हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू। आज है 18th ऑफ मार्च 2025। वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का सेशन। कमोडिटी मार्केट का लेवल देखोगे सेम ही है, कोई खास चेंज नहीं हुआ है। ठीक है, लेवल्स आर सेम। क्रूड ऑयल कल याद होगा एक सपोर्ट से बाइंग का ट्रेड बनाया था, वहीं से बाइंग आई थी। मार्केट आज थोड़ा सा फ्लैट ओपन हुआ था। ऊपर यहाँ रेजिस्टेंस है, यहाँ एक सेलिंग का प्लान रख सकते हैं इस एरिया के अराउंड एक थोड़ा सा। ठीक है, थोड़ी क्वांटिटी कम रखना क्योंकि ऊपर भी एक रेजिस्टेंस है। ऊपर आ जाए तो बेस्ट है यहाँ पर वैसे, लेकिन थोड़ी बहुत सेलिंग जरूर की जा सकती है। नेचुरल गैस भी कल एक सेलिंग का ट्रेड बना था, फिर मार्केट साइडवेज चला गया था। मैंने कल आप लोगों से कहा था कि अगर पुल बैक आया मार्केट में और फिर सेलिंग आती है तो बेटर रहेगा एज कम्पेयर टू डायरेक्ट सेलिंग आए। तो पुल बैक करके ही सेलिंग आ रही है। इसमें भी जो नीचे आता है इस एरिया के आसपास, तो यहाँ पर एक थोड़ा बहुत बाइंग का प्लान रख सकते हैं इस एरिया में। ठीक है, इस वाले लेवल को चाहो तो रिमूव कर दो, जरूरत नहीं है उसकी। बाकी डेटा की बात करें, 6 PM पे बिल्डिंग परमिट और हाउसिंग स्टार्ट का डेटा है। गोल्ड और सिल्वर को थोड़ा बहुत इम्पैक्ट करेगा एंड देन और कोई डेटा नहीं है। मुंबई सेशन ओपन है, लंदन सेशन ओपन होने वाला है कुछ मिनट्स में, फिर शाम को न्यूयॉर्क सेशन एंड यूएस मार्केट ओपनिंग है। न्यूज़ देख लेते हैं कुछ, अगर न्यूज़ है फिलहाल के लिए।
News when you want it with Bloomberg News Now. I'm Stephen Carroll.
And I'm Caroline Hepker.
The UK's Chancellor Rachel Reeves has defended her fiscal rules and pledged to bring down government borrowing. She was speaking to Bloomberg as the government's due to announce major plans to cut welfare spending later today. Speaking ahead of that announcement, Reeves sought to justify the measures.
It is important that we balance day-to-day spending with tax receipt and that we get debt down as a share of GDP. Those are the right fiscal rules for the circumstances that we face. But when we're spending £100 billion a year on servicing, I don't think anyone could seriously argue that we don't need to get a grip of government borrowing and government debt.
Reeves is having to rein in spending after higher borrowing costs and lower growth forecasts eroded her slim fiscal headroom from October's budget. But the Chancellor is up against internal pressure from Labour MPs and some Cabinet colleagues to soften her stance to avoid spending cuts. Later today, the Work and Pension Secretary...
Good afternoon.
Liz Kendall will announce cuts to welfare spending of as much as £6 billion in an effort to stabilise the public finances without the need for further tax rises.
Israel has launched a series of airstrikes on Gaza overnight, effectively ending a near 2-month ceasefire. Israeli Prime Minister Benjamin Netanyahu says his government will go after Hamas with increasing military strength for failing to release the remaining hostages. Bloomberg's Jerusalem reporter Dan Williams says a continuation of the conflict was inevitable.
Really, this resumption of fighting was just a matter of time. There may be an element of tactical surprise here. Indeed, Israeli public opinion was largely diverted in recent hours by internal discussions about the fate of Israel's Shin Bet security chief, his termination. It could be that discussion was actually meant to provide a smokescreen for the resumption of these Israeli attacks.
Our reporter in Jerusalem, Dan Williams, speaking there. The Hamas-run health ministry said that 44 people were killed by the airstrikes. Local reports suggest that that estimate would climb. Hamas released a statement saying Prime Minister Netanyahu had decided to, quote, overturn the ceasefire agreement, putting the captives in Gaza at an unknown fate. Hamas still holds about 60 Israeli hostages.
President Trump is expected to speak to his Russian counterpart Vladimir Putin in the coming hours about ending the war in Ukraine. Trump has already sparked concerns that he may sacrifice Kyiv's interests in a deal with his comments at the weekend that the US and Moscow are already talking about, quote, dividing up certain assets. The US is pressing for Russia to agree to a 30-day ceasefire that Ukraine has said it's ready to accept. However, Putin has insisted on a number of conditions before committing to any truce. Speaking to reporters, Trump sounded a positive note on the prospects for the call.
It's a bad situation in Russia, and it's a bad situation in Ukraine. What's happening in Ukraine is not good, but we're going to see if we can work a peace agreement, a ceasefire and peace, and I think we'll be able to do it.
Meanwhile, the news website Semaphore has been reporting the White House is considering recognising Crimea as a Russian territory in a future agreement. European leaders, meanwhile, are worried that Trump may concede too much on Ukraine's behalf in a direct exchange with Putin. They're pushing for security guarantees and a peacekeeping force to deter Russia from renewing hostilities in the future.
Now, the UK and EU are moving ahead with discussions on how to seize frozen Russian assets to boost Europe's defence spending. Bloomberg's Ewan Potts has the details.
Foreign Secretary David Lammy is meeting with the EU's top diplomat Kaja Kallas in London today. Top of the agenda will be increasing economic pressure on Russia ahead of any peace talks to end the war in Ukraine. Bloomberg understands the discussions will also include how to ensure Europe has the right legal and financial cover to seize billions in Russian assets to boost defence spending across the continent. We're told progress is being made despite resistance from some European countries concerned that the confiscation could breach the principle of a state's immunity under international law. I'm Ewan Potts, Bloomberg Radio.
German lawmakers will vote today on a bill to unlock hundreds of billions of euros in debt-financed defence and infrastructure spending. The Conservative Chancellor-in-Waiting, Friedrich Merz, and Social Democrats sealed an agreement last week with the Greens that should secure the two-thirds majority needed for the law to pass the Bundestag. The bill would allow for spending on defence and security above 1% of GDP to avoid constitutional borrowing restrictions. It would also create a special infrastructure fund and give Germany's 16 states leeway to borrow more.
Two NASA astronauts stuck in space for more than 9 months are now on their way home. The return capsule has undocked from the International Space Station and is falling to Earth. Nick Hague is the crew commander.
It was a privilege to call station home, to live and work and be a part of a mission and a team that spans the globe working together in cooperation for the benefit of humanity.
Hague is travelling home along with Butch Wilmore and Sonny Williams. The pair had been due to stay at the ISS for 8 days, but technical issues extended their stay by 9 months. The saga has seen SpaceX replace Boeing as the company in charge of the return flight, in an embarrassment to the aerospace giant.
Those are your top stories on the markets. We saw US stocks rising for a second day yesterday. The S&P 500 finished up 0.6%, with 90% of stocks in the S&P 500 finishing higher as well. Mega cap tech, though, absent from the rally. The Mag 7 index ended more than 1% lower. In Asia today, we are seeing equities gain on the positive Wall Street close as well. Third straight session of gains there. The MSCI Irish Pacific Index 0.9 higher. The Nikkei 225 up by 1.3%, and tech shares in Hong Kong are up by 2.9%. And ahead of the German vote today, we've got the euro trading a touch weaker against the dollar, but still above the 109 handle, 109.11. European stock futures 0.4 higher on Euro Stoxx 50.
That's news when you want it with Bloomberg News Now. I'm Caroline Hepker.
I'm Stephen Carroll, and this
We're doing pretty well, I think, with Russia. And we'll see if we have something to announce maybe by Tuesday. I'll be speaking to President Putin on Tuesday. And a lot of work's been done over the weekend. We want to see if we can bring that war to an end. Maybe we can, maybe we can't, but I think we have a very good chance.
What sort of concessions will you be seeking to have Putin make to get a deal done?
Well, I think we'll, be talking about land. It's a lot of land. It's a lot different than it was before the wars, And we'll be talking about land. We'll be talking about power plants. That's up, it's a big question. But I think we have a lot of it already discussed very much by both sides.
You'll ask him.
Ukraine and Russia.
You'll ask him.
We're already talking about that, dividing up certain assets. Yeah, and they've been working on that.
What do we know about this call that's going to happen tomorrow?
Well, we know that the ceasefire will definitely be a topic of conversation, probably the main focus of the call. Before the call, Trump said that they were going to discuss a couple issues, including land and a nuclear power plant, or a power plant, which I assume was the Zaporizhzhia nuclear power plant, the largest in Europe, that Russia has held since early in the war. We know that before the talks with Ukraine, U.S. Secretary of State Marco Rubio showed up saying that there was going to have to be concessions on territory. So with Trump talking about that, that's likely to be a topic of conversation. We could very well see them talk about the contours of an eventual ceasefire and potentially even win.
Could this be the breakthrough the world is looking for? Could this be actually the phone call that decides on whether Russia also sign up to that ceasefire proposal that Ukraine agreed to last week?
It's hard to see. Russia has been very reluctant to agree to a quick ceasefire. They've ruled out a truce during negotiations because they're basically making battlefield gains right now. They want to dislodge Ukrainian troops from Russian territory. They've made a lot of progress in Kursk, and they'd probably like to see that happen before any further negotiations happen. So time is really, Putin's calculating that time is on his side. So a quick ceasefire is probably unlikely to come if Putin gets his way.
So he might want to push it out a little longer. What do you think Ukraine and Ukraine's European allies will be watching out for on this call today?
Well, they'll definitely be watching very carefully.
Tomorrow, I should say.
Yes. They'll be watching very carefully. They're very concerned that in Trump's rush to get a ceasefire, he may make too many concessions. They're clearly worried about their own security framework, both in Europe and Ukraine, and they don't want Trump to see that in the rush for a ceasefire at any cost.
Yeah, and yet they are still having discussions about what military and defense support they can continue to provide to Ukraine, even once the ceasefire is agreed to. Talk over the weekend still of, X thousand troops being sent from UK and France to Ukraine. But that's a non-starter for President Putin. So how do you square that up?
That is a big question in any kind of ceasefire agreement, because Russia has ruled out NATO troops on the territory of Ukraine, but Ukraine has insisted that it needs a security guarantee that is enough of a deterrent that Russia won't resume hostilities down the road. We've seen players like the UK and France really step up and try to lead the initiative with their own defense framework, but there's a big question of whether they can do it and how fast, especially if the U.S. pulls back.
The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style.
1-seat buffer appears to be what we have at the moment, but that does assume that everybody votes kind of along party lines. So it's going to be interesting to see whether that happens. The Constitutional Court has rejected a number of motions over the last few hours to hold up this vote. It doesn't look like that is going to be the case. I do wonder whether that was what we saw yesterday in the 30-year, maybe a reaction
Yes, maybe
to some of that and concerns around what was happening with the Constitutional Court. So maybe that has been taken off the table for now. But in terms of the defence spending, in theory, it's unlimited at this point.
Yes.
So the numbers that are being put on this could be exceeded by some significant margin. We just don't know.
Yes, indeed. I've seen unlimited used in a number of reports around this story. And on the federal court, Karlsruhe, often our focus when it comes to German politics, because they seem to have the final say on so many things. It is interesting in the detail of our story. It says that they have said they won't delay the vote today, but they will take a look at whether sufficient time was given for all the parties to get across this and to have views on this vote. So I wonder if that comes back. But for the moment, the market is focused on whether it passes.
Let's turn our attention to the other key kind of almost historic moment that we are going to see later on today, and that is the Trump-Putin talks that are going to take place surrounding Ukraine. I think the symmetry of these two stories is really interesting. These talks come on a day when potentially we're talking about waking Germany up as a military force once again. I think that is interesting from a historical perspective. The talk, I don't know what time the talks are going to take place. Trump talked on Air Force One yesterday about it being tomorrow morning, but is that his morning? Who knows where he was at that point. So at some point today, these talks are going to take place. In theory, this is about the 30-day ceasefire. In practice, it may end up being a little bit more. It may be, as our stories hint about today, the idea that maybe we're talking about carving up assets. The New York Times points us to Yalta. Remember the Yalta conference from history books? Talking about the carve-up of Europe, East-West, a key conference that took place towards the end of the Second World War. Is that what we're witnessing here? I think there's going to be some really interesting historical parallels coming through.
There were more than two parties at that table.
There were three.
Yes.
And they were all sitting in a line. I'm sure at some point they were around a table. But we just don't know what comes out of these talks. And I think that's the challenge for Europe, because it, to your point, is not sitting around the table and doesn't have a voice in this discussion at this stage.
Absolutely. A different conversation taking place in Europe around Russian assets, because the UK and the EU are having conversations. David Lammy, Carla Callas, getting together today to talk about the potential for seizing Russian assets and whether they can fund some of the war war losses that way. But that, taking us back to our first story, requires a change of view in Germany. Maybe the new government brings a change of view on that. They've had other things on their plate in the very short term.
You talk about frozen Russian assets. I'll bring it back to the markets here. There's also reports that Russia is now allowing trading of some of its assets as well. And so that's another, we're talking about perhaps getting more than we bargained for in this call. You're starting to see some of the global Wall Street warm up to this idea of what does maybe this thaw actually mean for them.
Yep. And what happens with defence stocks today as well? Defence stocks have had a massive run. We talked to Amundi yesterday. The view there was maybe this run has gone too far. But to your point, maybe we're in the kind of buy the rumour, sell the facts narrative when it comes to defence stocks.
On that subject, I'll also throw in, we'll get the latest details on what's been going on in Gaza, but some are citing that as another reason that we could see defence stocks go higher at the open. So there's a lot happening today.
Yeah, positivity, it feels like across the board. And we saw a little bit of that in the U.S. session yesterday. But it feels like, is this moment for rotation here? Is this moment for not just buying the dip after a 10% technical correction, but is this a moment where maybe we are seeing a reversal in the spoon move? We are seeing a reversal in the outperformance of the DAX, not just for fundamental reasons, but just because maybe the valuations in other spots look a little juicier.
The equity market sell-off over the last few days has been interesting. The last kind of nearer term period, the rally back has been fascinating as well. I've read a number of pieces over the last 24, 48 hours that talks about this being a healthy correction, i.e. we're seeing maybe overvalued tech stocks coming down, the rest of the market doing okay. I think the argument around that at the moment is still yet to be proven.
A little Scott Bessent.
Yeah, I was going to say, is that yesterday's conversation around Scott Bessent coming back? Yeah.
So I think it's going to be interesting to see how the rest of the week progresses. Clearly, yesterday was a light volume session. We are waiting for the Fed, and I think that probably is the key moment this week.
And retail sales, we built that up quite a lot, didn't we? We got excited last week about the prospect of retail sales, and yet in the end there was something in it for everybody. With the disappointment initially, and then the control group, that sort of smaller data set, seeming to please some.
There's no real clarity on where the American consumer lies. So on the one hand, they're expecting inflation expectations at a 22-year high. On the other hand, they're still spending, and yet there's still some stimulus and liquidity. It's a little messy, not just on the geopolitical front, but on the consumer front as well.
Yeah, it's noisy, it's difficult to read, it's uncertain, hard to invest in. Difficult markets, interesting markets. Talking of which, we are going to have some great discussions around what is happening in these markets and these economies. Amanda Blanc, Aviva CEO, is going to be joining Francine Lacroix very shortly. Chris Rhodes, the ICE Futures Europe president, is going to be joining us around the table. Valerie Noel, Seas Group head of trading, to talk us through the markets. All of those guests coming up.
Yeah, we'll also be speaking to we'll be talking to the BBVA CEO. Ona Gench will be with us. A lot to talk about when it comes to the global macro environment, but also M&A, of course, within the banking sector and in Spain specifically. We'll also talk to Mère-Anne Barbat-Leani, who's the chair of the French Markets Authority, the AMF. That conversation around the regulation of markets, the Capital Markets Union, as it used to be called, now the Savings and Investment Union, apparently. We'll get into that conversation.
Love a rebranding. Of course, we have the perfect lineup to talk about. Of course, the main topic that is today, and that is Germany. At 10 a.m. Germany, 10 a.m. UK time, we get that Germany ZEW or ZEW, if you prefer, the survey expectations. We'll see if the market reacts to that latest data set. But then, of course, the highlight of today in the European session is that vote on the debt brake. So we're going to keep an eye and, of course, bring you the headlines as we get them right here on Bloomberg TV. In the afternoon, though, the focus switches over to the U.S. We've just been talking about the economic data from the retail sales to the inflation expectations. This afternoon, we get housing starts, import price index, and industrial production numbers as well. But then again, I think the highlight, perhaps for tomorrow for us, is going to be Jensen Huang's keynote speech. If we're talking about a rebound in these markets, how much of that can we expect to really show up in NVIDIA specifically?
Does big tech need this to happen now? Do we need a positive speech to get these stocks back on track? They've come down a little bit. Some would argue they're still trading at incredibly lofty valuations. What can he say? He's usually so optimistic. He's usually so positive. So many great things to say. Are those comments going to land, or is there more skepticism this time around?
Yes, in a world that knows about DeepSeek and knows about other Chinese competition.
Manus.
Manus, yes, which the bar is not quite the bar is not where it used to be, I suppose, for the likes of NVIDIA to impress. But we'll be looking for any news on their new processor, or the one still to come, Rubin. We'll be looking out for information on sovereigns and how much they're planning to spend on AI. So there could be a lot in the mix today.
Is it still coming down to the hyperscalers? Is it still coming down maybe to the shipping delays? Blackwell was exciting, but it's just now got shipped out. Rubin is exciting. We're still looking at delays a year, 2 years down the road.
Absolutely, and there's all kinds of other issues still going on around this. What happens with energy? What happens with gas, particularly in the United States? all kinds of energy aspects to this story that we need to focus on as well. Anna was mentioning it just a moment ago. Let's talk about some of the other stories we need to focus on this morning. Israel has launched a wave of airstrikes across the Gaza Strip in response to what Prime Minister Benjamin Netanyahu says is Hamas's refusal to release Israeli hostages. Gaza health officials say at least 235 Palestinians have been killed. Many more have been wounded. The White House says it was consulted ahead of the attacks. Bloomberg has learned that Chinese authorities are looking into Li Ka-shing's plans to sell the bulk of his company's global ports operations to a consortium led by BlackRock. The deal, worth approximately $19 billion, has drawn criticism from Chinese officials and politicians who accuse the firm of groveling to US pressure. President Donald Trump had touted the deal as the US reclaiming the Panama Canal. And shares in BYD have jumped to a record high. This after the Chinese automaker unveiled a new lineup of electric vehicles supported by an ultra-fast charging system. Now, according to BYD, the new battery system can provide around 400 kilometres of range with just a 5-minute charge. Now, the company is expected to start selling the vehicles with this new technology next month. So we're getting close to the kind of time that it takes to pull in to a petrol station, gas station, and refill. Now, you don't quite get the same range as you would if you did that with a petrol car or a diesel car, but you're starting to get close.
Yeah, I mean, I'm sure I could take longer than 5 minutes. So, you know, maybe they don't need to pursue any quicker charging, any more ultra-fast charging we've wasted on me. I mean, is this the end of all of those anxieties? Because there's range anxiety for
rage.
Around rage. And then the rage that you feel if you show up at a charger and it's broken, for example. I mean, if it's only 5 minutes, none of these things matter as much as they...
But you've still got to have the number of chargers, and that's the issue.
And they have to not be broken.
I think we should put this into some context here, because I had to do some digging. I didn't actually know what this meant. I've never driven an EV, I have to admit. I certainly have never driven a BYD either. But the kilometre per minute charging, according to our reporting, is about 80. So 80 kilometres per minute charging. By comparison, you look at Tesla, the main competitor, of course, is 18 kilometres per minute charging. This isn't even a beat by a small margin. This is a massive beat.
And better than Mercedes, which is the best European one in our research, in our little bit of digging on how they compare.
Can we just talk about speeds? Because these cars go really quickly as well. So they go to 0 to 100 kilometres an hour in 2 seconds.
Yes.
Okay. So this is Ferrari speed.
Unless you're driving in Germany, is this relevant?
Well, no, acceleration is still important.
Okay, sure, that helps.
So that does help.
This is the crucial context, the crucial Guy Johnson context.
But it does kind of it levels the playing field, which I think is fascinating. Why do you need a hypercar? So a Bugatti Tourbillon, which is this kind of multi-million-pound hypercar, does 0 to 100 in 2 seconds. The BYD, you can be driving around one of these. I went in one the other day in Dubai as a taxi.
I hope it didn't go
2 seconds as well. Fortunately, didn't go quite that fast. But it's going to be interesting that speed is no longer the metric.
Yes.
That the supercar makers are going to be able to rely on, because everybody's going to be able to do it.
Taking us back to where we started, will the grids...
You don't want to talk more about this?
Will the grids be able to cope? Was another line that stood out to me in our story, because it'll be limited to certain bits of China where they think they've got the infrastructure to deliver this.
Well, it's also a tone shift on EVs. Hasn't the narrative around EVs simply been that this is no longer in fashion, this is no longer in vogue, and now could this bring another wave of money from specifically, of course, Asian investors, but around the world as well?
OK, let's focus on what's coming up during the programme. The UK Chancellor Rachel Reeves defends her fiscal rules and pledges to bring down government borrowing. More from Lizzie's interview later in the programme. Plus, Santander Executive Chair Anna Botín tells Bloomberg that Europe is awakening thanks to President Trump. We'll bring you that conversation in the next hour. Up next, we'll be joined by Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income at Neuberger Berman. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on your Bloomberg terminal. Yet another lovely sunrise. I feel we've been spoiled these last few weeks here in London. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Today's CFOs focus on much more than revenues and margins. Their impact goes far beyond the balance sheet.
The world is coming at us faster than it ever has.
We're in an evolving business.
Our first job is to intimately understand and anticipate the consumer's needs.
We've been on a journey to be higher growth, more nimble, and more capital efficient.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. New episodes this spring, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Europe is awakening, and the alarm clock has been President Trump. Because what I have never seen is the President of the Commission saying that we're in extraordinary times and we need to take extraordinary measures. So it's not just good for the US, it's good for Europe. What's happening is good for growth.
Making Europe great again. Anna Botin, Executive Chair of Banco Santander, speaking with David Weston for Wall Street Week. Takes us nicely on to what is going to happen today. 2 key conversations, one around Ukraine, one around German spending. The German Bundestag, of course, is getting ready to vote on a bill later today that could unlock hundreds of billions of euros in defence and infrastructure spending. What does it mean for the markets? Valerie's here to tell us.
Guy, it's high stakes for this vote later this afternoon. Let's just take stock of how markets have digested this recent announcement from Germany for this infrastructure spending. Just in the month of March alone, the euro has rallied over 5%, nearly 5.5%, Guy. Its best month in over 3 years. And on the flip side, German bonds, those yields are rising, a 40 basis point rise in the German 10-year yield as we price in this extra debt issuance from Germany. Also, defense stocks, we got to keep talking about those. That rally is extending in defense stocks. Barclays saying they want to be buying on any dips. We flip on, we can just check on how they're moving year to date, because Rheinmetall, some of these stocks up over 100% year to date, and many are still calling for further gains to this sector. Maybe on this vote this afternoon could be the catalyst for further gains. But defense, this rally in defense is boosting other sectors across Europe. Talk about construction, talk about other industrials as well. Flip on, we can just talk about German mid-caps, because we had a note out from Deutsche Bank saying that they want to move into German mid-caps, saying that once this hurdle is over with, they are still wanting to go for more growth when it comes to those German names, especially when it comes to mid-caps. That's the MDAX index here in yellow.
Valerie, great stuff. Thank you very much indeed. Perfect setup. So 2 key events today. 2 things that the market has been worried about: what is happening in Ukraine and also this key German votes. Let's talk to Robert Dishner from Neuberger Berman about what happens next. Senior portfolio manager, multi-sector fixed income and head of trading here in London. Is today today mark the passing of peak uncertainty? We've been in enormous uncertainty for weeks. Is today the day when that starts to recede?
Yeah, we sort of think that this is when maybe it can start, right? We have the German vote, which you alluded to. We have the Fed tomorrow. We have the Bank of England, Bank of Japan this week. And then obviously the tariffs in a couple of weeks. So the market's going to get a lot of answers to its clues. If you think Jerome Powell kicked off some of this uncertainty a week or so ago when he talked about potentially increasing growth forecasts, will we actually get that Wednesday? So today's the first stop, or really end of last week, but is today the first stop in climbing down a little bit from that wall of uncertainty.
If we've passed peak uncertainty, or it happens over the next few days, do we take more risk? Does the market take more risk once that moment has been cleared?
It's certainly possible, because you look at things we were talking about earlier. The VIX was greater than the first dated future. That was extending. So the market was telling you there's just a lot of current uncertainty in the market. And so could the market rally after that? Yes, absolutely.
Don't worry about that.
Yeah.
Take it out.
You can take it out.
Take it out.
We're all here, so you don't need it anyway, Robert. Good to see you. What about the Fed and its role in this uncertainty then? Because you nodded to a little bit of it there, but the Fed is dealing with a whole range of uncertainties, just like the rest of us, and a kind of much more price-taking than they've been in recent years, perhaps, with having to take big policy shifts from the White House.
Yeah, no, absolutely. But, it's their job and it's our job, right? And so, they're going to have to calibrate the economy for that. Is this lower growth, or is it stable growth, or increased growth, which Powell had been talking about a couple of weeks ago? Is it stable inflation or potentially higher inflation? And how do they react to those type of environments? So, from our perspective, this is what they're meant to do, and the market is looking for this. This is going to be a big meeting, right? Because we get the projections, and so how is the Fed sort of thinking about these policies in terms of their outlook?
So is this the first Fed meeting where they can't hide behind, we have to wait for policy? Is this because we haven't got much backward-looking data for them to go on that reflects the new regime?
Right.
But because we get the projections, does that mean for the first time we really get to see what they think these policies will do?
That's exactly right. And if you think about the December projections, some people had it, some people didn't. So now we're going to get the full committee in terms of what they think about what all these policies mean.
Robert, can you give us a range here on the bond market? We'll start with the U.S. just to continue the flow of the conversation. Looking at a 430 on the 10-year. In 48 hours' time, what kind of range are we looking at?
That's a great question. It's been really stuck in a fairly narrow range. The volatility's been in other markets. That's been Germany, that's been Japan, that's been China. No one's really talking about that rise in Japanese yields or the Chinese yields year to date. But the U.S. market's probably a bit more range-bound in terms of yields. So is that a 425 to 450, a 430 to 450 type range? And so the U.S. is probably not where unless we get a big announcement regarding or something big in terms of growth, the U.S. market's probably a bit more range-bound because there's equal pushes and pulls with some lower growth and potentially some higher inflation. But again, those are sort of netting against each other to create really the opportunities a little bit in rates markets. There's been bigger moves elsewhere.
Let's talk about the range then on the German bond market. And we'll get 281 on those yields right now. Next 24 hours, give us a range.
Well, that's a great question. I mean, look, we rallied, 8-10 basis points yesterday on fears of constitutional court. So the volatility is really in that market. And could boons hit 3% in the short term? Maybe, maybe not. But really, what's the long-term rate for Europe? There's a lot of implementation risk. First of all, there's the risk of getting the deal done. Then there's the implementation risk into it. And then there's, as we talked about earlier, the possible truce in Ukraine, which could lower gas prices. So you're looking at probably a bigger range than people have been used to in boons. I think last week, or 2 weeks ago, the 40 bips rise was one of the biggest in history. So the markets are sort of recalibrating what that range is. And again, is that a 275, 3.25, 250 to 3? I was just in Switzerland. Huge diversity of views.
Yep.
Right? Some people calling for 350, some people calling for 250. So it's a difficult situation for the market to attack.
Treasuries are trading 147 over bunds at the moment. We've been as low as 138. If that spread continues to widen back out again, should the euro go lower?
Well, one of the things on the euro, and we've been fairly constructive, right? But the easy sort of money in the euro is probably out of there. But think about all the repatriation, right, that could come back. You think about this investment in defense, or you think about this investment in growth, and you had that decade-long with negative interest rates.
Yep.
Right, and it's not even from, like, the Swiss National Bank or the Norges Bank or those.
Money's just gone across the Atlantic.
Exactly.
In waves.
And does that money start coming back to further support, let alone that investment, if there is going to be European growth, which is, we're talking about a fairly big difference in terms of perceptions of European growth from just 3 weeks ago.
Certainly something we're going to be watching very, very closely. Euro dollar at 109.2 and rising as we speak. Robert Dishner, Senior Portfolio Manager for Multi-Sector Fixed Income, Head of Trading for London over at Neuberger Berman, joining us around the table. I think you asked the key question there, which is that rate differential story and how quickly it shows up in the euro. Because when we've seen these spreads blow out, the euro's been a little slow to catch up for those fundamental reasons. This time might be different.
Yeah, but it's going in the wrong direction at the moment for the euro. So does it get stretched, or is this just a flow story? As Robert says, money just coming back in the opposite direction.
Yeah, it might absolutely be. And that's without even factoring in the U.S. and factoring in the Federal Reserve. I'm looking at 430 on the 10-year and marginal strength, I'm going to call it, on the Bloomberg Dollar Index. Coming up, we're going to stick with the markets. We're going to talk about these geopolitics a little bit more. An exclusive interview with Amanda Blanc, the CEO of insurance giant Aviva, as the U.K. government seeks to cut regulation and urges pension funds to invest more at home. That conversation next. Stick with us. This is Bloomberg.
In case you missed it on Bloomberg Surveillance, Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. Do you have any plans to visit Kentucky?
I don't have any plans. I can tell you that we do an audit every year. I can tell the American people on camera right now, all the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
Don't miss Bloomberg Surveillance, live every weekday.
Do you think it'll be the case where someday you will be an investment committee or I'll be an investment committee and we just apply AI, decide whether it's a good deal or not, or we're not going to be there anytime soon?
I don't think we'll be there in the near term. And David, because, being on investment committees, there's the analytics of the math, there's the people, and then there's judgment. So analytics and math, I think AI will help us get way more refined. Right now, we have analysts building models upon models. Our typical investment memo is 86 pages. So we could refine that down very, very seamlessly to pieces. The people aspect to it, to make a judgment call on, do I believe this entrepreneur is going to go the next mile? Do I believe that the background of the entrepreneur, who they are, what they stand for, their values, their family, that's the harder one. I think AI is going to take some time to get there. And then the final piece ends up being judgment. And I don't believe we've seen anything yet that gives us a sense of judgment that we're able to apply.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome back. 30 minutes from the start of equity trading. Futures are pointing a little bit higher for Europe, but 30 minutes until we get the cash trade. This is the future picture then. It looks to be detaching a little from the US, picking up on the US of yesterday, of course, but US futures then point a little lower, so we'll see where that takes us later in the session. But for the moment, we focus on some equity gains perhaps ahead. We watch defence stocks very closely. We are also focused on very much what's going on in the bond markets this morning, because we have a German vote taking place. It should pass. This spending bill around infrastructure and defence should pass because the German government has the necessary seats to get it through, in theory. But of course, until it's actually delivered, the market will be watching very carefully. With that in mind, we've already seen 40 basis points, of course, added to Bund yields over the past, well, just during the month of March, Valerie was telling us earlier. Yesterday was a little different to that. Maybe some people are asking questions about whether the vote goes through today. But today we do see a little bit of movement in bond markets, but not much yield going, just a touch higher across the German curve, in fact.
Yeah, it's fascinating here because we keep talking about the yield move, but the spread story is fascinating in that we haven't actually seen we've seen the denominator move, we've seen the German side move, we haven't seen French, Spanish, Italian debt move by the same margin that I think a lot of people expected. That almost feels like a massive dislocation to me.
Also about gilts, because it's going to be a big week for gilts as well.
Yeah.
You've got the OBR stuff coming out. You've got, obviously, we've spoken to Reeves. Lizzie's been talking to Reeves.
Yeah.
Huge moment coming up for the Bank of England as well. That's going to be a potential for movement in gilts this week. Quite significant too.
Yeah, next week, of course, the spring statement. So, yeah, making our way toward that, of course. Thinking about what's happening in the UK government says plans to cut regulation will boost investment and create more jobs as it seeks to grow the economy. In an interview with Bloomberg, Chancellor Rachel Reeves defended plans to abolish more business regulators.
Overlapping regulation has held back Britain for too long, and we're determined to turn that around. We've made a commitment to reduce the regulatory burden, the administrative burden, by 25% during the course of this Parliament. That's across all regulators, whether it is in the environment or financial services, right across the economy. And that is to meet our ambition to grow the economy, to make working people better off, and to make our country and our economy more competitive.
Now, officials are also putting pressure on pension fund managers to commit 10% of their assets to British equities. That's part of a rebooted Mansion House compact in the summer. Let's bring in Bloomberg's Francine Lacroix now, who can take us into a conversation with the Aviva CEO. Francine, good morning.
Good morning, Anna. Thank you so much. I'm delighted to be joined by Amanda Blanc, of course, the Aviva Chief Executive Officer. Amanda, thank you so much for giving us a little bit of your busy schedule. There's a lot of talk about this Mansion House, Compact 2.0. What are you expecting to see in it? Is 5% asking of investment managers to put of their AUMs in the UK enough?
Well, I mean, no, I don't think it is enough. I mean, it would be great for it to be more, but I think it's a really good starting point. And I think getting that investment from private assets available to retail investors through their pension fund is a really important thing. I mean, we launched our long-term asset fund last month, so we're really positive about the opportunity to do that. But it also requires a change of mindset away from focusing purely on the price of delivering the pension to the value created by the pension for savers.
I mean, how much of a difference does it make to you if it's 5 or 10%? What are you hearing, and what are you lobbying the government on?
The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style.
The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday following 4 straight weeks of losses, and the White House isn't blinking.
Corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So up next, the Fed decision, and Fed Chair Jay Powell showing very little interest in stepping in with rate cuts anytime soon, putting even more weight on this week's economic data. As consumer confidence drops and corporate America fires some warning shots, investor focus turning to U.S. retail sales later on this morning. Another read on the consumer, 8:30 Eastern Time.
Which is key, because right now, and it's good that you pointed out the idea that the Trump put maybe isn't as strong as people expected. Well, is the Fed put also a lot more difficult to really engage than people expected? Because even though we do see a softening in consumer demand, the real-time data seems to suggest that we're not seeing a softening in long-term inflation expectations, at least in the margins, which makes it difficult for the Fed to just full throttle embrace the weakness and respond to it.
UMich was spicy going into the weekend, so let's talk about some bullet points from the UMich consumer sentiment read. Consumer sentiment, the lowest since November 2022. Long-term inflation expectations higher. Households expecting higher unemployment at levels we haven't seen in more than a decade.
The consumer sentiment, it's obvious from this survey, is souring right now. And a lot of this is policy driven. If you look at the statement that came out from the director, many consumers cited the high level of uncertainty around policy. So it's not even the policy itself. It's the uncertainty waiting for it. And another nugget I thought was so important, nearly 50% of survey respondents just spontaneously started mentioning tariffs in the interviews that they conducted.
Wall Street is souring as well. Check out some of the forecasts we've had over the last week or so. Equity downgrades at HSBC, at Citi, price target cuts at Giardini, Costin over at Goldman Sachs, and now Lori Calvasina of RBC, dropping the price target on the S&P 500 from 6,600 down to 62.
It's about a 6% decline in some of her expectations for the full year. But she echoed what a lot of other analysts said over the weekend, which is it's difficult to know whether this is an entry point or whether this is just the beginning of a deeper pain in equity markets, because ultimately, as she said, the sentiment, the vibes aren't sending us a clear signal. And that pretty much was what everyone across the board said. Mike Wilson of Morgan Stanley, it will take more than just an oversold market to get more than a tradable rally. Stuart Kaiser of Citi, we will wait for better entry points.
If you're worried about policy, over the weekend, the president doubling down on trade.
Doubling down on trade. Him and Scott Bessent as well over the weekend talking about April 2nd being the big day when it comes to trade. That's when we will get these reciprocal tariffs. Neil Dutta, who'll be joining us, sat down with Paul Krugman and talked about the fact that what the market was pricing in with Trump was tax cuts, deregulations, and then maybe tariffs. But on this program, how many times did we say tariffs is the first lever he can pull? Because he can do it from the White House unilaterally.
Neil Dutta, about 2 hours, 30 minutes away on this program, 8:30 Eastern Time, shortly after we get U.S. retail sales. If you want the scores, equity futures right now pulling back by 0.5% on the S&P 500, following 4 weeks of losses on the S&P, the longest weekly losing streak going all the way back to August. On that losing streak, we'll catch up with Jonathan Stubbs of Berenberg later on this morning, plus Tobin Marcus of Wolfe Research as President Trump teases even more tariffs, and Lofi Karui of Goldman Sachs turning cautious on U.S. credit. We begin this hour with stocks lower as Treasury Secretary Scott Bessent dismisses market worries. Jonathan Stubbs of Berenberg writing the pullback in U.S. shares in the past couple of months is a better potential entry point. Valuation is still not supportive, but technical indicators are. Jonathan joins us now for more. Jonathan, welcome to the programme, sir. Talk to us about the technical indicators that you're looking at that provide you at least some encouragement.
Yeah, morning. I think, first off, we entered this year hot, and it's actually quite refreshing to hear Besant's comments. It doesn't appear to be a slave to the market, which I think is healthy. Remember, US equities were 22.5 times on a 12-month forward PE. That's the third liquidity-driven sort of bubble that we have seen in the last sort of 50 years. That was start of year. We're back to sort of 20.5 times on a forward PE. Some of the technical indicators, retail sentiment, the sort of the classics of AA, II, sort of bull bear spread. That hit last week. That hit sort of buy territory. RSIs have been sort of hovering around there for a while as well. So there's some sort of technical sort of friction into the US market. The big question is, what has really changed? What has the Trump administration done to change the whole setup for US equities? Is the US actually now a broken trade on that basis? That's what I've been exploring with investors over the last few weeks.
So do they think it is a broken trade?
I don't think the market's come round to that, but work I did last year showed that the US equity market in market cap terms gained around $30 trillion of value from 07 to 23. And if you calculate a total policy impulse in the US, a sort of broad sort of number for monetary and fiscal, so change in central bank balance sheet, change in government debt, the US total policy impulse over the same period was $30 trillion. So pretty much a one-for-one relationship move with US equity markets. So given the sustainability question over sort of US fiscal, is the US now in a position where it's playing exactly the same policy which has driven American exceptionalism for the last 15 years, or is the Trump administration doing a 180, going in an opposite direction, trying to rewire America, remap the world? I think the latter is the case. So I'm not saying broken trade, but it's definitely a different proposition to investors today, in my view.
Jonathan, what are people waiting for to decide whether this is maybe a tactical trading opportunity versus maybe a bottoming out and a really good buy in the U.S.?
Yeah, I think the tactical opportunity, I can see I've written about. We came into this year saying we would look to buy lower on weakness, etc. We've had that weakness. Some of the tactical sort of technical frictions are there. I was updating our sort of forward grids end of last week, and for the US to enjoy 15% earnings growth, which is above consensus, and to be on what I consider a bull market multiple, which is 20 times PE forward in 12 months' time, that would give US equity markets 6% upside from here. So we have to stretch consensus. We're holding that sort of 20 times bull market rating. To get more than that, we have to see earnings growth 20% or higher, which is very unlikely. Or we're having to go back into that liquidity sort of bubble PE, which I also think is quite unlikely. So I think the US is in for a more sort of sober and somber year trading range. It'll pay investors to stay nimble, nibble when we get the sell-offs like we have, but don't sort of buy into the wholesale change that we're just going bottom left, top right.
You framed it in a way earlier to sort of demonstrate that in the United States, a lot of equity investors have simply been reaping the benefits of a whole host of bazooka of fiscal spending. That fiscal spending bazooka has shifted to Europe, has shifted to China. Is that kind of what equity investors are going to do as well? Is that trade over in terms of the shift to European equities in particular?
Yeah, correct. I mean, I've put this in my sort of regime analysis over the last 3 years. I've called that Brave New World. I write about that all the time, and my framework has been very sort of simple, 3 parts. First, this is a world of political and geopolitical disruption. We're seeing lots of that. Second, this is a world of fiscal activism where big government is the order of the day when it comes to generating growth and even sort of equity market gains. And thirdly, this is higher for longer. So my Brave New World framework hasn't changed, but as you say, there's been a very significant shift and a delta change from a European perspective. I would go as far to say that Trump is actually driving European policy. And our view as of the last 6 months is that Europe had upside risk, still has upside risk, but less so than 6 months ago. The Chinese are obviously having to sort of battle against disinflationary forces and sort of soft growth, but I suspect that they'll sort of muddle through as well. So yeah, I think the worm has turned. I think it's a big worm that's turned. And I think it means investors globally have got to take more balance in their global equity allocation. That probably means lightening up on US exposure and broadening out to the rest of the world. That's what we've been doing over the last few months, and that's what we'd recommend today.
Jonathan, we've certainly seen the Trump effect in Europe when it comes to places like Germany. You talk about how the reset when it comes to Trump 2.0 could have been extended pretend, tweak and modify, or wholesale change. And it looks like, according to your report, they're going for wholesale change. How long could we see the benefits of that, given it's going to cause a tremendous volatility on the pathway?
I think first, again, to recognise the lead-in you had earlier, Besant and the Trump administration recognise this. They're trying to manage that narrative real time. And I think everyone takes a step back. The conversation I've had with investors over the last few years is that the US has been and is on an unsustainable path when it comes to debt levels, when it comes to sort of fiscal sustainability. So it needs addressing. A modest tweak doesn't do it. US government debt is forecast by the CBO to go from $36 trillion today to 56 within a decade. America eventually breaks under that weight of debt. So the Trump administration is resetting energy, it's resetting trade, it's resetting national interest, it's trying to reset sort of domestic policy around ideology as well. So this is a wholesale sort of, as I say, rewiring of America, remapping of the world. It's radical, it's ambitious, it's obviously running into huge sort of frictions domestically and internationally. But America doesn't have too many options at this point. Modest tweaks won't do it. It needs wholesale radical surgery. And that's what the Trump administration is trying to put through. We'll see how successful ultimately they'll be.
So far, they're willing to tolerate some pain as well. Unexpected in many ways. Jonathan, got to leave it there. Appreciate the catch-up. Jonathan Stubbs there of Berenberg. Talking about a reset, I think a lot of people have got to reset expectations. And that's what the OECD is doing this morning, cutting the world growth forecast, citing, guess what? Tariff fallout.
This is what a lot of people have been talking about, not only downgrading growth, but increasing inflation expectations and saying the Federal Reserve may remain on hold well into 2026. This is the conundrum that they face. The report is clear to say if the tariffs are not that 25% across the board levy, that potentially growth would be impacted less. They still see slower growth, though, from some of the deglobalization trends that we see around the world.
They're playing catch down. We've seen this from so many houses on Wall Street over the past week, from Goldman, Morgan Stanley, the likes of Deutsche Bank cautioning as well about growth too. JP Morgan, Mike Feroli on Friday, Lisa, doing exactly the same thing going into the weekend.
A lot of people were expecting a little bit more of some sort of fiscal boost on one side. We heard a lot of businesses talking about tax cuts and deregulation as their nodes of optimism. Those have not been the nodes of optimism to start the year because, frankly, we don't see the time horizon for when that will get passed.
Equity futures just a little bit softer to start the week. We're down by about 0.4% on the S&P 500. With an update on stories elsewhere, with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Just some of the details of that OECD report that you mentioned, its latest economic outlook. The report says that President Donald Trump's aggressive trade policy is setting the global economy on a path of slower growth and higher inflation. The Paris-based organization has cut its growth forecast for 12 G20 countries, and it warned against ratcheting up retaliatory trade barriers. President Trump says that he will speak to Russian President Vladimir Putin tomorrow as the U.S. presses for an end to the war in Ukraine. Trump says that the discussions will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Now, the two astronauts stuck in space may be home as early as tomorrow night. SpaceX's Dragon capsule successfully docked at the International Space Station on Friday. The vessel was carrying a new crew, allowing marooned astronauts Butch Wilmore and Suni Williams to return home after more than 9 months in space. And that's your brief, John.
Just unreal. Absolutely unreal. Danny, thank you. More from Danny later on this hour. Up next on the program, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
That conversation up next with Tobin Marcus of Wolf Research. Live from New York City this morning. Good morning. So here's the state of play early this Monday morning. Good morning to you. Equity futures negative by 0.4%. A growing list of downgrades on Wall Street. The latest name, RBC's Lori Calvasina, dropping her price target on the S&P for year-end from 6,600 to 62. Mike Wilson of Morgan Stanley Publishing overnight saying tradable rally possibly. Durable rally, short answer, probably not.
And part of it is because not just this question around tariffs, but also growth expectations for earnings have to be pretty high. And that's really what we were just hearing. That's the sort of, fly in the ointment at a time where consumers just are not getting out there to shop. We will get the latest read today for retail sales.
The equity read last week was really tough. The bond market did nothing. No comfort at all coming from fixed income. Yields barely moved. This morning we're down 3 basis points. The 10-year 428.13. Under surveillance this morning, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. And April 2nd, I would have made it April 1st, but you know what April 1st is? April Fool's Day. I figured, I don't like doing it, but I made it April 2nd. But it's a liberation day for our country because we're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump saying both broad reciprocal tariffs and additional sector-specific ones are coming on April 2nd. The president suggesting added levies will be imposed on key industries, including autos, chips and pharma. Joining us now for more, Bloomberg's Tyler Kendall. Tyler, the president not backing down.
No, John, and President Trump, these comments signaling that we could see those reciprocal tariffs and those sector-specific tariffs you mentioned stacked on top of each other instead of just rolled in to one big calculation. And while senior administration officials have long pushed us to that April 2nd date, these comments that you're hearing do signal that President Trump appears ready to opt for that more aggressive tariff regime despite the recent market volatility. Importantly, he also went on to say that he is not expecting to implement any exemptions or carve-outs for his steel and aluminum tariffs that he implemented last week. As we know, many of our trading partners opted to negotiate with the U.S. instead of implementing their own retaliation. Of course, Canada and the EU examples to the contrary there. But it remains to be seen if any of those concessions are being made as these negotiations continue. Treasury Secretary Scott Bessent, in an interview over the weekend, did say that some of our most unbalanced trading partners are starting to lower their tariff barriers, although he didn't specify which countries exactly. But, John, it's showing that this administration does appear unmoved by the recent correction in equity markets, that they say that they are holding the course here for a more aggressive tariff regime. Both President Trump and Treasury Secretary Scott Bessent saying that this is all part of a pro-growth long-term outlook.
Tyler, when it comes to tariffs, we have 20% rate now on China, 25% steel and aluminum, and 25% on Canada and Mexico, but a lot of carve-outs if you're trading under USMCA. What can we see on April 2nd?
Right. So we are expecting those reciprocal tariff calculations. We have to keep in mind this White House has said that those will include those non-tariff barriers like the VAT tax, like subsidies, relaxed IP regulations. The administration is going to roll that all into one. And then those sector-specific tariffs that this White House has said is adjacent to national security concerns like autos, pharmaceuticals, chips that this president wants to see lower and bring down. That's why the European Union we've been talking so much about, because we know that they could be hit particularly hard when both of those tariffs are combined. We know negotiations are already underway. Just look at Friday when we saw that meeting between Commerce Secretary Howard Lutnick and a Canadian delegation, but still not seeing much movement when it comes to how these countries are going to start to lower their barriers ahead of April 2nd. I'll just quickly add that in his interview over the weekend, Treasury Secretary Scott Bessent did give us a range. He said, look at April 2nd, but also look potentially towards June 30th, the whole of the second quarter, as the timeline that we could start to see those tariffs go up and down as those negotiations continue.
Tyler Kendall, appreciate the update from the nation's capital. To extend the conversation, joining us now, Tobin Marcus of Wolf Research. Tobin, welcome to the programme, sir. Some people, and I stress some people, have been surprised by the amount of pain the administration is willing to tolerate here. From your perspective, just how far do you think the White House is willing to go in early April?
It seems like they're prepared to go big on this. And I think there's a huge range of outcomes that's possible on April 2nd. The value-added taxes that you were just discussing, that's the big question in terms of the reciprocal tariffs. If they roll out rates that don't incorporate value-added taxes, this will be a quite modest policy. If they do fully incorporate VATs, we're looking at rates in the 10 to 25% range on most of our biggest trading partners. And based on the way the president's talking about it, I think we have to assume that that will be included as they've indicated. Because if they don't, it's, I think, going to be a pretty underwhelming policy relative to the expectations they've been setting.
Well, the administration views differences in sales tax rates as an export subsidy. What can Europe do to get ahead of this?
Right. Countries cannot negotiate away their VAT. That's the entirety of the tax base in most of these countries. That would be like if somebody asked the U.S. to repeal the income tax as concessions in a trade negotiation, which clearly is not going to happen. I think the economic argument about VATs is very weak. They really are neutral to country of import. You're talking about, a German-made and a U.S.-made car. They're both taxed at the VAT rate in Germany. Neither is taxed at the VAT rate in the U.S. So there's no discrimination taking place. But the administration has been arguing that, this looks like an export subsidy because they're rebated at the border.
Tobin, we heard from the president and from Scott Bessent, the Treasury Secretary, both really talking about the big day being April 2nd. Do you expect any announcements, though, like the 200% on champagne and cheese and wine from Europe to happen before April 2nd?
In terms of further retaliation from trading partners, possibly. I think other countries are still digesting a lot of what's already been done. For the most part, I think countries have made their decisions about how and whether to retaliate. There are, I think, some countries where there is further retaliation that's in store, but they seem to be trying to maintain a little bit of strategic maneuvering room. China in particular has hit back a little bit, but not that hard based on the sort of severity of the 20% with which we've already hit them. And I think other trading partners of ours are also making their own calculations. So we'll see, again, exactly how severe they go on April 2nd. I fully expect there will be more retaliation at that time.
Heading into 2025, people were expecting the tariffs. They also were expecting, though, a wave of deregulation as well as tax cuts. That we have seen some deregulation, but tax cuts haven't really been the main discussion for a while. Do you foresee a time later this year where we'll be talking once again about fiscal expansion in the United States and not just some of the cuts?
So Congress has been working hard on the tax cuts. That process is proceeding. I think it's proceeding as quickly as anyone could realistically have hoped. We never thought that was going to get done before summer, and that's still what we're looking at. But that bill is going to be, there will be some nice goodies in there for the corporate sector. We'll probably get 100% bonus depreciation. We'll probably get R&D expensing. Those will pull a little bit of CapEx forward, to the extent that it's not being stepped on by uncertainty. But that's not going to be a massively stimulative bill, and we never thought that it would be. I think it will be a little bit expansionary in the early years, turn contractionary on paper a few years down the road. But, most of the cost is extending current policy. There are going to be some real offsets in there, in my view. And we don't have another 14 points to cut the corporate rate like we did in 2017. But I think it was never going to be the same, level of favorable tax cuts that we saw during his first term.
They're moving really quickly, Tobin, and they're moving quickly on the foreign policy front as well. Just getting confirmation from the Russian side, something we had indicated by the President of the United States in the last 24 hours, that there will be a call between the Russian and US leader on the phone scheduled for Tuesday. That confirmed by the Kremlin just moments ago. Tobin, what are you looking for tomorrow? What's the outcome you'd expect from that call?
Yeah, I think that the Russian side seems like they want to make a show of being a good negotiating partner, but it's not yet completely clear to me that they're willing to kind of foreclose on their ambitions to keep making progress in the near term. They've believed for quite a while now that they're on the front foot. And so I think it's always been clear that one of the major obstacles to the sort of near-term negotiations Trump is trying to mediate will be, can you get the Russians to settle for the current status quo for now, or are they going to keep making these demands like, Ukraine ceding the remainder of these 4 disputed territories and so forth before even getting into the early ceasefire phase?
Tobin Marcus of Wolf Research. Tobin, appreciate it. A highly anticipated phone call taking place between the President of the United States and the Russian leader set for tomorrow.
And it comes after his special advisor, Steve Witkoff, sat down in Moscow with President Putin. And over the weekend on the Sunday show, Steve Witkoff said he doesn't want to put words in President Putin's mouth, but he thinks that Putin agrees with Trump's philosophy, basically, on how to end this war.
What's the goal in terms of the timeline, though? And I think that's what a lot of people are wondering, is to cease the fighting in the near term and then hash out the details. Putin has talked about not wanting to do that so quickly. So this is sort of going to be an interesting moment.
We'll have more on that story in just a moment. And this one. Up next on the programme, Stephen Trent of Citi on his outlook for the struggling airline industry following that big downgrade to its forecast coming from Delta just last week. From New York City this morning, good morning to you all. You're watching Bloomberg TV. So here's the tone of the stock market right now, just a little bit softer. We're negative by 0.33% on the S&P 500. Similar move on the Nasdaq 100. Don't forget the Friday, the biggest one-day gain on the S&P going back to November. So the best day of gains so far this year, but not enough to erase that weekly loss. 4 consecutive weeks of losses on the S&P 500. The longest weekly losing streak going all the way back to August of last year. If you set up the bond market, the 2-year, 10-year, 30-year, when you see moves like last week in the equity market, you'd expect a bid in fixed income. You did not get it. Yields were higher on a 10-year by a single basis point. Lisa, the 10-year this morning down 428.
To me, this was the most notable aspect of last week. You could argue it's stagflationary light getting baked into the market expectations. You could also make an argument that this is Germany boosting yields globally because they are going to be borrowing so much money as they intend to have a fiscal injection both into infrastructure as well as defense spending. Nonetheless, there is an ongoing belief that bonds will not be the same kind of buffer at a time where the Fed is somewhat hamstrung from the fact that inflation expectations aren't coming down as quickly.
That's been the story of March so far, with the S&P 500 down around 5% on the month and bond yields on a 10-year up by close to double digits, even with that decline in equities. Lisa mentioned Germany, so let's finish on foreign exchange and take a sneak peek at the euro this morning. Euro dollar and a new forecast over at SocGen. Kitjugs looking for 113 in 4Q. Only 2 months ago, we were looking for parity at a lot of houses across Europe. Euro dollar this morning, 109.09.
And a lot of people making the argument that the gains that we've seen so far in the euro versus the dollar have been on the potential fiscal spending, not on potential weakness in the United States. When that starts getting factored in, suddenly that delta gets even bigger.
Key vote for spending in Germany. That vote starts tomorrow, so look out for that. We'll have coverage for you. On our radar this morning, President Donald Trump saying reciprocal and sector-specific tariffs are coming on April 2nd. Trump telling reporters that in certain cases, both types of levies will apply to imported goods.
April 2nd's the big one. They've been talking about this. I thought Tyler in Washington brought up a really good point. Something Scott Besson said over the weekend is it's not just April 2nd. Also look at June 30th. Basically putting the time frame on what will likely be a negotiation. Besson said either tariff barriers come down and the U.S. can export more, or they don't come down and then the U.S. is able to use those revenues. They're trying to at least project that this is going to be a win-win scenario, even though we are seeing it hit sentiment and consumers and, of course, the market.
The most important thing to see on April 2nd, does it give some certainty to consumers and to corporations? Does it give a sense of what the architecture of this tariff deal is? I see out of the corner of my eye you shaking your head. I think a lot of people are saying that uncertainty isn't going to go away, and the uncertainty tax people are trying to grapple with, as well as the framework that we may get.
I just find it hard to have this certainty on April 2nd if already Scott Besson is saying also look at June 30th. It already tells you that this is Trump in full-on negotiating mode, which he has been since he entered office.
And as you've said repeatedly, this is a feature and could be a feature of the rest of his second term. Let's talk about the foreign policy effort. The president saying he'll speak with Russian President Vladimir Putin tomorrow to discuss ending the fighting in Ukraine. Trump telling reporters there is a, quote, a very good chance for a deal. And much of the discussion will be about territory.
So they're discussing already what kind of territory, land. Trump keeps talking about power plants. I imagine they're talking about Zaporizhia, which is the biggest nuclear power plant in Europe. Russians have been holding it since the middle of 2022. One thing that is interesting following this meeting is I want to see signals of when these two individuals could meet, because I had reporting months ago, at this point now, that they were aiming for an end of February meeting. Well, we are now in March. Steve Witkoff has made already 2 meetings there. When are these two leaders potentially going to sit down?
In the meantime, Russian assets are rallying. And guess what? The OECD came out this morning, and improved Russia's 2025 GDP growth forecast to 1.3% from 1.1%. Key question is, how does President Trump and the administration go about doing this while having a deal that is unfair equally, where people are equally unhappy with the outcome at a time where it seems like there's a bit more leverage, at least on the Russian side?
We'll speak to the OECD in about 60 minutes' time, so don't miss that conversation. Wanted to get the latest data out of China because the data was pretty decent. Chinese consumption, investment and industrial production coming in higher than expected to start the year as the country braces for more tariff pain. Retail sales increasing 4% in the January-February period from a year earlier. That's the most since October.
And it should give people a boost of optimism. But you heap on top of that some of the rhetoric from Chinese authorities about their growth plan. And they're saying all of the sweet nothings that everyone has been waiting for so long, which is we want to boost consumer spending. We want to revive people's incomes so that they can go out and actually fund this economy. And that's giving people a lot of excitement, which is a reason why you're seeing a pretty positive response in equities.
Then you get into the policies, and the policies less impressive.
Yeah, they don't really do anything.
Right? Nothing at all.
But it sounds great.
Also, the property market remains under immense pressure and unemployment is rising. So even though there are maybe some exciting things going on in China, when it comes to what is happening, when it comes to property and unemployment, it's still not a great game.
That's the latest over in China. Let's bring it back to the United States and turn to the U.S. consumer. Retail sales due at 8:30 Eastern Time. The report coming after a disappointing UMich consumer sentiment survey dropped going into the weekend. Airlines leading the way as corporates start to lower guidance. Delta, American and Southwest slashing their outlooks, citing weaker than expected demand. Stephen Trent of Citi still optimistic on the sector, writing the main risk seems to be top down. When and how do we get clarity on the government's plans on tariffs, trade and foreign relations? Stephen joins us now for more. Stephen, good morning. Good to see you.
Same. Thank you for having me.
I think we've got to start with the downgrades to the outlook for the first quarter that came from some of the airlines, and it was kicked off by Delta just last week. Ed Bastian used the T word. The T word's a scary word on this programme. Transitory. Transitory. Just how transitory might this be?
Great question, and I think it's too early to say. So you did have a lot of noise in 1Q. Certainly, as you guys said, the airlines really dislike this uncertainty. So when are we going to get clarity on tariffs, on Dodge cuts, and what does all of this mean for demand? I think that's too early to say. During this quarter, at least so far as well, you did unfortunately have several high-profile aviation accidents. All but one of them were fatal. That is also something that you can't ignore in these short-term moves. But I think overall, what confidence do we have 6 months from now? I think it's way too early to tell. And the underlying fundamentals still look positive.
So let's gut check ourselves, because before we get carried away with too much negativity, not that I would ever be accused of that, I am wondering if it really was all that bad, what some of these airline executives were projecting.
Yeah, so look, I think if you look to your point, nobody so far has changed their full year guide. I think they're also in a wait and see mode to some extent where things go. Are we going to wake up a month from now and we'll have a little bit more clarity after this April 2nd bogey that Mr. Bessemer mentioned? Are we going to wake up and have some wild headline about Greenland and nobody wants to travel? I think it's too early to say, and it's a little too hard to put math on that today. But the underlying fundamentals still look positive. And I think the airlines telegraphed that by not making any cut to the full year guides.
There was a real question about how much of this was driven by consumer discretionary spending, people who might be worried about losing their job, versus companies really pulling back, saying, hunker down, study, you have got nothing to tell any of the clients.
Yeah, look, I think those are all potentially legitimate drivers. I would add to that what's happened on the government level, which is not the largest piece of travel, but with DOGE kicking in, less government employment, I would imagine they're also being stricter about who's allowed to go on business trips from these various agencies. So I think all of that stuff is relevant.
They certainly are. I hear that anecdotally, but also we saw it with United. Who is most vulnerable to that, those government contracts, those government flights?
Yeah, certainly United had not a massive number, but American United kind of sort of talked about having a smallish percent of revenue associated with U.S. government travel. So I don't remember exactly off the top of my head, but very low single digits, I think, in the highest case.
So not enough to pull roots?
No. But you also have to consider some of these markets where the government serves. So Washington Reagan, of course, where we just had one of those awful accidents. The FAA had actually added a little bit of flights into that corridor recently. So you have a difference in terms of how much flow you get from some of these government employees and what kind of economics you get on them. So they were small numbers. But I think the question is, when the dust clears in all of this, how big are they going to be? We don't really know yet.
You also mentioned fuel prices in your note. A lot of banks are now cutting their forecast to Brent. How much is that going to be very helpful right now for the airlines? Yeah, so I think lower fuel prices are helpful, and fuel's sort of a funny thing. Fuel prices that are too high are bad news. Fuel prices that are too low, also bad news. The latter signals a recession, for example. But
where we are today with WTI in kind of the high 60s or thereabouts, it's at a level where it's not really doing any damage, or it's not dangerously cheap per se. And it did come down from levels where we're going to see lower unit revenue, at least short term. So it's actually good to have a little bit of tailwind from fuel today, but I guess if fuel and crude started to fall wildly, that wouldn't be the best signal in the world.
So I think a couple of things we're still talking about. One, did the weakness in February spill over to March? And within the weakness, is the premium segment, the international long haul, still holding up?
Yeah, so what we see so far, international long haul is still strong. You have a dearth of new equipment per capita in that space. On the wide body side, you really only have now with Alaska, you have 4 U.S. airlines that have any wide bodies, really. And loyalty and co-branded card, the same. Domestic's been the main place so far that's been a little bit soft. And, the indications so far is that should at least continue somewhat into March. But, too early to say what's going to happen on the month.
Let's finish on domestic. What happens when you start charging for bags? What happens?
Yeah, it depends who you are.
What if you're Southwest?
So I think on one level, if you're a carrier that's for decades been dealing with a passenger flow that is elastic in terms of demand, it's a give and take, no? So I think what you're going to pick up and check bags, you're also going to run some risk of sending some passenger flow away to somebody else. And that also makes you arguably less distinct against basic economy of one of the big three. You're now offering something similar to them, and they have a massive network versus you if you're Southwest.
Next, the question, why did they do it? What's the logic behind it?
So I think for the discount airlines, there has to be some kind of change, strategically speaking. I think these post-pandemic structural challenges, the way consumers purchase tickets and decide to travel, all of that's changed. We no longer have enough air traffic control capacity per capita to allow these discount carriers to just lay a bunch of capacity and maintain really high block hour utilization. They need to do something on the unit revenue side. So is this going to be the fix? I don't know.
Just quickly, top pick right now for the sector. What is it?
Of the U.S. airlines, United's my favorite one, and then American Airlines and Delta.
All three, then? All three of the big players?
We're fans of the network, guys. They have everything they need to win. We just need the consumer to have a little bit more calmer water.
We'll get another read on the US consumer at 8:30 Eastern Time. Stephen Trent, good to see you, as always. Stephen Trent there of Citi. US retail sales, the next stop for this market. That comes later on this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A severe storm system over the weekend spawned tornadoes, dust storms, and wildfires that killed at least 36 people. The storm is moving into the southeast and mid-Atlantic, bringing thunderstorms, hail, damaging winds, and the potential for more tornadoes. Forecasters are warning of dangerous winds from Florida to New Jersey. China consumption, investment, and industrial production exceeded estimates in both January and February. China's pro-growth pivot in September fed economic momentum, but the Trump administration's tariffs threatened to halt that growth. It wasn't all good news in the data. The property market stayed under pressure and unemployment rose. Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the app ahead of next month's deadline. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this morning. Up next on the program, the White House isn't blinking.
Corrections are healthy. They're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Up next on the program, we'll get the market view from Lotfi Karui of Goldman Sachs from New York City. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Equities off session lows this morning. We're lower but by only 0.2% on the S&P 500. In the bond market, yields a little bit lower as well, down by 2 basis points. The 10-year 428.70. Under surveillance this morning, the White House isn't blinking.
Corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, reiterating the administration's focus is not on the markets, leading some investors to revise their outlooks. Lotfi Karui of Goldman Sachs looking for wider credit spreads, writing, since the first tariff headlines broke, our message has been simple. Add hedges and brace for some rebuild and risk premia. Lotfi joins us now for more. Lotfi, good morning. It's good to see you.
Good morning. Good to see you.
I want to go back several months. I want to go back to the note you put out at the end of 24, going into 25, where you highlighted just how severe the valuation constraints were coming up into the new year. How much of a role do you think that's played in some of the shakeout we've seen so far?
A little bit. Obviously, when valuations are expensive, you don't have a lot of room to stomach these big shocks. But back then, actually, our message was that, yes, the market is expensive. Add hedges, add downside protection, and then wait for any signs that things are shifting, either fundamentally or from a technical standpoint. What we've learned the last 3 to 4 weeks is that things are actually shifting fundamentally. But the trade-off between growth and inflation is, in our view at least, heading into a direction that is unfriendly to risk assets. And so you have to realign yourself with that, and you have to push spreads a little wider.
Things are changing fundamentally when it comes to sentiment, when it comes maybe to demand that we're hearing from airlines, as we were just talking about. Has it really shifted, though, with the creditworthiness of these companies that have locked in borrowing costs for a long time and still seem to have healthier balance sheets than they have historically?
It depends where you look. If you're talking high-quality, IG-rated companies, probably not. I mean, if you implement tariffs, at the end of the day, it's probably worth a couple of points of declines in earnings. That will shift your credit metrics a little bit, but not too much. Where this will make a difference, in my view, is in the very low end of the high-yield market, where we ended the year with tight spreads in hopes that actually the economics of refinancing for some of these over-leveraged capital structures have gotten better. Now, I think what you'll see is spreads moving wider and that economics of refinancing getting a little bit more challenging again.
We just saw a week of the biggest widening in credit spreads going back to last summer's volatility. And I just wonder, is this a repricing of risk, to your point about valuation late last year? Or is this the start of something more significant where people shift maybe to places like, say, Europe and European credit over the United States?
This feels a little different to me relative to late July, early August, where we were actually pounding the table to buy the dip back then. This feels a little different because you need time to process what is effectively a meaningful dose of uncertainty that's been injected in the economy. The starting level for spreads is also very tight, and so it's not like you are being paid actually for this type of shocks. Europe has already outperformed, actually. Europe has had a phenomenal start to the year, both in credit and in equities. I guess I would describe European credit as basically being in the same situation as U.S. credit, 3 months ago, back to that valuation conundrums. So I think it's going to be very hard for Europe to continue to tighten in absolute terms. In relative terms, I think Europe will outperform the U.S.
There's this question at a time when the U.S. is potentially entering into a difficult patch of whether credit still has the canary in the coal mine aspect that it used to, whether it still kind of can forecast the sense of disruption in the fundamental economy that it had the reputation of doing 10, 20 years ago. Has that signaling mechanism been broken?
Yeah, I think that reputation comes entirely from the playbook of the global financial crisis. I don't think things will play out that way this time around. And so what we've seen now is literally credit moving in locksteps with its sort of empirical or beta relationship to the equity market. And so people complain all the time, well, actually credit has not moved. That's not true. We've actually repriced in terms of the change in spreads. If you look at the change in IG that would be implied by an 8.5–9% move in the S&P, it's exactly what you've gotten the last 4 weeks. And so it looks like credit is resilient only because the starting level is so tight. But if you look at the change in spreads, it's been commensurate, I would say, with the move in equities.
When John was talking about your note, you talked about the first headline from Donald Trump when it came to tariffs. Yeah. Why now? Trump has talked about this from the very beginning, and we knew this was one piece of his broader plan.
Why now? Great question. I think what we've learned is that the administration has greater tolerance for a move lower in the market and even a full slowdown in the economy. To me, that's been the most critical piece of information that we've learned. And then valuation has remained very tight. The two other things I would add is that, and this is a big difference between today and 2018. In 18, rates were very low. They're not today. Actually, you get paid 4%, 4.25%. To invest in cash. And so you have a very valuable degree of freedom. Duration has rallied too, from a peak of 4.75 roughly to 4.25, but can rally more if you have an even bigger slowdown. And so to me, the urgency to buy the dip today is just not there.
I think we all remember December 2018 when the credit market totally froze up. I think that month for high yield, we got zero issuance in December 2018. Is there anything like that happening right now? Anything that would concern the Federal Reserve going into this two-day meeting starting tomorrow?
I think they'll most likely be in wait and see or on the sidelines. We'll learn, in terms of what they do with their own projections, how much they'll push inflation up and then how much they'll push growth down. But at the moment, like us, my guess is that they're processing this flow of information and trying to assess what they will do. Now, the market is pricing in, I think, 2 cuts for this year. That seems quite reasonable to me. You're pricing in 2 cuts not because you think we're going to make progress on inflation, but you're pricing in 2 cuts because you think the Fed will probably adopt some kind of an insurance cuts type of framework, exactly like they did actually in 2018.
Is the primary market still open for deals? We saw some headlines in the last week or so.
Risk aversion has gone up, and so the market is open 100%, but new issue concessions have gone up, and so, issuers have to pay a little bit more relative to the secondary to access the primary market. That's actually in and of itself, it's a healthy thing, because if you reduce supply, you kind of rebalance the market a little bit and you bring stability to the secondary market.
What are you waiting to understand the depth of what kind of correction we could see, or whether this is going to become something that you can opportunistically go into?
So at the single name level, I would say you're already seeing some opportunities. I mean, certainly the primary market is one way to deploy capital and harvest a little bit of alpha. But what could change my view, look, 2 things. One, you get a valuation reset. So actually you front load a lot of damage, you price it in, you make spreads interesting, then you revisit the conversation. The second thing, I think we need to remember that in the administration's policy agenda, there's a lot of things that are pro-growth. And so if you recalibrate actually that policy mix away from some of the stuff that is actually negative to growth into some of the things that are positive for growth, tax cuts is a good example, deregulation, et cetera, then I think you have a different conversation and you would look at this market a bit differently.
I sense that's still the strategic anchor of a lot of the bulls out there, that the overall policy mix is still pro-risk, pro-growth, and in 6-9 months' time, things might look a little bit different. That's the hope anyway.
The first half of the year is Biden data, and then when Trump data comes into play...
You were told that,
yeah. Then there's going to be a policy mix that's more supportive to things going better.
Lotfi, it's good to see you. Thanks for breaking this down. Sharp as always. A clinic on credit from Lotfi Karui there of Goldman Sachs. Equity futures right now in the S&P are raising losses, down by just 0.2%. Up next on the programme, Bob Elliott of Unlimited, Henrietta Trays of Veda Partners, the OECD Secretary General Matthias Cormann, and Sam Zeef of JP Morgan. From New York City, the second hour of Bloomberg Surveillance. Up next.
We don't know what the pass-through of expected and actual tariffs will be.
The tariff policy on again, off again. is impacting the sentiment of consumers.
Tariffs, of course, also in particular impacts anyone who's associated with trade with Canada and Mexico.
Tariffs are going to raise prices, and middle and lower income consumers have to bear more of the weight.
It's going to be very tough to pass this to consumers because the consumer is highly elastic in terms of looking for alternatives.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Your next stop for this market, 90 minutes away, 8:30 Eastern Time. U.S. retail sales, another read on the U.S. consumer. Then later this week, a Federal Reserve decision with Chairman Powell, a news conference and forecast. Going into all of that, equity futures erasing this morning's losses, still negative by about 0.2% on the S&P 500. Following 4 weeks of losses, the equity bulls need some better data.
And they need some better data from the companies themselves, who last week indicated that demand has rapidly fallen off a cliff. It raises a question: where is the market most asymmetrically positioned heading into retail sales? For a quickly deteriorating economy where people are stopping spending, or where people are potentially, really hanging in there a little bit better than people expected?
The soft data is soft. The guidance coming from the likes of the airlines, not great. We'll see if we get this at 8:30 Eastern Time. Will that confirm some of the gloom that we've seen in various places across various dimensions over the past few weeks?
Stephen Trent said that some of that weakness has carried into March. We've heard those ongoing warnings for a number of companies. That said, can we say it's still too early? Or are we going to start to see it bleeding into the hard data? Torsten Slok of Apollo last week came on and over the weekend put out a note where he said, expect it to start bleeding into the hard data. At that point, how much more of a downside does this market need to price in?
I know that you, Mitch, is tainted by political views.
It triggers
And we know
people.
there's some problems with that survey, and we know it triggers a lot of people. But the headlines coming from Friday, that was a very ugly read. The weakest read we've seen going back to November 2022. Inflation expectations, long-term inflation expectations, pretty ugly. And then you've got this anxiety around unemployment, which is something that Neil Dutter of Renmac would talk about a little bit later. Anxiety around unemployment started to climb.
Anxiety around unemployment, anxiety around what is going on in terms of policy. This was coming out in the statement. And when it comes to the politics, Jonathan, regarding it, what you heard from the University of Michigan is that consumers from all three political affiliations are in agreement that the outlook has weakened since February. Long-term inflation expectations, 32-year high. This is challenging right now, especially ahead of retail sales.
This does trigger people. I mean, I just want to put that out there. I put out a note about the Inmish survey on X, and I got a lot of hate mail saying, super liberal survey, because people say it breaks down between partisan parties. But what you did see when you dug under the hood was that deterioration was widespread. And it crossed party lines, albeit from a very low base among Republicans. But independents also saw that deterioration and increased their expectations for inflation. All this said, it's going to be difficult for the Fed to justify cutting rates proactively if long-term inflation expectations are creeping up.
There is a political bias in you, Mitch. With that, I don't think we can disagree. That's just the reality of the survey. But I don't think there's a political bias over at Dick's Sporting Goods or American Airlines or Delta, for that matter, over the last few weeks. When they tell you the business is slowing down, I don't think they say that because they like Joe Biden or don't like Donald Trump. I think that's because the business is slowing down.
The real question going forward, Neil Dutter actually addresses this really well, is how much is this slowdown going to bring down prices or continue the disinflation? Or do we see that stagflationary-like price action that we're seeing right now in markets? Do these companies pass it along to consumers? They spend less but pay higher prices, and that keeps inflation pretty sticky.
Equity futures right now erasing this morning's losses very slowly and then quickly all at once. We're down by just 0.1% now on the S&P 500. Coming up this hour, we'll catch up with Bob Elliott of Unlimited, with markets looking to recover following another week of losses. Henrietta Trey's of Veda Partners as President Trump reiterates more tariffs are coming, and the OECD Secretary General, Matthias Cormann, as the organization cuts its global growth forecast. We begin this hour with stocks pushing lower, as Treasury Secretary Scott Bessent says that recent corrections are, quote, healthy. Bob Elliott of Unlimited staying cautious, writing, it's important to note the S&P is back to about where it was in October. A recession is not being priced in. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
How would you describe this repricing that we've seen over the past month?
Well, I think what we've done is we've wiped away some of the post-election euphoria that this was going to be, the most pro-business administration in the post-war era, and we were going to have an economic boom. People are tamping that down and basically so far saying, okay, disinflationary boom probably not going to happen, but they're still pricing in pretty good growth conditions in the face of what is a mix of policies that's very growth negative over the course of the next 6 to 12 months.
Mike Wilson of Morgan Stanley publishing coming into the new week saying this is not just about tariffs, it's about other issues. Do you agree with that?
Well, I think it's about the complexity of the whole mix of policies that are here. In many ways, we're seeing sort of a wrecking ball of policies with weaker immigration, tariff policies, cuts and significant pay-fors that are probably going to have to happen in order to get the TCJA passed. And that combination of things is all quite growth negative. And then on top of it, you're seeing a Fed which is, pretty handcuffed here to respond to any growth weakness that they're seeing. And so that combination of things with an administration that, at least so far, doesn't look responsive to equity market weakness is a pretty bad combination for growth prospects and equity markets ahead.
This is a pretty bearish view. How bearish are you? How much more downside do you see?
Well, if you just look at how much, stocks have outperformed bonds on a risk match basis over the last 3 or 4 years, the U.S. exceptionalism trade, we've corrected 5 to 10% on something that is outperformed by several 100% over the course of 5 years. If investors start to question whether U.S. exceptionalism is the path ahead, there can be considerable repricing that we see in the market.
And something that you pointed out is you see bonds actually outperforming stocks this year, which was a sort of a reversal of what we've seen for the past few years. And yet you do see the Fed constrained. So this isn't necessarily that bonds are performing so well, but rather that stocks are performing so poorly, no?
Well, I think last time I was here, Secretary Bessent was in just ahead of me, and he said he was looking for bonds going down, bond yields going down, every week. And since then, he's gotten stocks going down 4 weeks in a row and kicking off the week going down further. So he might be getting his bond rally, but as I said then, it's for bad reasons, not good reasons.
When was the last time that you saw a mix like this?
This is a very challenging policy mix. This significant growth negative set of policies. I mean, really the last time that we saw such growth negative policies relative to conditions was coming out of the financial crisis where, we had the Tea Party efforts to constrain fiscal spending at a time when, we needed significant stimulation. Now, of course, the economy is stronger today than it was back then. But that push, that sort of exogenous push for growth negative policies is similar to that period. And that was a challenging time for Wall Street and also Main Street.
We've heard this a lot from various investors, but their assessment seems to be the following, that the policy mix becomes more positive as the year grows older. Do you disagree with that?
Well, if anything, it's going to take some time to get these policies in place. I mean, particularly the negotiations over appropriations for the next fiscal year, which will happen over the course of the next 6 months, will give us a view into whether there is going to be meaningful cutbacks in terms of government spending and any efforts to really balance or get close towards balancing the budget. I think the thing that's interesting is that budget policy that was passed suggests, several $100 billion a year worth of pay-fors for the TCJA extension. You put that into the budget combined with, some DOGE cuts and things like that. That is definitely likely to cut the overall spending picture in, the next fiscal year.
But Bob, they're talking about maybe getting reconciliation done by Memorial Day. I mean, that's 2 months.
Yeah, and if that's true, then what's going to happen is you're going to start to see that get priced into the market. I think in part what we've seen in the last couple of weeks is not only are we seeing significant policy uncertainty, and that is causing basically anyone with any sort of risk or levered position to cut back on their positioning, but that tilt that we're seeing is increasingly seeing expectations that the new administration is very committed to this set of negative growth policies, and that'll start to get priced in not when the spending happens, but when we actually start to see those policies enacted.
Is the extension of TCJA not enough?
It doesn't do anything. That's the big thing. While the political rhetoric will call this tax cuts, from an economic perspective, it makes no difference. And the reason why that is it's current law. And given that it's current law, simply extending current law avoids what would have otherwise been a big tax hike, which would have been growth negative, but it is not a growth positive on its own.
Would we still have this volatility in the market if Kamala Harris had won? We were sitting here debating whether or not tax hikes would be going up at the end of the year.
I have no idea what we would be if Kamala Harris was in office. But what I do know is the concern, the volatility in terms of a policy perspective is really about the totality of all the policies. And really, I think in the last couple of weeks about the tariff policies. I mean, what is tariff policy over the course of the next, 3 to 6 months. Is it 25% tariffs on our biggest trading partners, or is it zero? Because it's been both over the course of the last 30 days. And if you're managing money or running a business, the only thing you can do in that sort of circumstance is pull back, cut back. And that's why we're seeing a broad-based cutback in confidence, not just in the Michigan surveys, but we're also seeing it in CEO confidence, which is now at the weakest level it's been in more than a decade. And given that, it's going to be very hard to get those sort of animal spirits that are hoped for to really continue this economy right now.
Step up Chairman Powell. If things are as bad as you say they are, why isn't he prepared to step in sometime soon?
Well, he is really handcuffed by the inflation picture. I mean, while the headline numbers for PPI and CPI came in below expectations, the PCE expectations continue to be elevated. They're too hot for him to continue to cut. And let's be honest, I don't think he necessarily cares too much if he can hang weaker economic conditions on the new administration.
Just jump in. How unusual is it to see inflation expectations climb against the backdrop of lower energy prices? How unusual is that?
Well, it's pretty unusual, but it's also pretty unusual to shift tariff policy up from essentially, close to zero, multi-decade lows, all the way up to the highest level since Smoot-Hawley, right? So that is getting priced in. People are digesting that, and that has a meaningful influence on what you're seeing in those expectations.
So are you one of those people going to the Bank of England and loading up a suitcase with gold bars, sticking it on the airplane and going home and hiding?
Well, I certainly couldn't carry a whole suitcase worth of gold bars.
All right, well, what are you doing?
But paper gold looks good in this sort of scenario, and it's a little lighter to trade. Looking at assets that are going to do well in a lower growth environment, particularly relative to stocks, things like bonds and gold relative to stocks, and weaker dollar in the circumstances. The U.S., we haven't really talked about the global picture, but the U.S. is tightening and engaged in growth slowing behavior just at a time when globally we're seeing out of Europe and out of China a real push to reaccelerate those economies. And that will really call into question whether or not the U.S. exceptionalism trade, should continue. And there's a lot of capital that hasn't repriced that trade.
Can you imagine the excess baggage fees, Southwest, trying to move gold around the country?
Well, can you imagine? I mean, the workers' comp for people's backs having to lift that stuff.
Have you ever held a gold bar?
I haven't.
Ridiculously heavy. Just ridiculously
Can you imagine?
heavy.
I mean, we heard about this. It affected GDP expectations for the first quarter.
Absolutely wild. Bob, it's good to see you. Appreciate the catch-up. Thank you, sir. Bob Elliott there of Unlimited. Equity futures just about negative on the S&P 500 with an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. At least 36 people have died across 6 states since a massive storm system moved across the U.S. starting last week. And another round of storms swept into the eastern U.S. yesterday. The National Weather Service says that severe thunderstorms will bring damaging wind and a few tornadoes this afternoon and evening. Elsewhere, U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also warning to Iran, which backs the Houthis. CEOs of some of the world's largest companies will be heading to Beijing next week, with some planning to meet President Xi Jinping. Sources tell Bloomberg that plans are being made for the heads of Qualcomm and Saudi Aramco to meet with the Chinese president. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away, because they had no clue what they were doing.
Henrietta Trays knows what she's doing. She joins us next from Vader Partners from New York City this morning. Good morning. Equities just a little bit softer here, down by 0.1% on the S&P. Bond yields a little bit lower, down by 2 basis points, 429. So far, not much drama. In the FX market, 109.07, positive by 0.2%. A new call from Kit Jukes over at SocGen, looking for 113 on euro dollar. That currency pair has moved very, very quickly to start the year. That currency pair this morning positive by 0.25%. Under surveillance this morning, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump pressing ahead with his tariff agenda, confirming reciprocal and sector-specific tariffs will begin in just over 2 weeks' time. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, just how misleading is that April 2nd date? How much longer could this all take?
Well, John, it could take months potentially after that. We heard from Treasury Secretary Scott Bessent over the weekend telling us that we should really be looking at a range from April 2nd to, he said, in his words, say June 30th, the end of the second quarter, for those tariff negotiations to go up and down. And it really, after these comments from President Trump over the weekend that he is going to pursue this more aggressive tariff approach, potentially stacking those reciprocal tariffs on top of sector-specific tariffs, we'll have to see how that impacts negotiations with our trading partners, as many opted for talks instead of large-scale retaliation. Importantly, President Trump also there, as you heard him, he alluded to the fact that we are already starting to see tariff revenue come in from the tariffs that have been implemented. Now, we don't have specific numbers, but I do bring it up because we often talk about tariffs as a revenue raiser going hand in hand with implementing President Trump's tax cut agenda. Senior administration officials keep pointing us to the fact that when there is tariff uncertainty, this is all about a longer-term growth agenda. John, Bloomberg News reporting that some in President Trump's orbit are pushing for that tax cut agenda to get done by May. Our read on it is that that is highly unlikely. It does go to show how officials are trying to get more money into consumers' pockets, as these indicators that we often watch, like consumer sentiment, the 5 to 10 year inflation expectations, do sour. And while we talk a lot, John, about this potentially higher tolerance that we're seeing from this administration when it comes to market volatility, we're going to start to see a lot of opinion polls come out rating this first few months of the Trump administration. We'll have to see if that serves as any counter to this administration's policies.
Tyler, when it comes to the tariffs, do you get a clear sense if they're a negotiating tactic right now by the administration, or they truly are going to be revenue raisers for their tax agenda?
Well, Anne-Marie, this administration is trying to push that it could be a win-win here either way. And they've often pushed that tariffs accomplish a multitude of goals. For example, if we go back to the original tariffs against Canada and Mexico, that was for the border policies. Then steel and aluminum last week is trying to accomplish the national security items, which we're also going to see that rhetoric come back up again with those sector-specific tariffs, particularly when it comes to chips and autos on April 2nd. But this administration really pushing that at least the first step is to rebalance trade, try to get back to an even playing field, and then they will take it from there, particularly when it comes, if they don't lower those tariff barriers, then the positive could be that they will have this revenue raiser, which is going to be important to that long-term fiscal agenda that we keep hearing about.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Tyler mentioned briefly opinion polling. We had some over the weekend. And the standout wasn't about the president. The standout wasn't about the economy. The standout was just how poorly the Democratic Party are polling in this country right now.
I think it's one of the worst polls they've had ever when it goes back to NBC polling. They can just not get it together. And the infighting was on display last week. And this poll was done even before that infighting started. And Chuck Schumer said, OK, we're going to allow the Republicans to pass through this continuing resolution to keep the budget open, which you've seen a tremendous amount of the government open, tremendous amount of pushback, especially from House Democrats.
27% of registered voters view the party positively in an NBC News poll. Unreal. Joining us now to build on some of these conversations, Henrietta Treyz of Veda Partners. Henrietta, welcome to the programme. Overall, I would say on net, the people that come on this programme don't like tariffs. There is some pushback sometimes, but on the whole, they don't like them. The market participants, they do like tax cuts. Now, we're trying to understand whether we'll get those corresponding tax cuts anytime soon.
Well, if you listen to the White House, they're trying to bill the one thing that is happening here, tariffs, as tax cuts. You know, when Peter Navarro and other economic advisors in the White House come out and say that tariffs are tax cuts, that's obviously, either you're lying to yourself or you're lying to me, but it's not correct. And that's the problem that we run into, because the same is true on the tax cut side. As your previous guest was discussing, The bill that they're trying to pass, by Memorial Day, whenever it passes, I don't care. They're extending the status quo. So there are no tax cuts even built into the $4.6 trillion tax bill that they need to pass this year. So there are tariffs and there are not tax cuts. And when you sell tariffs as tax cuts, you create a pretty material disconnect between the consumer, who's confused now about what they should be expecting, which is why you see pullback at the big box retailers and people delaying big purchases, which is what's leading to that soft data that's so problematic right now.
Henrietta, what happened to the carrot and stick approach when it came to tariffs and corporate tax rates? I thought if you produced in the United States, potentially you could get a 15% corporate tax rate. Where did that conversation go on Capitol Hill?
That conversation is nowhere right now on Capitol Hill. Each percentage point reduction in the corporate tax rate costs $150 billion. So as I mentioned, we're already at $4.6 trillion just for the status quo. We got to fix the SALT cap, even just to raise it up to $20K for couples filing jointly. We have to extend the child tax credit. The president wants to do things like eliminate taxes on tips, which is itself $175 billion. We do not have the money for a 15% corporate tax rate. And even if you did, I'd like to relay that the Republican conference and members up there do not support additional tax cuts for the business community. They view the 2017 tax bill downfall. The one piece that was really unpopular is that the corporate rate cuts were permanent, and all the individuals in the United States are now subject to a tax increase at the end of this year because of the 2017 bill. So there's not a lot of appetite for tax cuts at the corporate level.
So, Henrietta, what kind of extras can we get? Do we get no tax on tips, no tax on Social Security? What could Trump put on this to make it more than just an extension of TCJA?
That's a great question. The no taxes on Social Security is physically not possible. They're not permitted to address Social Security in any capacity using reconciliation instructions. So that's entirely off the table. And just so we're clear, the cost of doing that would be $1.8 trillion. So if it was not physically impossible, it's definitely monetarily impossible. The no taxes on tips piece doesn't have a tremendous amount of support because there's not been enough education or discussion of how to rein that in so that you don't avoid, a CEO saying, the $1 million that I made last year is actually just a tip and evading taxes. So they don't have the logistics worked out for that. And then in addition, that's not a universal tax cut for all individuals. It's only a tax cut if you get tips, which not everybody does. So it's disproportionately impactful to different states. That was a big sell in Nevada, but Nevada does not have Republican senators. So it's going to be really difficult to get that over the finish line. There's not a lot in there that can be described even charitably as stimulative. There are a couple of business-related provisions that expired in 2022 that we could provide a short-term extension of, but that's really it.
Henrietta Schrays there, of Veda Partners. Henrietta, thank you for the update. Appreciate it. We've had a lot of downgrades to growth off the back of some of the policy volatility of the last few weeks, including downgrades from JP Morgan, from Goldman, from Morgan Stanley. In just a moment, we'll talk about the OECD doing exactly the same thing, dropping their growth forecast and raising their inflation outlook.
Yeah, exactly the mix that people don't want to see, and talking about the Federal Reserve not really having the ammunition to cut into potential weakness.
Coming up on the programme, we'll catch up with the OECD Secretary General, Matthias Cormann, on global growth risks. Looking forward to that conversation. Check out the equity market as we go to a commercial break. Equity futures just about negative by 0.1% on the S&P 500. In the bond market, bond yields just a touch lower, down by 2 basis points at 4.29. The next stop for this market, US retail sales in about an hour from now. The last major data point, the last read really on the US consumer going into the Federal Reserve's two-day meeting, which kicks off tomorrow and concludes on Wednesday. Chairman Powell set to deliver a rate decision. No change to interest rates expected, but plenty of changes to the forecast in store. So look out for the news conference 30 minutes after that decision. From New York City this morning, good morning. I mentioned briefly moments ago the downgrades to economic growth we've seen from JP Morgan, Morgan Stanley and the like. We've also seen downgrades to the equity market view as well from HSBC and Citi, and more recently from Goldman Sachs and David Costin dropping their price targets on the S&P 500. Lori Calvasina follows today from RBC, cutting the price target on the S&P for year end from 6,600 down to 62. With that in mind, equity futures right now are raising some of those losses. We're negative by 0.2% on the S&P. On the Nasdaq 100, we're softer by not even 0.1%. Let's get you some morning calls, some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with NVIDIA. Those shares are up 1.3% as we await the company's giant AI conference, which kicks off today. But the big event will be tomorrow with Jensen Huang's speech, where he's expected to unveil more details about future versions of its AI chips. But as we know, a lot is riding on this moment because this year has not been kind to NVIDIA. It has also not been kind to our next stock, which is Tesla. Those shares now are lower by 0.8% and leading the broader tech sector lower. And this I found interesting. A Danish pension fund with $20 billion AUM says it's selling its remaining 200 Tesla shares and blacklisting the company, meaning it won't buy any more shares due to what it says are growing risks posed by its founder and CEO, Elon Musk.
Yahara, thank you. That stock a little bit softer in the pre-market, down by about 0.9%. On our radar this morning, Treasury Secretary Scott Bessent saying recent market turmoil isn't rattling the White House.
Corrections are healthy. They're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
The White House, the Treasury, they're not blinking. And going into Wednesday, a question we've all got, well, Chairman Powell.
Yeah, at the same time that we're seeing inflation expectations creep higher in a number of different surveys, you can say what you will about the University of Michigan. This is going to constrain their ability to really say we can proactively cut rates. And that's what we see in market pricing in. If that's the case, if no one's blinking, where's the relief valve for a market that's facing off with slower growth, policy uncertainty, and a Fed with a sticky Fed policy rate?
The problem right now this administration has is right now the markets, the consumers are dealing with only one part of their entire agenda, and that's tariffs. You heard from the Treasury Secretary there talking about when you look at it overall and long term, we're talking about tariffs plus deregulation plus tax cuts. Well, right now, we only have one pillar of that agenda, and that is what's making this so complicated for them.
We're talking about foreign policy, too, so let's turn to our next story. The Defense Secretary, Pete Hegseth, saying U.S. strikes on Houthi militants will be, quote, unrelenting until the Yemen-backed group stops attacking vessels in the Red Sea. President Trump on Saturday ordering the first round of attacks on Houthi targets.
So Pete Hegseth, the Defense Secretary over the weekend, really made clear two things. Freedom of navigation, which we have seen basically American troops, men and women, protecting Chinese and Russian vessels, the only ones willing to go through the Red Sea. They want that to end, and also they want to restore deterrence. Your age group put out a note, made a very good point. We have seen attacks even under the Biden administration when it comes to the Houthis, but not at this scale. And I spoke to a number of officials over the weekend. What I'm hearing is this is likely going to be definitely days and potentially weeks, and what this administration is willing to do to set deterrence and really go after the Houthis.
I wonder how much this actually ties into the economic story. They've cited inflationary impulses from some of the shipping delays that we've seen, and we have seen that. How much is this part of that? If you open up that corridor and create the freedom of the seas, once again, that reduces some of the pressures, at least on the margins.
They were very critical of the previous administration for totally failing to provide and establish a deterrence in that part of the world. It was kind of shocking. Week on week, month on month, we saw these developments and hardly anything was done.
And maybe now commercial ships, which are going around the Horn of Africa, will actually start, to Lisa's point, use the Red Sea. Also, this is sending a clear message to Tehran and what this administration is willing to accept in terms of Tehran's support for proxy groups like the Houthis.
They have been very clear about that. Just wanted to squeeze this in from the ECB. The ECB Vice President, Luis de Guindos, saying President Trump's policies are causing more economic uncertainty than COVID did. The Vice President joining several policymakers highlighting worry about a brewing trade war. Now, sometimes we're too dramatic. I don't know what happens in our personal lives, but that is very, very dramatic to say something like that.
At the same time, we just heard that from Bob Elliott, that frankly, he hasn't seen this level of uncertainty or at least a negative growth mix going back years. It raises a question about whether there is a sort of well-oiled plan that's getting executed or whether people outside the U.S. are correct in feeling like it's 200% tariffs one day, 200% tariffs another day that are withdrawn. I mean, it's very difficult to keep track of all the tariffs, let alone
see what the overarching plan is, especially if you are on the receiving end of some of these tariffs.
I don't think you can compare this to the pandemic. Being locked in your apartment, needing a passport to go and get a cup of coffee to prove you were vaccinated.
I think that it's a different kind of uncertainty. I mean, there was sort of an existential
forced to
uncertainty.
hang out in certain bubbles with certain people. I don't know. And also the tariff plan, we don't even have
people,
yet.
what was wrong with your bubble?
True. Jonathan was in my bubble when he was in London. No offense to Jonathan, but you weren't really allowed to expand outside, the people you saw every single day. On top of that, we don't even have Trump's tariff policy. How are you throwing all these daggers at it when actually we don't have the policy?
In fairness, during the pandemic, and I'm not talking about it from a personal bubble issue, you can talk about that all you want. I'm talking about this from an economic perspective. And back during the pandemic, there was a sense of economic cooperation between countries. And that created a sense, we'll do what it takes to actually try to revive the economy. A whole host of uncertainty. That, I think, is the aspect that is getting people concerned. What is the framework even that we're operating in?
Curious how willing they are to criticise US policy and how unwilling the Europeans have been to criticise policy coming from China, particularly around the pandemic.
Couldn't agree more.
In the months and years after that. So plenty of questions for the Europeans on that front, that's for sure. Let's get to the OECD, out with its latest economic outlook saying President Donald Trump's aggressive trade policy is abruptly setting the global economy on a path of slower growth and higher inflation. The organisation saying, quote, significant risks remain. Further fragmentation of the global economy is a key concern. Joining us now to discuss is the OECD Secretary General Matthias Cormann. Matthias, welcome to the programme, sir. It's fantastic to get your insight on the global economy. When you downgrade overall global economic growth, can you lift the lid on that call for us and just go beneath the surface? Where are the biggest downgrades, revisions to growth on a country-by-country basis?
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1% and next year by 0.3% down to 3%. And I mean, it's a function of the data pointing to a weakening in the global economic outlook, but also inflation remaining more elevated than we had previously anticipated. Of course, the very high levels of policy uncertainty, which is weighing on growth, because of its impact on, both consumers and investor confidence and likely future investment decisions.
Secretary Matthias, how much do you see the U.S. getting penalized just as much as the rest of the world when it comes to downgrading the growth trajectory as a result of tariffs? Or is it still the idea that the rest of the world will see a bigger hit than the United States?
Well, we do see a negative impact on the economic outlook in the United States, but it's a lesser impact on the basis that the U.S. has a comparatively large domestic economy, of course, and trade as a share of GDP is of less importance in the United States than what it is in other countries around the world. I mean, in particular, when we look at Canada and Mexico, who have got very comparatively higher trade exposure as a proportion of their economy, but also, and in particular, high trade exposure to the U.S. market, then clearly the impact there is somewhat more significant. But the impact is also material and negative in our outlook for the United States.
How much do you have a framework to even price in what the outlook is for trade? I mean, we were just talking about how April 2nd, hopefully we'll get more clarity. We hear from every company the issue isn't just the tariffs, it's a lack of certainty around what the policy is going to be. How do you even come up with a model for this?
Look, I mean, we are making certain assumptions, and certainly, I mean, for us, we work on the basis of what is announced and or legislated policy of an elected government. But the uncertainty in itself is certainly weighing on growth. But as a matter of general principle, what we would say is that there is, when it comes to global economic growth, when it comes to continuing to lift incomes and living standards for people in countries around the world, keeping markets open, having well-functioning global markets, having a rules-based trading system in good working order is still the best recipe. And to the extent that there are issues between countries in terms of fairness or perceived unfairness, in terms of policy issues that need to be addressed, that is best done through bilateral or multilateral dialogue rather than through unilateral measures.
To build on Lisa's point, your calculations don't account for what Trump is set to announce on April 2nd. Also, some other items he's announced, like a 200% tariff threat on European wine, cheese, and champagne coming into the United States. So after April 2nd, or maybe a few months after that, June 30th, do you think you're going to have to revise down some of your growth forecasts?
Well, we are pointing in our revised forecast today. We are pointing to significant downside risks, including, when it comes to further trade fragmentation or increased trade tensions because of further measures, which clearly would be a further negative in terms of the global economic outlook. I mean, at the moment we can only make our assessments based on the decisions that have been made and announced so far. But if further decisions in the same directions will be made down the track, then of course we would have to revise our assessments. But on the flip side, I mean, there's also positive opportunity. If countries around the world decide to work together to resolve some of these issues, in a better, more efficient way, not relying on tariffs and other trade restrictive measures, there could also be a positive impact on the global economic outlook.
Well, one positive has been the Europeans, and they've been energised on the policy front. They're willing to spend more on defence and infrastructure, and perhaps we can finish the conversation there. That view, that move by the Europeans has been widely celebrated. Can we finish on some words of caution for them? Do you have any?
Well, look, I mean, as a matter of general principle, investment, increased investment in infrastructure, in particular, increased investment in productivity enhancing infrastructure, is a good thing and is an important part of the overall increase in international competitiveness, and it should be part of a broader plan. But of course, in the end, it's all a matter of what is fiscally affordable and fiscally sustainable as well. And part of our advice to countries around the world, including in Europe, is to keep an eye on debt sustainability and on the need to rebuild fiscal buffers and fiscal resilience.
Matthias, enjoyed the conversation. Great piece. It came out early this week. I'm going to give it a good read a little bit later on. Matthias Cormann there, the OECD Secretary General. In the summary page at the very bottom, they say higher government spending on defence could also support growth in the near term, but potentially add to longer-term fiscal pressures. Now, that might not apply to Germany, but for Europe as a whole, got to ask some serious questions. There's been way too much happy talk and groupthink regarding the investment and defence push by the Germans. And I understand why. It's something a lot of people have been calling for a long, long time. But we've got to ask some serious questions as well about what might go wrong.
Yeah, especially at a time where this is over 10 years that you're seeing almost €1 trillion of spending being deployed. You have to imagine what this means for spreads, what this means for the peripheral countries that might not have the same capacity to borrow that maybe Germany does. But also, seriously, how much can this actually boost an economy that's dealing structurally with some challenges and being between China and the United States?
Questions on the foreign policy front as well. You've basically got the Europeans communicating very transparently that in the future we will have our own defence. We will have a massive defence force, and this is how much we're willing to expend. But in the meantime, we don't have it, and we don't have the goods to secure anytime soon, because you're going to have to build these things. You can't buy them overnight. And the Russians are going to be listening very, very carefully, and I imagine calibrating their response to that accordingly.
And whether or not it's Europe building up their defenses, it all comes back to the United States. In the near term, it's backed up by the U.S. In the long term, even if you're spending more on defense, besides a select few like Rheinmetall, you're going to be buying weapons from USA.
A lot to think about. Equity futures right now in the S&P just about negative by 0.1%, with an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also a warning to Iran, which backs the Houthis. The Vatican released the first images of Pope Francis in the hospital since he began treatment for double pneumonia last month. In its latest medical update over the weekend, the Vatican says that the Pope is gradually improving and using less mechanical ventilation to help his breathing. Fashion retailer Forever 21 has filed for Chapter 11 bankruptcy. The company has assets of $100 to $500 million and liabilities of $1 to $10 billion. It said in a press release that it would wind down its U.S. operations while pursuing a going concern transaction or a sale of some or all of its assets. That's your Bloomberg Brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program, a healthy correction.
Corrections are healthy. They're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Up next on the program, we'll get the view from JP Morgan. Sam Zeef joins us in just a moment from New York. This is Bloomberg. Equity futures on the S&P negative, just a touch here, down by 0.2% on the S&P 500. In the equity market, 4 consecutive weeks of declines, the longest weekly losing streak going back to August of last year. Don't forget Friday, though, a really strong finish to the week. The biggest daily gain on the S&P of the year so far. No positive follow-through. We're down by 0.2. And the bond market down by 2 basis points. The 10-year 4.29. Later on this morning, U.S. retail sales. The next stop for this market, 8:30 Eastern Time, about 41 minutes from now. Under surveillance this morning, a healthy correction.
Corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The White House isn't blinking as trade tariff policies erode market-based U.S. exceptionalism. Sam Zeef of JP Morgan writing, we think this is more of a growth scare than a true slowdown. But that's where you could get another leg weaker in the U.S. dollar. Sam joins us now for more. Sam, good morning. Welcome to the program.
Good morning. Thanks so much.
Let's talk about the policies and how the market has responded to them. The policies themselves aren't that surprising. Tariffs. We were promised tariffs. We've got tariffs. The surprising element to this is how the FX market has responded to said tariffs. What explains that, do you think?
I think the operative word here is uncertainty. So if you think about it, coming into the year, people expected tariffs, but the amount of uncertainty around U.S. economic policy is greater than I think many were thinking, and that's starting to weigh on the soft data in the U.S., weigh on sentiment, weigh on business confidence, which is starting to introduce a little bit of downside risks to the U.S. outlook. At the same time, you have uncertainty over, let's say, the U.S. commitment to global security, at least if you're from a European perspective. And that's now sparking large fiscal stimulus in Europe, largely focused on defense, but infrastructure as well. And that's starting to raise expectations for fiscal stimulus and growth in the Eurozone. And so you have uncertainty, but if you combine the two, you're starting to narrow that gap between U.S. growth and rates and the rest of the world. And that's what the market is starting to price in, with the dollar starting to weaken year to date.
There's an argument being made that right now the dollar weakness and the euro strength is only pricing in the fiscal spending in Europe, not necessarily the weakness in U.S. growth. Do you agree with that?
I would. I'd say the market has gone a long way to pricing optimism in Europe. Think about the rate moves we've had, the kind of neutral rate estimation in the market's eyes for the euro area, where the ECB's terminal rate is. Those are both increased 25 to 50 basis points, really to the upper end of, I'd say, accepted ranges. You're not pricing in a lot of growth pessimism in the U.S. You've taken out some of the optimism from earlier this year, but growth pessimism, the Fed's still only priced to cut to 3.5%. The 10-year yield is around 4.25%. Think about last fall, last summer, when you had the Somme rule triggered, a lot of recession fears in the U.S. economy. 10-year yield was 100 basis points lower than it is today almost. You had the Fed price to cut 50 to 75 basis points more than it currently is. So that's where that leg of extra dollar weakness, if the market was going to price that type of slowdown in the U.S., that's where the next leg would come from.
It is highly unusual to see the dollar weaken at a time that's risk off, at a time when you see equities also losing value and there is uncertainty economically globally. A lot of people have raised the question, is this the beginning of a new shift, of a paradigm shift where suddenly it's a reversal of the trend we've seen into the dollar over the past decade? Do you agree? Do you think that that's what this is?
Well, where that risk off has been concentrated has been in U.S. equities and in U.S. tech, which has been the main dominant driver, let's say, for the last 10 years. I would say that you're starting to see a little bit of a shift in the dollar's relationship with risk assets. If it continues, you're going to lose one of those things that's really built up these big overweights to U.S. assets. So think about it. Global investors for the last 5 to 10 years or even longer have built up big overweights to U.S. assets because they're safe, they're liquid, the dollar provides a natural hedge when there's a risk-off environment. U.S. tech has been the main outperformer. If the market starts to question a few of those, there's very, very large capital shifts that can occur. We're not really starting to see signs of that, but I think that's something we're watching really closely. Hard to get data on it, but it's really important to just note that even just small amounts of shifts, a couple percentage points among these global investors, is hundreds of billions of dollars.
We do know Trump hates trade deficits. If there's a weaker dollar, potentially that can cut into that. Do you think a weaker dollar is actually welcomed by this administration?
I'd say the weaker dollar is one thing that can help rebalance trade. It's not the only thing, right? And so it's something that we're trying to pay attention to. Like usually on most models, you would need a very large depreciation of the dollar to be large, persistent, stay in place for a large period of time to rebalance global trade. I don't presume to know what the administration is exactly trying to do, but it's a reason that we're starting in the private bank to think about the right types of diversification across asset classes and across geographies. And so trying to take the market at face value, respect the risks, and invest globally.
Right type of diversification, meaning you're buying more gold?
Definitely buying more gold. That's definitely the first destination of kind of global investors that are looking for alternatives to U.S. dollars, but also investing globally, right, and making sure that we're not ignoring other geographies that are starting to see a pickup in momentum. And also, of course, just investing across asset classes. So not just in U.S. equities, but looking at bonds as well.
This has been a sales pitch for the best part of a decade. You've got to buy international.
Yep.
Are people finally buying? Do you feel that capitulation?
I won't call it capitulation yet, but it's definitely getting more conversations in our internal investment committee meetings and everywhere else as well. Rather than starting to shift all of your U.S. allocation into global, a recognition that this is why you have it. It hasn't been fun. It's been a detractor in some portfolios. We hear it. Everybody hears it. But this is why you have it for times like this.
The ECB's not having fun. Should we finish on that? I like Luis de Guindos, by the way, the vice president. A very nice guy.
You're going to bring
Charming
this back
man.
up.
Of course.
All right, carry on.
He says it's the most uncertain time, even with the pandemic in mind. He thinks it's more uncertain now than the pandemic. What's your view on that?
I was listening before. I'm going to give him a little bit of defense here, which is to say that for a central bank, it is a tough environment, the current one, because you're getting some downside growth risks. Inflation is still above target. Inflation expectations are always fickle, so you don't want to necessarily ease too early, let's say. And so I think from a central banker perspective, it is uncertain. You're not exactly sure what to do. Pandemic, much larger shock than anything we're living from today, but it was very clear what to do. You ease policy, you ease aggressively. I'm going to cut him some slack and say that's what he's talking about.
Does Chairman Powell need to confront the same thing on Wednesday?
I think they're dealing with the same uncertainty, right? And I do think that what the Fed is basically saying is we're going to stay on hold for a little while. We're watching this. Let's see what the policies actually end up being. Let's see what the data tell us to do. But a big reason that we think that actually fixed income, even U.S. dollar fixed income, is looking quite interesting from an asymmetric return profile is because at worst, the Fed stays on hold for a while. You get the yield that's written on the tin. It's hard to imagine a big backup in yields with downside growth risks. But if something does materialize that's much worse and the Fed does have to ease, they'll provide protection in a portfolio.
Sam, appreciate it. Sam Zeith there of JP Morgan. Didn't provide much protection last week, did they?
No.
Or the last couple of weeks, for that matter.
Because of concerns about inflation that remains sticky. I just want to say that was a much better defense of Luis de Guindos. And frankly, it's not saying that this shock is the same. I'm not saying that, some of these policies are us burrowing into our homes and a camera and our kids on the couch.
They say it was the obvious thing to do back then. I just don't think we've paid the price for it yet. That's all.
Could be. I think that you're right.
That's all. Up next on the programme, Samir Samana of Wells Fargo, Tom Forday of Maxim Group, Neil Dutta of Renmac, Colin Martin of Charles Schwab. From New York City, the third hour of Bloomberg Surveillance. Up next.
The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So the opening bell about 90 minutes away as we kick off the third hour of Bloomberg Surveillance. Your scores look like this. Equity futures on the S&P 500 softer by a little more than 0.25%. On the Nasdaq 100, softer also, weaker, lower, negative by 0.1%. And the underperformance comes from the small caps, the Russell. This can all change in about 29 minutes' time when we get US retail sales, another read on the US consumer, and the last big read going into the Federal Reserve 2 days away.
It's going to be important to tell whether the deceleration does continue. We did see last month this deceleration, a decline of 0.9%. The expectation is for an increase. If you do get a deceleration, how much does that just turbocharge some of the concerns about a growth slowdown in the face of, yes, uncertainty, but also already slowing growth? And that's something Neil Dutta has been really clear on.
And Neil's talked about anxiety over unemployment starting to rise, consumer sentiment starting to drop. And some of the companies in corporate America, I'm thinking of Delta Airlines in the last week, starting to tell you that in the middle of February, spending started to stall for some consumers and for some businesses alike.
Kohl's, Dick's Sporting Goods, the airlines are starting to show you that consumers are pushing back. And of course, the Michigan survey on Friday talking about consumers, talking about the uncertainty of policy out of Washington, D.C. Long-term inflation expectations hitting a 32-year high because of those tariff concerns. When you think about retail sales, when it comes to tariffs, and you talked about this earlier, Lisa, you think people front load and are buying a lot right now because they're concerned of prices going up? Or has the consumer actually been hit? They're worried about maybe losing their job and a lot of anxiety, and they are deciding that they're not going to go out and spend.
There was a study highlighted by the Financial Times by Retail Next, which is a consultancy, that said that footfall in U.S. stores fell 4.3% in the early weeks of March. So people are saying that it's more of the latter and not the former in terms of people front loading, especially because they're already seeing prices creep up in certain places and they are already feeling the hit from some of that uncertainty.
Step up Chairman Powell. So Chairman Powell goes into this news conference on Wednesday with some new forecasts, and we'll see what we get in those forecasts. Some people anticipating lower growth forecasts, but what will happen with the outlook for inflation? And this is a really curious time because everyone's talking about the prospect of higher prices. At the same time, energy prices are dropping. That's pretty unusual. That's not something we're used to.
And you've made this point. It is a correct one. Why are they dropping? Are they dropping because of supply or are they dropping because of demand? And the answer is both. The expectation for OPEC to actually increase some of their production and ongoing pumping at the same time that demand is expected to slow. We see the projections coming out that is the case. Again, this goes back to the difficulty of a stagflation-like playbook. And that is what I think a lot of people are trying to wrap their heads around. How long can inflation remain sticky if growth and demand truly is falling?
The Federal Reserve decision 2 days away. Equity futures right now down by a third of 1%. That data is just around the corner. U.S. retail sales 8:30 Eastern Time. Coming up on the program, we'll catch up with Samir Samana of Wells Fargo as the White House calls the stock correction healthy. Tom Forday of Maxim with Apple down double digits so far this month, and Neil Dutta of Renmac reacting to that economic data later this hour. We begin this hour with stocks looking to snap the longest weekly losing streak going back to August. Samir Samana of Wells Fargo staying constructive. We expect stock prices to march higher by year end, driven primarily by earnings growth that should broaden to more cyclically oriented areas of the market. Samir joins us now for more. Samir, welcome to the program, sir. I have to say a key feature of your outlook is still US outperformance, US economic resilience. Now, that was consensus at the start of the year. 2-3 months later, it's on the edge of contrarian. Samir, why are you sticking with the call?
Yeah, and I mean, look, I think it has just as much to do with the international side as it does the U.S. side, right? I mean, if you look at, kind of what's happened with Chinese equities over the past, I'll just call it 5 to 10 years, there's been these false dawns, and they happen. And, the way we've always likened it is the Chinese tend to kind of drive a car with, one foot on the accelerator, one foot on the brake as they go down the road. And the last tap was probably on the accelerator, but the next one could easily be on the brake. So you do want to be a little careful chasing performance there, and that's really been the driver for emerging market equities, where we remain unfavorable. On the developed side, same thing. Europe has had many kind of, times when it seemed like they were, moving towards greater cohesion, the valuations were cheap, and that we were finally going to kind of unlock that value. And then something happened in order to make kind of the political stuff, take a step backwards. So I really do think the U.S. still remains the cleanest story, and the administration really does want America to come first.
If these are false dawns abroad, potentially head fakes, what do you make of the dislocations we're seeing in big tech?
Yeah, so we also think big tech probably rebounds from here. Again, the multiples had probably gotten a little lofty. I think expectations had probably gotten a little bit lofty. I think anybody who thought that there wasn't going to be competition around AI and was surprised by DeepSeek probably wasn't doing their homework to begin with. And now that expectations have reset, I think tech looks really interesting at these levels.
flows can take on a life of their own, Samir, and that's something we were just discussing with Sam Zeef, this concern that given the fact that the dollar has weakened in tandem with big tech, it could prompt some rethink globally of whether the U.S. truly is a hedged story, whether you can buy using dollars that will rally if there is some sort of downturn and get that as sort of an offset. Do you see anything like that happening, or how concerned are you about some sort of global shift away from the U.S.?
I mean, we've always been kind of neutral on developed market equities, so we do want people to have a full allocation there. Interestingly, we think the dollar probably rallies from here. And, again, if you think that inflation is going to stay higher, it means the Fed probably has less room to cut than some of the other central banks, which, again, should be supportive of the dollar. And then if you see tech kind of starting to bottom out, as we think it will, we think some of that hot money, which, has chased returns abroad, probably comes back home.
So what do you reject that we're hearing about, or the market is sniffing out about slowing growth that we heard particularly last week from the airlines? Why is that not something that really is a warning sign to you?
It probably is. And look, it's probably a warning sign on the consumer side. So, the areas that we like tend to be more on the manufacturing side. We like industrials. We like energy. Refining spreads are finally starting to kind of perk up. We like financials. The curve has, finally, gotten to positive territory. So we think they'll do okay, although, there could be some credit quality concerns if there's a bigger economic slowdown, not in our base case. And then we like comm services. So when you look at kind of the areas that we favor, along with large caps and mid caps in the U.S., it's a very high quality portfolio. So this is not a swing for the fences type of portfolio. Where I guess maybe the market has gotten things wrong is the consumer's been tapped for years now. I mean, I remember just day after day, week after week, we would just talk about, hey, look, when does the low-end consumer, just finally tap out and the high-end consumer finally, kind of hit the skids? And I think some of that has been a long time coming, but some of it's probably precipitated by the tariffs.
When it comes to the tariffs and the policy right now, you think that Trump is going to have a targeted tariff approach. Why?
I mean, because he said as much, right? I mean, again, I think he wants to kind of start with shock and awe, and then I think they'll probably settle into something that, is, in his mind, probably what maybe kind of cures the ills that he sees, and then they'll move on. They'll move on to deregulation. They'll move on to taxes. Like, I don't think we'll be talking about tariffs to this extent at the end of 2025.
When it comes to them moving on, we haven't heard a lot about deregulation, and when it comes to the tax cuts, Bob Elliott, our guest earlier today, said basically it's just extension of TCJA, which is the current law right now. Is that enough to really boost excitement in this market?
I think I come back again to, all right, what's your alternative, right? You've got long rates kind of in that 4 to 4.5% range, as I've been, telling people, look, after tax, after inflation, you're almost left with nothing on the Treasury curve. If you move out to corporates or high yield, now you're taking some of the same risks. I would argue, I would take high quality equities probably over high yield at this point, and you at least get, still a pretty solid kind of 5% earnings yield. Then you throw in the buybacks, you throw in the dividends. We still think equities probably offer kind of, low teens type returns. Now, again, it does come with some risk, but we think after the pullback, you've already taken a good bit of the discounting kind of out of the equation.
Samir, how much protection are Treasuries providing in a portfolio right now, given the fact that, just to take score for the month so far, we're down 5% on the S&P 500 and bond yields aren't dropping? They're doing the opposite now. That wasn't the way we started the year. It wasn't the way we started this administration, but there has been a subtle shift over the last 2 weeks, and I'd love your thoughts from you and the team.
Yeah, and that's just it, right? Is that, look, if inflation is not going away, which has been our base case for some time, we've been on the north end of consensus for as far back as I can remember. We just didn't think inflation was going away. If anything, we continue to worry very much about a second wave of inflation, right? Especially if, the tariffs cause wages to start kind of perking up, and then there's, again, to call it that upward spiral. Not our base case, but that's the side that the risks are coming in at. And so what history tells you, and even recent history tells you, is when you have inflation as the problem front and center, stocks and bonds can both struggle at the same time, which is kind of what you're seeing now. And that's why I think gold's doing a little bit better. Commodities, where we're favorable, is doing a little bit better. You may want to sneak a little bit of that money, as I mentioned, to the developed market equities. So I think it's okay to have some diversification in that type of scenario. But yeah, I think it's going to be really tough for bonds to outperform from here.
Samir, it sounds like you prefer the U.S. You still do think that it's the cleanest shirt and whatever cliche you'd like to put out there. At the same time, it sounds like you don't expect big returns this year. Is that correct?
I mean, from current levels, we do. I think our year-end target for the S&P is 6,600. So, if you throw in the dividend yield, that is, again, kind of, mid-teens type returns into year-end. If you start to think out into the first quarter of next year, now maybe you're talking high teens. We just upgraded mid-caps to favorable. We think they could do, as much, if not better than that. So, I guess what I would tell investors is don't wait for the narrative to shift, right? Right now, there's this really negative narrative around tariffs, around inflation not going away, around a growth slowdown. I promise you it'll change as we get into the summer months. And at that point, the markets will respond first and investors will find themselves trying to kind of catch up to where markets are going.
Samir, appreciate the clarity on your view from you and the team. Thank you, sir. Samir Samana there of Wells Fargo. A key feature of their point has been US economic leadership, and that was very, very consensus at the start of 2025. And as we work our way through the year, it's on the edge of contrarian now.
I would argue it is contrarian to say that the U.S. is going to be the outperformer, that you've got, in the mid-teens in terms of outperformance for U.S. equities at a time where big tech is supposed to rebound. Other people, whether it's Stuart Kaiser, whether it's Lori Calvasina, we don't know. These signals are getting a little confusing.
Let's go to the forecast from the OECD. So they've got US growth down for 2025 at 2.2%. Eurozone GDP growth projected to be about 1% in 2025. Now, in terms of levels, you'll get the outperformance for the US versus, say, Europe. Probably, most likely. As a lot of people always say on this programme, what the market's interested in is better or worse. And things in the United States, based on projections, are worse than people thought they would be only a few months ago.
And they are better than they thought that they would be elsewhere when you have the promise of fiscal spending. We can't emphasize it enough. And I think you put it really well. This idea, have we paid for some of the fiscal bazooka that we engaged with during the pandemic? And is now the time where you're going to have to ultimately pay for it? And if you don't, you're going to get penalized in the debt market. It is an interesting time coming off one of the biggest dislocations we've seen in a long time.
Feels like Secretary Besson's the only guy out there saying, yes, we need to pay the price for this. And it means a detox.
Well, other people say that there is a price to pay for it, but we don't want to pay it. At the same time, I think the issue isn't that there is not a crisis. I think a lot of people agree with that. It's what is the cohesive plan to get there? Are we cutting enough to actually make a dent when it comes to reducing the deficit?
Looking potentially at a major realignment across several dimensions. Equity futures right now on the S&P slightly softer. We're down 1/3%. Big economic data points 17 minutes away. US retail sales just around the corner. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. The U.S. Mid-Atlantic is on alert as a powerful storm system sweeps over the region. The Storm Prediction Center said more than 50 million people from western New York to central Florida were in the track of the storm. This comes after at least 36 people were killed across 6 states when a massive storm system moved across the South and Midwest last week. President Trump may be raising the possibility of new investigations into the January 6th committee. In a Truth Social post, Trump declared President Biden's pardons for the committee members void because Biden signed them with an auto pen. Last year, a federal appeals court found that a pardon doesn't have to be even in writing. And March Madness is upon us. The Auburn Tigers were named the men's top seed with Duke, Houston, and Florida also getting named as number 1 seeds in their conferences. The tournament begins tomorrow with the first 4 games tipping off in Dayton, Ohio, ahead of the main bracket action on Thursday. And that's your brief, John.
Danny, thank you. I just wish I had a snapshot of Bramo's face just then. Not doing your bracket, Lisa.
Well, no. I just feel like it's, sports roulette.
All right, that's a no. Okay. Up next, the Morning Calls Plus. Tom Forte of Maxim Group on how Apple can bounce back from its double-digit drop so far this month. A conversation up next, live from New York. You're watching Bloomberg TV. Equity futures here just a little bit softer. We're down by 1/3%. On the Nasdaq 100, down by 2. On a Russell, negative by 0.6. That's the price action. Let's get you some morning calls. First up, MoffettNathanson upgrading Netflix to buy, calling its ability to monetize engagement underappreciated. That stock up by 1.2%. Your second call from JP Morgan upgrading Norwegian Cruise Line to overweight, seeing no change to demand trends despite emerging consumer concerns. Interesting one, that. goes against the grain with the airlines, that's for sure. That stock is up by 4% in early trading. And finally, Mizuho lowering its price target on Tesla to $430, expecting February sales to underperform in several key regions. What's that, horses, barn doors and all that stuff? Stock is down by 1.2%.
It's just, I remember how we used to not care about deliveries with Tesla.
Yes.
It was a belief stock. It was a sort of dream stock. And now it's both.
The bulls will tell you it's still a story stock, right?
Yeah.
It's the future. It's away from what they're going to do with EVs.
Yeah, but even Dan Ives kind of moving away from that and saying it is the moment of truth. Either come or don't come back to Tesla or else stay at Doge, and maybe we're not going to have such a great go of it.
Stock is down in the pre-market by 1.2%. Let's stick with the Mag 7 names. Apple shares under pressure, down nearly 15% so far this year, as slow revenue growth and uncertainty around its AI offerings weigh on the stock. Tom Forte of Maxim Group has a hold rating on the stock with a 215 price target, noting its AI smartphone is a potential catalyst. Tom joins us now for more. Tom, welcome to the program. Always good to get your thoughts on the name. Let's talk about Apple right now. What do you think is behind the recent weakness over the last few weeks?
Yeah, so I'm actually encouraged because I think for the first time in a long time, some of the risks for Apple are starting to get priced into the shares. When you think about, are we in a global trade war, or are we on the verge of a global trade war when it comes to Trump's tariff policies? And in particular, you think about a trade war with China, which is a high teens % of sales, and still where Apple manufactures most of their devices. I'm actually encouraged that the stock's starting to price in some of the risk.
So, Tom, when we go into the next earnings release, are you expecting some weakness in China and some weakness that's already priced? Because we did drop another 11%, close to 11% last week alone.
Double-digit declines in China in the December quarter. And the concern would be that a prolonged trade war with China would inspire more consumers in China to buy from Huawei and not from Apple. Add to that the fact that Apple's been unable to roll out their AI feature set in China, and I think you're going to see continued weakness there.
So, Tom, what would make you actually be enthusiastic about this stock, given that there are a lot of fundamental challenges, and you're encouraged by a 14% drawdown so far this year, but not really changing your hold rating?
Yeah, so Lisa, what would get me more excited is Apple still generates a ton of free cash flow. And generally speaking, when they report the March quarter, they update their returning capital to shareholders policy. So I think lost in the shuffle on the Trump tariff policy is Trump's tax plan. And when you think about Apple, and they pointed this out when they announced their $500 billion investment in the U.S., that they're one of the largest taxpayers in the U.S., and a prolonged period of lower tax rates means more free cash flow and a greater opportunity to buy back stock. That gets me, excited, I guess.
So later this year, you could see, if those tax cuts get extended, that there could be some sort of stock repurchasing that maybe, you guess, could get you excited or move away from a hold. What's your concern level about some sort of tit for tat between the U.S. and China, roping Apple into it and make Tim Cook have to choose in a way that the ultimate diplomat just hasn't had to do yet?
So historically, as you pointed out, Lisa, he is the ultimate diplomat, CEO by day and diplomat by night. Does an amazing job balancing the company's relationship between the two countries. Elon probably second best with Tesla. What would get me more excited is evidence that that there is an upgrade cycle as it pertains to AI. We haven't had that evidence to date, given that they rolled out the new hardware the 16th of September, and they've been rolling out the software piecemeal with the AI feature set, and you haven't seen very good Apple iPhone sales. So maybe as the year progresses, you start to see evidence of an upgrade cycle, or at least better than what we're expecting right now.
Tom, let's think about the backdrop for this decline, particularly over the last 2 weeks or so, and for that matter, over the last several months. We've seen a major sentiment shift away from the United States to Europe to China. And with that, multiples have had to come down. And Tom, I'm just wondering if you can go beyond just a single name coverage just for a moment, just indulge me. Do you think there is a possibility here that perhaps the scarring from several events over the last couple of months could be long-lasting, that maybe the willingness of investors to pay up for US equity names, particularly US tech and major tech names, that willingness might not be there through the rest of this year?
So the argument against that, Jonathan, would be that the US has been the source of most of the globe's major tech companies. Yes, you have Alibaba, Tencent, and some other giants in China, but you're talking about Apple, Amazon, Meta and Facebook, same thing, Google, So the innovations come out of the U.S. The multiples, I think, will follow the innovation. And there's reason to believe long term that the U.S. will remain the epicenter for tech and for stocks in general.
I guess what I'm getting at, Tom, is how much of this is really about tariffs? How much of this is really about still dealing with the fallout from the DeepSeek revelation from the back end of January?
Well, the problem, Jonathan, with the DeepSeek revelation is that every major U.S. tech firm basically reaffirmed that they're going to spend a ton of money advancing their AI efforts. So I think that we should expect there to be competition, especially from China, for AI. Let's see how Amazon, Apple, and others ramp their AI efforts. And if the CapEx spending is worthwhile, I definitely believe for Amazon it will be. So let's see how things play out.
So what do you have to see to actually raise it to a buy at a time where potentially there are all of these headwinds, there is competition, there is the upgrade cycle, and at a certain point you also just have structurally higher rates potentially that could impact valuations?
So it is possible, Lisa, that the stock just trades down lower, so there's more upside to our price target. So, the risks getting priced in to a greater extent. Love to see signs of improving sales in iPhone. But again, they generate a ton of free cash flow. We haven't talked at all about their services story. That's very compelling. That's where all the upside came in the December quarter. They recently added Apple TV to Android devices. So I think the services story is quite good still, higher margin than the hardware. So there are things to like. I just would like the shares to get priced in a little more risk.
There's also a concern longer term, and this is something that Peter Scheer of Academy Securities raised over the weekend, that as the trade wars drag out, that Americana brands, the ones that really represent the United States, will get penalized in foreign sales, akin to what we've seen maybe in Tesla anecdotally. Do you believe that that is something that could pose a challenge for the likes of Apple, which has traditionally been associated with Americana?
The answer is absolutely. And really the worst example, Lisa, is the Canadians taking the American liquor off the shelves, essentially. So yes, I do think that a prolonged trade war, nationalism, consumers in China buying from Huawei instead of Apple, brands that are associated with the U.S., even though they are global brands like Apple, having negative views outside the U.S. on a prolonged trade war, that's certainly a risk.
Hey, Tom, appreciate it, as always, to get some clarity from you, sir. Tom Forte there of Maxim Group on Apple. Apple down by close to 11% last week. Pretty ugly week at the moment. In a moment, we'll get US retail sales. And I think a big question for the likes of Neil Dutter of Renmac. If you have an iPhone, which is a wonderful product, and it lasts, and you don't need to upgrade it every single year, and anxiety about employment is going up, and confidence about the economy is going down, are you going to upgrade for an iPhone anytime soon?
The answer has been for a long time, based on the Jonathan Farrow index, that not so much. And that really is going to be the key tell at a time where it's $1,000. And why bother?
In a wait-and-see economy, why would you rush?
Yeah, I mean, that's probably...
In a wait-and-see. Show me the new products. Show me that AI. Show me why it's going to change my life.
You
and
wouldn't
maybe
really... What do you want it to do?
Life.
You know,
Cook? Battery life.
I'm a very simple man. It's the battery life. Retail sales up next from New York. This is Bloomberg. "25 seconds away from a much-anticipated US retail sales print. Mike McKee's going to break that down in just a moment. Your scores going into it look like this. Negative by 1/3% on the S&P, down by 1/10 on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Your yield curve shaping up as follows. The 10-year this morning, your yield is down 2 or 3 basis points. The 10-year, 428.51. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, the economic data is the hard data people have been looking for, and it is worse than anticipated. We had a question about whether the hard data would follow the soft down. Retail sales on a headline basis up just 0.2%. Ex-autos up 0.3%, and ex-autos and gasoline up 0.5%. A retail sales control group is reasonably strong, though, up 1% after a negative 0.8% drop in the month before. We'll take a look at what the movers were in just a moment. The Empire Manufacturing Index, another soft data, comes in terrible. Down 26 points to -20, with new orders, shipments, employment, and hours worked all falling. Prices paid rise 5 points to 44.9. That's the highest level in more than 2 years. Optimism about business activity in the future falls 10 points after dropping 15 points last month. So it looks like at this point, people are not confident in the future, and to a certain extent, they're spending less.
Michael McKee, let's put it this way. Some conflicting data, some tension, a tug of war between the soft data and the hard data, and that tension continues. So I'll just give you a snapshot of what the bond market is doing in response to it. Initially going into this print, yields were lower by 2 to 3 basis points across the curve. We erased some of that move, now higher on the front end by a single basis point, just north of 4%. In the equity market, I'm sure for many of you, you don't know what to do with this. You're not alone. Equity futures just about unchanged on the session, down by 0.2%. Headline retail sales, month under month, a downside surprise of 0.2% against an estimate of 0.6%, but the control group, a punchy 1% against an estimate of 0.4%. And then you've got a really ugly Empire Manufacturing read in the mix as well for the month of March. So, Lisa, put that all together. What have you got?
You basically have a situation that's not weakening fast enough for the Federal Reserve to cut rates in an imminent way, but you have weakening growth and, as Mike was talking about with Empire Manufacturing, ongoing concerns about price pressures, even with reduced demand. This is not what you want to see. I want to point out that revisions were all to the downside when it comes to retail sales for the prior month. So not weakening quickly enough to necessarily warrant an emergency rate cut of any sort, but definitely on the weaker side.
Mike McKee, just want a quick explanation. I know you're going through the details as we speak. What explains the downside surprise on headline versus the outperformance, the upside surprise on a control group?
Well, we had a big drop in motor vehicles and parts, autos down 0.6%, and a 1% drop in gasoline prices. So that's weighing on the headline. The only thing that's really good, though, in the report is non-store retailers, e-commerce, up 2.4%. But food services and drinking places, sporting goods, clothing stores, health and personal care stores, everything else is down during the month, so it is not a very good report overall. We stayed home, I guess, in February. Maybe it was the bad weather, and ordered stuff instead of going out and buying.
Mike McKee on the latest. Neil Dutta joins us now to extend the conversation. Neil Dutta of Renmac. Neil, welcome to the programme, sir. You've noted the soft data, the anxiety over employment specifically. I just want your thoughts initially on retail sales. Do those two things stack up?
Well, I mean, the retail sales data was basically an online story. I mean, last month, a lot of the weakness that people didn't foresee was a function of online retail. And this month, a lot of the strength that people see was a function of online retail. So that kind of just swung around. If you take that out, the underlying story is still weaker. I think it's interesting that food services and drinking places, basically restaurants are down 3 months in a row, or down, over the last 3 months, and pretty meaningfully over that period. I mean, that's sort of a bread and butter type of discretionary purchase. If you're not feeling good, you're not going to go out to eat. And that's exactly what's been happening.
Neil, you've been clear about how this weakening trend has been in place for quite a while, that really since late last year. You could start to see it in the data. And this is part of the economic cycle as much as anything else, if not more. I am wondering if you're surprised by the pace of some of the deterioration, especially in light of the pressure that increasingly is being put on the Fed not to cut rates because of inflation expectations.
Well, I mean, I don't think there's a smoking gun yet in the hard data. I mean, I want to be clear about that. There's no sign of collapse. There's no real discontinuity in the hard data. I mean, that's a classic Greenspan sort of tell for trying to figure out when, if we're in a recession or going into one. But you clearly see weakness in, soft measures of economic activity. And obviously, there's been a fairly rapid speed in terms of the weakness in consumer sentiment. As an example, the March Empire data, sort of the same thing. Obviously, if you're doing tariffs, I mean, that's going to weigh on the goods sector, disproportionately, and you're seeing that. But you've yet to see that really translate into hard measures of activity. And I think at some level, Lisa, I mean, the fact that the economy, I mean, residential investment's been quite sluggish. a lot of the cyclical areas, manufacturing's been quite sluggish. So if these cyclical areas have been relatively soft to begin with, it mitigates some of the downside, because if you're sort of bouncing along the bottom, it's hard to go further down into the basement.
One thing that you've laid out, Neil, and I thought it was really profound, especially in your conversation with Paul Krugman over the weekend, was the degree to which some people are underestimating the amount of state and local funding that's being cut right now, and how some of the federal cuts might look really small on kind of a national spending level. But when you start to get those cuts at state and local levels, that's where it's going to bite more significantly. I'm wondering, how quickly are we starting to see some of those cuts filter into some of the economic data that we're getting out, like spending, like consumer confidence?
Well, I think the area to watch is really state and local government employment. I mean, that had been a steady tailwind for jobs growth over the last year or so, and that's shifting into a much lower gear. Remember, state and local governments were adding 30 basis points of GDP growth, and that's probably poised to go to zero, maybe even slightly negative this year. That's what we're seeing in the upcoming fiscal year. States have exhausted their pandemic relief money, and that's already started to weigh on sort of public sector construction spending. I think employment's going to be the next leg of that.
Neil, when it comes to this administration and their pain tolerance, over the weekend, Treasury Secretary Scott Bessent, someone I know you know well, said over the long term, if we have good tax policy, deregulation, energy security, then the markets will do great. But in the short term right now, the only policy we keep getting out of this administration is tariffs. What's their threshold for how painful they're willing to take what we're seeing in the financial markets and consumer sentiment?
Well, I don't know the level of the put. I mean, I just know that it's lower than where we are now. I mean, look, I do think it's more about what they're doing, not the uncertainty around what they're doing that's driving the markets. But, you and I have talked about this, Anne-Marie. Did people not know what they signed up for? I think what we're seeing is when Trump won, everyone knew that it was some combination of tax cuts, deregulation, and tariffs. But they bet on it in that order, which is why you saw expectations for growth, at least in the first and second quarter, go up after the election. But obviously, we see what the order is. And any day that they're not talking about tax cuts and deregulation is a day they're talking about tariffs. And the signaling of that means that they're pursuing a lot of growth unfriendly initiatives first.
Neil, why do you think there was this consensus around the sequencing? Because it's very clear, if you understand Washington, that the only lever Donald Trump could pull on his own when he got into office was unilaterally tariffs.
Well, yeah, I mean, I don't know, Anne-Marie. Maybe you should get into the private sector forecasting business, because I think that was a great call. But look, I mean, not only that, I mean, any legislation was going to be a very, very tall lift as well, as you know, because the Congress was so thinly divided. I mean, I think at some level, because it's going to take them longer to get some of this tax stuff through the finish line, that's probably why one reason why they are front loading the tariff agenda.
Neil, I haven't watched it yet, but people want to know, is Krugman Dutta going to become a regular thing? Do we get a second series?
You'd have to ask Paul, but it was quite the honor to be on with him.
Neil, appreciate the input as always, sir. Neil Dutta of Renmac. Did you watch that over the weekend?
I did. You saw Neil almost fanboy a little bit in the beginning. Am I right?
Well, I mean, honestly, I understand it. It was a really interesting conversation.
Mutual respect.
That's what I was going to say.
They should come on the program together.
We should make that happen. Got to deal with something else first, though. Need to talk about the economic data. Mike McKee's back with us. Got a busy week ahead as well, Mike. That was the last big read on the US consumer going into this Federal Reserve meeting on Wednesday. When you piece it all together, Mike, what's the review? What's the conclusion of where we are right now?
Well, we seem to be on a slowing trend. The question is, how fast do we continue to slow, and how far down do we go? We get a lot of data this week that will add to the overall impressions that the Fed and the markets have after the dismal Empire number and the poor retail sales number. Tomorrow we get housing starts, import prices, which feed into that PCE number, the last piece of that, and industrial production. That's going to be interesting. What's happening with the factory sector at this point, given the consumer sector seems to be weakening? Wednesday, obviously, the Fed meeting and Jay Powell's press conference. And then Thursday, claims, we're watching that. Philly Fed and existing home sales The more important number, though, for the markets might be coming out later this morning. We get the first update of the Atlanta Fed's GDP now in about 2 weeks since they put out that negative 2.4% figure. A lot of people don't realize this is just cumulative adding up what we know for the moment, not a forecast, but it did influence a lot of people's views of the economy. And today they're going to update it with the latest data, so we'll see how that moves.
Look out for that. Like the green as well, Mike. Should have done the same thing. St. Patrick's Day. Happy St. Patrick's Day to you all out there, particularly the Irish here in New York City getting ready for that big parade. Terrible weather for it.
Yeah, well,
isn't it?
Yeah, but, that's par for the course. They'll still be happy.
That's part of being a New Yorker,
exactly.
Is it, Brower?
Yeah,
nice,
all
right.
So Irish.
Colin Martin and Charles Schwab with us now for more. Colin, good morning. Morning. Good to see you, sir. If you're in the bond market right now, I think you want a better understanding of whether you need to be focused on growth, inflation, or both.
I think both. I mean, that's really what it comes down to. The risks are kind of balanced to both right now. I don't think we're going to get too many insights this Wednesday about where the Fed is tilted. I'm sure they're going to keep it pretty open-ended. I think for now, the growth concerns appear to be more on the sentiment and consumer confidence, and we're still waiting for that hard data. Obviously, we got the number this morning. Looks like it was kind of mixed, a little soft on the headline, a little bit better on the control. So I think we'll need to start to see more hard data roll over before we get a little bit more concerned. So our guidance right now is we think ultimately the direction of interest rates is probably a little bit lower. But for now, we're not making a big bet about that because I think a lot of it does rely on the hard versus soft argument.
For much of this year, the bond market appeared to be more focused on downside risk to growth versus upside risk to inflation. Neil Dutta was with us just moments ago, and he's highlighted the anxiety that's rising around the labour market. And for that reason, I think economists at the moment say that should dampen any concerns around second-round effects from tariffs. If you're worried about your job, you're not going to your employer and asking for a raise. You're not going to see that get away from you. You should go to your employer and ask for a raise. I'm just throwing that out there. But anyway, that seems to be the conclusion right now. Is that the right conclusion?
I think so. The labor market is still relatively strong, but there's a but. That's kind of how I'm looking at it right now. Most of the data supports a relatively strong market. The unemployment rate's still relatively low. We're seeing employment gains, but they've slowed down. I think that's a big part. We've seen the participation rate tick down a little bit. JOLTS is kind of mixed. We saw a little tick up in quits data. That's something we look at about if you're asking for a raise, are you willing to move to another job? So that is something that's important, but you hit the nail on the head. If you're worried about your job and you have this anxiety about what's going to happen because of all the political uncertainty right now, what that translates to business from a high level, that's going to impact our spending habits. So I think that is important right now. Right now, things are looking pretty good, but there are pockets of weakness on the edges.
So how can inflation continue if people are concerned about spending? And it sounds like a pretty basic question, but there's this argument that if you have a one-time price shift with tariffs, they don't actually translate into higher inflation longer term, just because if you dampen demand, well, guess what? You don't have that kind of inflation.
Yeah, that's right. That would dampen inflation to a degree. And also when we look at the tariffs, one-off price change versus potentially a sustained increase in prices. We do think the tariffs should be a little bit inflationary, but you're right that if we get some slower growth there, we get a lot of uncertainty, especially on the business level. If we get this on again, off again tariffs, that slows down activity, and maybe inflation doesn't accelerate the way that it would have minus all that anxiety. But we still think inflation is going to be sticky. It's hard to see it come significantly lower given all the things we're seeing right now, especially with tariffs.
How complicated is the situation in terms of U.S. rates when you have rates globally in the developed world going up on the heels of fiscal spend elsewhere?
Yeah, very. It complicates the issue. When we look at the global markets, one thing we've looked at for a while is just that yield advantage that the U.S. offers. And it's still relatively wide right now, but it's come down a little bit. But you also have to factor in the dollar. And if we're seeing other yields rise across the globe, we've seen a weaker dollar lately, that can impact how attractive global investments could be. So it is something we're looking at right now, but it also complicates the issue here in the U.S. All these things, we just see a lot of volatility right now. So the guidance we're providing is to not make a crazy move in either direction. We're not super short duration. We're not super long duration. We're really just at your benchmark duration until we get more clear signs that either growth is slowing significantly or inflation is reaccelerating.
I feel as though the message has been clear from the Treasury Secretary, though, in terms of this is a transition. He also, over the weekend, did not rule out, say there's no guarantees that we can't have a recession. Are they preparing America potentially for this quote unquote transition, aka maybe a recession?
They could be. I mean, they are laying the breadcrumbs out there for what we could expect. I think given where we were coming into the year, valuations were pretty stretched across the board, whether it's equities. I'm not an equity guy, but I know that PEs are relatively high. But we saw that in the credit markets also, very low credit spreads. So a natural correction can be considered healthy. I think the swiftness is what's capturing a lot of investors' attention, and will it be prolonged? I think it's easy to say that now when we're down, 10% or less with stocks and the rising credit spreads. It was sharp, but they're still low. If we see that continue and that 10% decline in equities becomes a 20% decline, maybe that message changes a little bit.
Do we see the Fed chair potentially dangle a rate cut?
I don't think so. They want to stay as apolitical as possible. So I think they'll lay out kind of the dual risks they have. I think they won't mention it in this statement, I'm sure, but Powell will get the question about all the uncertainty, the political uncertainty we're seeing, and how that's playing into their outlook, especially inflation expectations. I mean, we saw the jump with the University of Michigan last week. I don't know how much they weigh that versus market-based, but there's so many different indicators out there. You can't ignore that jump that we saw in that 5 to 10 year inflation expectations, highest since I think the early 90s or so. So they'll try to stay away from the political fray, but they clearly have to be considering these potential outcomes as they're coming up with policy.
One of the biggest reasons we pay attention to you, Mitch, is because they do. They responded to it so quickly in the rate hiking cycle of a number of years ago.
That's why the most interesting move on Friday was not stocks selling off in the heels of some sort of negativity. It wasn't necessarily long-term bonds selling off in terms of long-term inflation expectations. It was the short end on expectations that the Fed would have to respond to the University of Michigan sentiment inflation survey and not cut rates more quickly.
It was easy to stand on the sidelines and say you don't want to talk about policy when there wasn't any policy. There's some policies now. We've got some tariffs. They've got to respond to that in the news conference on Wednesday.
They have to answer the question, are they inflationary? Are you modeling into your base case that this is going to structurally be more inflationary? And do you have to fight that with Fed policy at a time of weakening growth?
Get them to say the transitory word in the news conference.
That's not going to happen.
Yeah?
Is that what you're going to go for?
I'm not going to be there. Mike will be. Colin, it's good to see you. Appreciate it. Thank you. Colin Martin there of Charles Schwab. Equities just turning positive as we inch closer towards the opening bell. That opening bell about 42 minutes away. Equities up by about 0.1%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. President Trump says that he will speak to Russian President Vladimir Putin tomorrow, pressing for an end to the war in Ukraine. Trump says they will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the popular app ahead of next month's deadline. And in sports, Newcastle upset Liverpool to win the Carabao Cup final 2-1. It's the Magpies' first domestic trophy in 70 years and their first overall since 1969. Elsewhere, the Players' Championship is headed for a 3-hole playoff after Rory McIlroy and J.J. Spaun tied in yesterday's play. McIlroy is looking to secure his 28th career PGA Tour victory. And that's your brief. John.
Danny, thank you. Thanks for this morning. I think that playoff begins in about 11 minutes' time, so I'll be at my desk watching the golf.
How do you know? I have no idea.
Here so quickly.
I know.
Can I just take a beat? Congratulations to Newcastle fans. If you're not familiar with Newcastle fans, genuinely, they are some of the best fans on the planet. Win or lose, they sell out that stadium every single week they play at home. I couldn't be happier for you all. Just absolutely fantastic.
And that game made people also want to be a Newcastle fan because they played really well, and Liverpool, not so much.
I remember the Christmas holiday period going back years. OK, there was a game in the Midlands, West Brom versus Newcastle. It's freezing. OK, behind the goal, Newcastle fans, shirts off in the freezing cold. And they travelled down from Newcastle, which must be like a 5-hour drive or something. Absolutely ridiculous.
Is it passion? Is it crazy?
I think it's a little bit of both. It's a little bit of both. Congratulations to you all. Up next on the programme, let's set you up for the day ahead. That's around the corner from New York. This is Bloomberg. Equity futures turning positive briefly. Equity futures just about positive on the S&P and up 0.2 on the Nasdaq 100. So we count you down to the opening bell. Here's the trading diary for the week ahead. On Tuesday, President Trump speaking with the Russian leader Vladimir Putin. Wednesday, a Bank of Japan rate decision. Then at 2 p.m., it's the Fed's turn, followed by a Chairman Powell news conference later that afternoon. On Thursday, a Bank of England rate decision plus another round of jobless claims and earnings from Nike and FedEx after the closing bell. Joining us now for some final thoughts, Bloomberg's Tyler Kendall down in Washington, D.C. Tyler, welcome back. That call coming up in the next 24 hours. How high are the stakes?
Oh, well, incredibly high, John. And of course, it comes on the heels of Anne Marie's scoop that Special Envoy Steve Witkoff was in Russia last week negotiating face-to-face with Vladimir Putin. Now, President Trump has said that he feels that this could be a chance for some very good progress and that he has the potential to potentially announce a deal after that call. He previewed that land territory will be one of those big concessions that we are going to look for. Also saying that energy infrastructure as well as power plants are something that they are trying to figure out the path forward here. National Security Advisor Mike Waltz over the weekend saying that they know all the components for the deal. Now they are just trying to hammer it out.
Tyler, you've got to lean against the wind and tell me you need to seek shelter. You make it really dramatic. Got to make it more dramatic than it is. Tyler, I appreciate it. Tyler Kendall down in Washington, D.C. Stay safe. The weather's been absolutely brutal over the last few days.
I think there was plenty of inherent drama there. You could hear the cans kind of blowing behind her and her hair.
The North Lawn can get very dramatic, especially when they bring out the lawnmowers as well, not just the wind.
That's about as dramatic as it gets for a reporter in the White House, eh?
Well, I don't know about
the
that.
lawnmowers coming out first thing in the morning.
For a broadcaster, it's a little dramatic.
All right, coming up tomorrow, let's get to the lineup. Peter Chi of Academy, Kit Jukes of SocGen, Tom Becker of BlackRock, Stephanie Roth of Wolf Research, joining us to break down the first day of a two-day meeting for the Federal Reserve. It will conclude on Wednesday, and it's going to be a fascinating one. This White House is not blinking, will Chairman Powell.
At a time when you have inflation expectations that are climbing, a lot of people aren't expecting that. Do they expect higher inflation and slower growth going forward? And how do they message that?
Look out for those forecasts on Wednesday afternoon. Live from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
we're doing pretty well, I think, with Russia.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we begin this morning with the latest on the war in Ukraine. President Donald Trump is expected to speak today with Russia's Vladimir Putin. The U.S. is pressing for Russia to agree to a 30-day ceasefire that Ukraine has said it's ready to accept. However, Putin has insisted on a number of conditions before committing to any truce. Speaking to reporters, President Trump sounded a positive note on the prospects for the call.
It's a bad situation in Russia, and it's a bad situation in Ukraine. What's happening in Ukraine is not good, but we're going to see if we can work a peace agreement, a ceasefire and peace, and I think we'll be able to do it.
The news website Semaphore is reporting that the White House is considering recognizing Crimea as Russian territory in a future agreement.
Well, Nathan, Trump has already sparked concerns that he may sacrifice Kyiv's interests in a deal after his comments over the weekend that the U.S. and Moscow are already talking about, quote, dividing up certain assets. Julie Norman is a professor at University College London.
Obviously, there's this discussion now of a 30-day ceasefire. Ukraine has agreed to it. Putin has not said no, but has certainly said there are going to be major conditions and things he wants to discuss. We heard from Trump's envoy over the weekend that they're moving closer to some kinds of agreement. But I think what's really going to be on the table is what does Putin actually want and how willing is Trump to essentially give it to him.
University College London professor Julie Norman, European leaders have made no secret of their concern that Trump may concede on points that could weaken both Ukraine and Europe's security in a one-on-one exchange with Putin.
And along with that exchange, Karen, President Trump says Chinese President Xi Jinping will visit Washington in the not-too-distant future. The Wall Street Journal has reported U.S. and Chinese officials are discussing a possible birthday summit between the two leaders in June. Talks are currently stuck at low levels. China has said it hasn't gotten clear steps on what to do about fentanyl to have tariffs lifted.
Well, Nathan, we have new developments in the war in the Middle East. Israel has launched a series of airstrikes on Gaza, effectively ending a nearly 2-month ceasefire. Israeli Prime Minister Benjamin Netanyahu says his government will go after Hamas with increasing military strength for failing to release the remaining hostages. We get more from Bloomberg's Dan Williams in Jerusalem.
Really, this resumption of fighting was just a matter of time. There may be an element of tactical surprise here. Indeed, Israeli public opinion was largely diverted in recent hours by internal discussions about the fate of Israel's Shin Bet security chief, his termination. It could be that discussion was actually meant to provide a smokescreen for the resumption of these Israeli attacks.
Bloomberg's Dan Williams reports Hamas still holds about 60 Israeli hostages. Hamas says more than 300 people have been killed or are missing in the airstrikes.
And the rising tensions in the Middle East have oil on the rise for a third straight day, Karen. Right now, NYMEX crude is up 1.2%, trading at $68.41 per barrel. As for equity markets, futures are modestly lower after 2 straight days of gains on Wall Street. More than 90% of the companies in the S&P 500 rose yesterday. Phil Orlando is chief equity market strategist at Federated Hermes.
If you're a long-term investor, I couldn't disagree with you starting to nibble here, but in terms of getting an all-out, full-blown market capitulation signal, I don't know that we're quite there just yet.
And Federated Hermes equity strategist Phil Orlando notes the Magnificent Seven did not participate in the comeback. A gauge of those mega caps fell 1.1%.
Well, Nathan, one of the Mag 7 will be in focus today. NVIDIA CEO Jensen Huang is expected to unveil more about the firm's next-generation AI chips at its annual developers conference. And Bloomberg's Tom Busby has more.
At today's annual GPU Technology Conference, CEO Huang is expected to update developers, shareholders, analysts, employees, and others on the company's next-generation Blackwell Ultra AI chip, promising in February, quote, some really exciting things to share. Also expected comments on gross margins, China, competitors, and growth. Now, this address comes at a critical time for NVIDIA, which has seen its share price fall about 11% so far this year, amid fears that the AI boom may have peaked, at least for now. Tom Busby, Bloomberg Radio.
All right, Tom, thanks. In other tech news this morning, Bloomberg News has learned Alphabet's in talks to purchase cloud security company Wiz for $33 billion. The deal would be the Google parent's largest acquisition to date and could help it catch up with Microsoft and Amazon in the competitive cloud computing market.
Well, in Asia, Nathan, consumer sentiment on the rise in China. In a new survey by Deutsche Bank, 54% of respondents say they feel financially better off than a year ago. That's up from 44% on average in 2024. 60% of respondents anticipate an income increase in the year ahead.
Well, back here in the U.S., Karen, federal agencies say they've fired nearly 25,000 probationary employees since Inauguration Day. Let's get the latest on that with Bloomberg's John Tucker. John.
Yeah, good morning, Nathan. These figures actually come from the Trump administration after they were demanded by a judge. It's the fullest accounting yet of cuts in the federal workforce. The Treasury Department fired the largest percent of its workforce at 7%. That's about 7,600 employees. Agriculture fired 6% of its employees. The abrupt firings led to lawsuits in California and Maryland, and judges ordered a slew of agencies to temporarily reinstate the employees. The Trump administration is appealing those rulings. I'm John Tucker, Bloomberg Radio.
Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. In Tokyo this morning, the Dodgers and Cubs meet for the first regular season game of the 2025 MLB season, and both will have Japanese pitchers on the mound. The Dodgers will start Yoshinobu Yamamoto, and the Cubs will go with Shota Imanaga. At the Players' Championship, J.J. Spahn put his tee shot on the 17th hole into the water, had a triple bogey. That's all Rory McIlroy needed for the victory, his second in 4 starts so far on this PGA season. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager. And this
गाइस ये नेचुरल गैस में क्रूड ऑयल में ध्यान रखना, ये मार्च का चार्ट है, अप्रैल का नहीं है, कल एक्सपायरी हो चुकी है ऑप्शन की। यहाँ पर एक सेलिंग का प्लान जरूर था, बट एक कैंडल ही सीधा ओपन इक्वल टू लो बन गई, एग्जैक्टली रेजिस्टेंस एरिया पे ऊपर चला गया। दिस कैंडल, लुक एट दिस कैंडल, इट इज ओपन इक्वल टू लो एग्जैक्टली ऑन रेजिस्टेंस। फर्स्ट कैंडल जिसने लेवल को हिट किया, ऊपर एक रेजिस्टेंस है, देखते हैं अब। बाकी इसने यहाँ पर रीटेस्ट भी कर दिया वैसे तो। ओपन इक्वल टू लो बनाया, ब्रेकआउट किया और सीधा फिर ऊपर निकल गया प्राइस। इसको अब रिमूव कर देते हैं, जरूरत नहीं पड़ेगी। दैट्स व्हाई ओपन इक्वल टू लो एंड ओपन इक्वल टू हाई कैंडल इज वेरी इंपॉर्टेंट एट लेवल्स। सपोर्ट पे जब बाइंग के लिए आ रहा है, ओपन इक्वल टू लो नहीं बनना चाहिए और ओपन इक्वल टू हाई रेजिस्टेंस पे नहीं बनना चाहिए। ओपन इक्वल टू लो रेजिस्टेंस पे और ओपन इक्वल टू हाई सपोर्ट पे। Well, weekly candle is bullish. वीकली के लिए सैटरडे को करेंगे एनालिसिस, अभी कह नहीं सकते, अभी काफ़ी टाइम है कैंडल क्लोज होने में। ठीक है, अभी तो वेडनेसडे ट्यूसडे ही है, अभी तो 3 दिन और बचे हुए हैं। सैटरडे को करेंगे वीकली एनालिसिस, बाकी लास्ट वीक का एनालिसिस देख सकते हो। फ्राइडे को किया था, सॉरी सैटरडे को किया था, वहाँ पर डिटेल एनालिसिस किया हुआ है वीकली क्या प्लान है, कहाँ पर रेजिस्टेंस सपोर्ट मिल सकता है मार्च के चार्ट के अकॉर्डिंग, क्योंकि एक्सपायरी भी हो जाएगी फ्यूचर की अप्रैल की कल, तो अप्रैल की नहीं करिए, मार्च की करिए सिर्फ। लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया स्ट्रीम को, डोंट फॉरगेट टू लाइक द स्ट्रीम। थोड़ा मोमेंटम डल जैसा हो गया है, कैंडल को देखोगे फॉरेक्स की कैंडल थोड़े वॉल्यूम में है, बट एमसीएक्स की कैंडल में वॉल्यूम ही नहीं लग रहा है। यहाँ पर एक रीटेस्ट के लिए प्राइस को आना चाहिए, क्योंकि नीचे सपोर्ट वाला ब्रेक हुआ है। एक रिस्क लें क्या यहाँ पर क्रूड ऑयल में 15 पॉइंट के एसएल के साथ फॉर रीटेस्ट, वैसे थोड़ा और ऊपर आ जाए तो बेस्ट है। एक यहाँ पर जो रेजिस्टेंस था इसका ब्रेकआउट हो गया ओपन इक्वल टू लो बना के, इसका रीटेस्ट मार्केट को करना तो चाहिए। अब दो चीज़ हो सकती हैं, या तो रीटेस्ट करने आए या फिर डायरेक्टली रेजिस्टेंस पे चला जाए।
The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style. The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style.
From the heart of where innovation, money, and power collide, in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Tim Stenivek in San Francisco. This is Bloomberg Technology.
Coming up, all eyes on NVIDIA as the tech community gears up for the company's GTC conference this week. We'll discuss what investors expect. Plus, our conversation with FTC Chairman Andrew Ferguson on how it's prioritizing big tech. And 2 NASA astronauts will soon return to Earth aboard a SpaceX Dragon capsule after more than 9 months stuck in space. But first, we return to this particular area of the world, and we're checking on the markets. We're off by 0.1% on the Nasdaq 100. We've been flip-flopping between gains and losses, but ultimately underwater after what had been a stellar rally on Friday. But the points drags to the downside are significant. You've got Tesla, Apple, Amazon, Broadcom, Meta, MicroStrategy, Google, but NVIDIA a key one as well. The biggest points drag on the day, off by some 28 points, dragging the Nasdaq 100 lower, as we see NVIDIA just seeing a little bit of cautious trading, of course, ahead of the all-important GTC event this week. What can Jensen Huang articulate to steady nerves? We're currently off by 1.8%, Tim.
Well, as you mentioned, NVIDIA shares are lower. The company kicking off its annual GTC conference this week. Investors are focused in on CEO Jensen Huang's keynote set to be delivered tomorrow. For what we can expect, Bloomberg's Carmen Reinecke joins us now. Carmen, good to see you. What does Jensen need to do tomorrow? What does he need to tell investors to show that earnings haven't peaked and growth hasn't peaked?
Yeah, those are really the key things. I think what investors are looking for is that demand is good, that they're seeing people wanting to buy, the next iteration of chips, their Blackwell, and that ultimately NVIDIA sees a ton of growth ahead, that they're, still at the forefront of the AI trade, that they're seeing things that are good, that there's growth in the future.
My question, though, is what more can he say that he didn't get across in his earnings? He tried to talk about that future, about the next scaling laws that are upon us, but it didn't refuel, regalvanize the trend higher for the stock.
I think that's a really good point. I think something that investors are looking for is maybe more information on the macro level. I think that they'll potentially be looking for anything that can be said about China, the impact there. And I think that there are also things outside of just chips that investors might be looking for. Hearing Jensen speak about things like robotics and, autonomous driving and other parts, just of the overall market where NVIDIA chips could be used. I mean, healthcare. There are just so many instances in which AI could benefit different sectors and companies. So I think that very future sort of view is something that people are really looking for. And we might also get, a little bit more information on gross margins. That was something that was, very top of mind for investors coming off of the earnings. And so any clarity or optimism that Jensen could give there may also really lift the stock.
We thank you, Carmen Reinecke, on all things NVIDIA. Can he vindicate the valuation? Let's talk about these valuations and broader tech markets. Tiffany Wade is with us, Columbia Threadneedle Senior Portfolio Manager. And we try to take stock of the sell-off that's already occurred, that we've seen tumbling 10% so far this year, for example, like an NVIDIA, but we're trading at 26 times future earnings. Are these valuations more attractive yet, or are we still trying to catch a falling knife?
I think we're starting to see the valuations for certain stocks are more attractive. If you think about Nvidia, for example, it's trading significantly cheaper than where it has been for the last couple of years, and it's trading significantly cheaper than other parts of the market like staples while growing much faster. So there's certainly some areas of the market, certainly within tech, that have sold off quite a bit over the last couple of weeks. So we think the valuations do look attractive.
Friday's move notwithstanding, but we're still down significantly from all-time highs hit earlier this year on the major indices. Do you think this is the end of the pullback, Tiffany, or is there more room to move lower?
I think we're getting close to the end of the pullback, at least for the short term. So I think, in the near term, we might be able to see a bit of a bounce in the market. But in order for us to see sort of longer term sustainability of that bounce, I think we need to see some resolution of policy uncertainty right now.
Many wondering when we might get that. And that certainty doesn't seem to be bothering, ultimately, the administration in terms of giving that to the markets, at least. What does, therefore, a long-term investor decide when it comes to China, for example, at the moment, and whether or not you want globally focused stocks or whether you want actually US focused stocks right now?
Yeah, I think you need to focus on the fundamentals of the names. What are the opportunities for the stocks? Certainly within the U.S., outside of the U.S., there's a lot more enthusiasm for stocks that are based in Europe right now. But I think we need to focus on the fundamentals, even with the policy uncertainty, and look through some of this to what the longer-term picture is.
Fundamentals, many would say, haven't changed in the last few weeks, despite the never-ending, ceaseless sell-off. So, from your perspective, has it been just weighed out this sort of volatility? And what fundamentals do you try and focus in on?
Yeah, I think companies are seeing a bit of a change in the fundamentals if we do see tariffs being enacted. Right now, a lot of companies are kind of sitting on their hands for the year, waiting to see what the policies will be and how those might impact their costs for the year. So I think there's a lot of waiting and seeing in terms of companies deciding how to deploy their budgets for the year. But you're right. I think for the most part, the fundamentals haven't changed. What could cause a change in the fundamentals is if we see a very long, drawn-out period of policy uncertainty that leads to lower consumer spending, lower corporate spending, which then impacts economic growth.
Okay, so let's talk a little bit about that, Tiffany, because this administration doesn't seem that bothered about this sell-off. Scott Bessent said as much yesterday, President Trump saying as much the weekend before. Are you confident that this administration can implement these pro-growth policies that it keeps talking about? It's saying to investors essentially, patience, patience. When we figure out tax cuts, when we push those through, when we get companies to start making stuff here in the U.S. again, everything will be fine.
I do think that we see policies out of the administration that are potentially pro-growth and are balancing some of the other policies like higher tariffs that might impact, pricing, inflation, and consumer spending. But again, I think it comes down to the uncertainty around tariffs, DOGE, some of the other policies. And if we can get some certainty, then I think we see a resumption of consumer and corporate spending. And companies, for the most part, have plans on how they would offset tariffs, which might impact some consumer pricing. But overall, I think the consumer is still strong. So I really think it comes down to that uncertainty, which is causing a lot of consumers and corporates to be on hold for the moment.
Okay, so it raises the question of the Federal Reserve and what the Federal Reserve will do this week. Of course, the policy meeting kicking off tomorrow. We'll hear from Jay Powell on Wednesday. What's the needle that he actually has to thread in providing an outlook and communicating for the remainder of the year what Fed policy looks like?
Yeah, I think there's a chance that we see some changes to Fed policy, maybe some lower rates in the second half of the year. But for right now, there's still a lot of indicators that the economy is still strong. And that inflation is, coming down, but is not yet totally tamed. So he certainly has to walk a fine line between acknowledging that we're seeing some signs of things like, higher unemployment rates, maybe some lower consumer spending in the near term. But overall, the key indicators that they look at are still not indicating that it's maybe time for them to move in terms of policy quite yet.
Tiffany, I remember back in November of last year, when we knew the administration was going to be new but hadn't come in, you were articulating how you thought really tariffs are where it's going to be the pressure point for tech, but also regulatory stances. How do you feel that this current administration feels about big tech and ultimately some of the antitrust weight that's on a Meta, on an Alphabet, on a Microsoft?
Yeah, I think it's unclear. We haven't seen a lot of regulatory changes around from this administration. I think one thing we have heard from them is that in terms of things like M&A, they want to make the process a lot smoother for companies. So that may not be helpful for the big tech names, which might be under scrutiny still for any type of M&A. But I think that they are trying to be a little bit more favorable or more helpful for companies that are looking to do any sort of corporate action by at least speeding up the process.
Tiffany Wade of Columbia Threadneedle joining us on set in New York City. Thanks so much. Well, China's internet search leader Baidu released a new AI model that articulates its reasoning in an apparent bid to regain momentum against rivals like DeepSeek. The company says its new model, called Ernie X1, excels in areas like daily dialogues, complex calculations, and logical deduction. Caroline?
Coming up, Tim, our conversation with the FTC chairman, Andrew Ferguson, on his plans for policing big tech. We just talked about it with Tiffany Wade. This is Bloomberg Technology. The FTC is not taking its foot off the gas when it comes to enforcement action. Now, that's according to its chairman, Andrew Ferguson. We sat down with him earlier today to discuss the FTC's mission under the second Trump administration and how he will approach dealing with big tech. Just take a listen.
I think if you are a big tech company, you should be getting your lawyers to give you great advice on complying with our competition and consumer protection laws. Look, I don't have a particular axe to grind within the industry, but I do think it's very important that the FTC devote its resources to the markets that Americans most frequently engage with. It's not just big tech, although that's definitely one of them. It's also healthcare, and it's protecting American as laborers. But no matter who you are, I think it's important to proceed like the FTC is a vigilant cop on the beat. We're surveying the markets. We're looking for competition problems. We're looking for violation of the consumer protection laws. And if we think they're there, we're going to go to court. But most importantly, if we don't think that there are problems, it's really important for the FTC to get out of the way. Again, one of the most consistent complaints that I've heard about the previous administration was a lack of certainty and a tendency to want to do a lot of regulating. The FTC, we're not regulators, we're cops on the beat. We police for competition problems and consumer protection problems, but we're not trying to regulate the economy. We want to create economic conditions that allow, companies to innovate, to grow, and to help lift the whole country out of this debt crisis and bring about the golden age that President Trump has promised the American people.
Talk about striking that balance, because many would say if I look at Europe, they regulate too much. There's too much enforcement. But in many ways, they're being a strict cop on the beat, some would say. So from your perspective, are you seeing over-regulation in Europe? And is there a worry about stifling innovation in the United States by the amount of focus you have on big tech right now?
Well, I do think that Europe has a real regulatory problem. It has an innovation problem. And we definitely don't want to create conditions here in the United States that suppress innovation. But I think it's important to bear in mind, monopoly suppresses innovation. Monopoly makes it very difficult for little companies with the next great idea to sort of rise. And I think it's very important, if we want to sort of preserve the American innovating spirit, that we create conditions in our economy that allow little tech, who have the next great ideas, the next life-changing ideas for all Americans to thrive. President Trump has been pretty emphatic on the importance of making sure that our economic system allows little tech to bring its ideas to market. And that's what antitrust really does, is it prevents monopoly, and monopoly stifles innovation. So if the antitrust cops are vigilant and are making sure that they're protecting us from competition problems, it allows the innovation that has made America and our economy sort of the driving engine of the whole world.
What deals do you think can get done? Is there any prescription you can give as to this M&A will look good if you are a big tech eyeing a little tech?
I think that the deals that can get done are the deals that are lawful. And I think the most important thing I want to take away from this is I see it as my job to scrutinize deals consistently with the timeline Congress created in our antitrust laws. And if we think that they are illegal and we think that we can win in court, we're going to go to court. But if we don't think that they are illegal or we don't think we can win in court, the FTC is going to get out of the way. Again, I've heard this complaint a lot from the business community that in the previous administration, a deal would enter the FTC and it would sort of disappear. And sometimes it could disappear for months while, novel ideas were floated, different theories. And sometimes it sort of seemed like the FTC was hoping that deals would die on the vine while they waited for regulatory clearance. I want nothing to do with that. If a deal is illegal and I think we can win in court, I'm going to go to court. But if it's not, we're going to get out of the way and we're going to let deals go forward. M&A is part of how the economy grows. It's an important part of fostering a system that allows for innovation and dynamism. But we have to make sure that we don't create monopoly, and I see that as my job. If we think there's a monopoly problem, then the government's going to intervene. But if not, we've got to get out of the way as quickly as possible and let the economy grow.
Does the AI space look like it's thriving? Or do you worry about monopolistic behavior there?
Yeah, I think it is extremely important that we protect competition in the AI space. But I think it is equally important that the government not race to regulate AI. Vice President Vance's speech in Europe on AI, I think, is about the perfect way to thread this needle. We got to ensure that there's competition. We got to ensure there's competition because competition promotes innovation. But we can't have the government come in with a heavy regulatory hand and stifle innovation. Again, we don't want monopoly stifling innovation. We don't want big government stifling innovation. And admittedly, that's not an easy needle to thread, but that's how I think about it is protect competition, but don't overregulate AI because that's exactly how we're going to kill the innovative prospects of AI.
You started all of this by talking about the very close look you're going to take at every enforcement action that's out there at the moment, whether you pursue it or not. But just that assessment takes a lot of labor. You've also said you've got the resources. I know everyone's been asking you about what this lawyer said in court last week regarding the Amazon Prime deal. And ultimately, you've been saying he was wrong, and they came out and said that, no, we do have enough resources, even though he said there's an extremely severe resource shortfall in terms of money and personnel at the FTC. Have you got the right amount of people, and how are you living up to DOJ's necessities to slim down?
Well, I didn't say that the lawyer was wrong. The lawyer said the lawyer was wrong. He filed something almost immediately after his statement to the court explaining we don't have the resource constraints that he thought. We don't have resource constraints. I've said from day one we've got the resources to litigate these cases. That remains true. But I also want to be clear. I think that the president's efficiency agenda is one of the most important things going in government right now. Government should not be any larger than necessary to deliver the services and protections that the American people deserve. And at the FTC, look, we're a lean operation. Our budget is less than $500 million. We've only got around 1,300 employees, and we deliver a lot of value for the American people. But we have got the resources we need to deliver on our competition mandate, our consumer protection mandate. But we're always looking to be as efficient as possible.
Well, there you have it. FTC Chairman Andrew Ferguson in his interview with Caroline Hyde just moments ago. Andrew in a very festive tie for the holiday, I should know. Let's stay in Washington to break it all down with Mike Shepard. Hey, Mike, what are investors learning at this point about any daylight between a Lina Khan-run FTC and an Andrew Ferguson-run FTC? What are the differences that are emerging?
Well, one of the differences that became clear in this interview is the speed with which he is promising to move and the decisiveness he said he will try to bring. He faulted the prior administration, the Biden administration, and the prior chair of the FTC for perhaps moving too slowly in deciding on some of these enforcement actions and whether to intervene to block a deal. Sometimes companies would be left hanging for months, uncertain about whether their transaction, their proposal would actually win the commission's blessing. And what he says, look, we'll try to give a thumbs up or thumbs down much more quickly and much more decisively so that there is uncertainty removed from the equation. And he also made clear that, look, we are going to proceed with a number of these enforcement cases against big tech. Little tech is responsible for a lot of the innovation that we see in the economy, and the competition cases that are now really hitting their stride against Google, against Meta, that are in court now, those were brought during Donald Trump's first administration. And he warned, as we heard very clearly, lawyers for some of these big tech companies should be ready to make sure that they are complying with competition law.
Some of the concern regarding just the sheer scale of big tech has been around artificial intelligence. It's interesting that here in New York, it looks as though the governor, Kathy Hochul, wants to cross the divide at the moment, Mike, wants to work with the administration when it comes to the AI action plan. Just talk us through what we're starting to see on a bipartisan nature.
Well, it was interesting to see her weigh in so quickly with New York State's vision for how the AI plan that is being pulled together by Donald Trump's AI czar, David Sachs, at the White House with a June deadline to pull this new vision for AI policy together. She is the first governor to put in a state's vision for how that plan should come together. She called for a couple of things. One, encourage adoption of AI across the board more widely in industries. Two, do more to revise intellectual property protection laws so that there is less of this uncertainty surrounding all the data that these large language models need to be able to run and to be able to work and to train. And then three, the energy question. This is one we've talked about so much here. They're even talking about nuclear energy. And there's a lot at stake for New York because Micron is building those big factories that got CHIPS Act money upstate, and they want to make sure that New York is getting a piece of the action here.
Bloomberg's Mike Shepard. We thank you so much. The latest from Washington now coming up. Klarna officially files for an IPO and it dethrones a firm to become a Walmart partner. More on that next. This is Bloomberg Technology.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Payments firm Klarna. It's filed publicly for a U.S. IPO, showing the company's revenue jumped 24% last year. The company also today announcing that it will be partnering with Walmart to offer buy now, pay later to more U.S. shoppers. It's actually replacing Affirm as the retail giant's fast credit option. For more, Bloomberg's Bailey Lipschultz joins us now. I go to today's news, because this is quite an upending of the relationship for Affirm, right?
Yeah, it's a big change. And as you can see, Affirm down more than 10% this coming. The company announcing in a statement that Walmart alone accounts for about 5% of its gross merchandise volume and about 2% of its adjusted operating income. So pretty sizable chunk, not quite the size of an Amazon or Shopify, but obviously a big move for Affirm. And obviously, if you're Klarna, announcing this right after you launch your IPO or file for your IPO publicly is kind of big news.
On that IPO, Bailey, what took Klarna so long? I mean, this is a company that is almost as old as Facebook.
Trying to get it right, Tim. When you look back, this is a company that at one point was valued magnitudes higher back in 2021, SoftBank cutting a sizable check and ramping up its valuation. More recently, private valuation around $14.6 billion. So trying to right-size the operations, trying to grow back into that valuation. Even if you look at Affirm, this is a stock that's up 32% on a trailing 12-month basis, trading around $45. Just last month, it was north of 80. So a lot of volatility. And as much as a Klarna management team will want to pitch you on different kind of offerings and diversification, at the end of the day, the buy side is going to directly compare this company to Affirm, who is still well below the peak that it hit back in 2021 when it was trading for $169 a share.
Swedish founders coming to the U.S. Very briefly, Bailey, anything worrying in that IPO listing?
Not really. Nothing jumped out completely. It is interesting. They have three classes of stock. So we're trying to get a better understanding of what that means, what that could look like, and kind of how that's going to impact the path forward. But the typical kind of red flags and words of caution were kind of what you would expect.
Bloomberg's Bailey Lipschultz. Thanks so much, Bailey. Well, coming up next, a new partnership aims to bring flying taxis to British skies. We're going to have the details next. This is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York.
And I'm Tim Stenovec in San Francisco.
Check in on these markets, Tim, because we are flip-flopping between gains and losses. The Nasdaq 100 currently off by about 0.1%. Now, we got retail sales that weren't too ugly, but they weren't great. And ultimately, we're still trying to work out after Friday's push higher, can we sustain any sort of built-in risk-on attitude? Not in big tech, I have to say. Nvidia is pulling us lower from a points perspective, but so too is Tesla. Drill into what's happening on the next board, because Tesla is off by 40% year to date thus far. Mizuho slashing its price target for this company, once again reaffirming some of the key concerns we've got across the company. We're worried about China sales, European sales, US sales. We're worried about ultimately a long-term AI vision not being timed to the here and now of really how many cars are going to be sold under Elon Musk. We're looking at BYD, and I compare and contrast. BYD is up 2%. They're saying they're going to have EV charging at just 5 minutes. That would be a big game changer for me and my EV. But Tim, we're seeing once again BYD up 50% year to date on its overall US depository receipts, whereas Tesla is off by 40%. What have you got?
5-minute charging, that's like almost as convenient as a gas station. So we'll see if that actually comes to fruition. Well, two NASA astronauts, Butch Wilmore and Suni Williams, will soon return to Earth after SpaceX's Dragon capsule successfully docked with the International Space Station early Sunday morning. The two astronauts spent over 9 months in space following a series of unexpected events and technical issues with their original spacecraft. For more, Bloomberg's Bruce Einhorn joins us now. Bruce, this is as much about SpaceX as it is about Boeing and its Starliner capsule. What does this mean for Boeing moving forward?
Yeah, I'm sorry to jump in there. So there are a lot of questions about Boeing's space program following what's happened here. So, of course, Butch and Sunny, they went up on the Starliner capsule. They were supposed to be there for only about a week. They've been there for quite a lot longer. The Starliner did return to Earth without them, but there were concerns about the safety of it. And a lot of questions remain about just whether that's a program that has a future.
Take it back to the success that this shines on SpaceX, Bruce. Yes, they were slightly delayed, but ultimately they're the ones that have to be depended on from a U.S. government perspective right now.
That's all there is, really. The U.S. currently has two ways of getting people to the space station. SpaceX's capsule and Starliner, but Starliner is not really an option right now. So it's really just SpaceX. The only other way to get people to and from the space station is aboard a Russian Soyuz rocket. But as far as U.S. capabilities, it's just SpaceX. There are others that have either already had cargo flights or plan on having cargo flights. But as far as getting astronauts to and from, it's SpaceX with essentially a monopoly now, given that Boeing Starliner is questionable at best.
Bloomberg's Bruce Einhorn, we thank you. Much celebration for those returning astronauts, I'm sure, a little bit later. Meanwhile, electric air taxis could soon be on the horizons of London and Manchester. Joby Aviation and Virgin Atlantic have announced a partnership to launch an air taxi service in the United Kingdom. Let's bring in the CEO of Joby, Jobin Vivat. And Jobin, how soon am I going to be able to fly back to the UK and hop on one of these Jobys?
It's just a few years out, Carolyn. We're so excited to be announcing today our partnership with Virgin. Virgin has an incredible dedication to customer service that matches with our own. In addition, Delta is one of Virgin's largest shareholders and an incredible partner for Joby. And so this is really a match made in heaven, and we're so thrilled to be announcing it and really using it to help catalyze the development of takeoff and landing locations, both within London and across the UK, which is going to bring this service to market. So just within the next few years, we're so excited to be bringing the opportunity for Virgin customers across the UK to fly on our air taxis.
Would Virgin and indeed Delta actually buy some of these aircraft, or are they just helping promote them?
So we're going to have Virgin customers. We're going to give them the opportunity to book a Joby air taxi flight on the Virgin app, on the Virgin website, and to be a key demand funnel alongside our partners at Delta and Uber in driving to put passengers and fill the seats of our air
So
taxis.
it's marketing. They're not actually going to be committing to purchase one.
Correct. It will be Joby owning and operating
Got
the
it.
service in the UK, much like we do in the UAE and Dubai and in New York and LA.
Jobin, what is the main thing holding us back right now from flying in these to the airport in the US and the UK at this point? Is it regulators?
So we're making record progress on certification. This last quarter, we announced that the FAA had made record progress on their side. Joby is really leaned in and delivering day after day on the component system and aircraft level testing. We're testing more components, building FAA conforming components and testing FAA conforming components. So we're really thrilled with the momentum we're seeing on that side. We're seeing incredible lean in from the administration, from the DOT, from the FAA. And we also had UK CAA regulators here in California with us, beginning the preparation work for the validation of our FAA certification. So fabulous progress across the board on the certification front.
How has your relationship with the FAA changed with this administration?
As I said, really seeing a lot of lean in. The administration has made air taxis a very high priority, and that also is going to roll into the build out of infrastructure. And we view these vertiports, the takeoff and landing locations that you can fly from, as being a critical enabler to delivering really spectacular customer experiences. And so we're very grateful for the administration and the priority that they're putting on building new takeoff and landing infrastructure.
And how about, at the moment, me as a consumer might be able to get on one in 2026, I believe your new timeline is. But defense, how are you working with the Defense Department at the moment, potentially seeing eVTOLs in that particular area?
We've had an incredible partnership dating back to 2016, and this is a critical accelerant to all of our work. The DoD has been a fabulous first mover, and that continues. We delivered our second aircraft to Edwards Air Force Base, and so now we're thrilled to have both of those aircraft flying, building really valuable flight test experience, and we see that as just the beginning to incredible opportunities for vertical takeoff and landing aircraft on the defense side. The DoD gave us provided us with funding, which enabled the demonstration of our 561-mile flight this last year of our hybrid aircraft, and so we're just thrilled to be seeing such incredible momentum on the DoD side for this industry.
Joby CEO JoBen Bevirt joining us from Santa Cruz. Thanks so much for joining us today. Do appreciate it. Well, coming up, Zoom's Chief Product Officer, Smita Hashim, joins us to discuss the company's updated AI agents. That's next. This is Bloomberg.
Let's talk about AI spending, because resources are going to continue to be increased by hyperscalers. In fact, we're expecting them to increase by 44% this year, top $500 billion in the early next decade. That's according to a new report out today from Bloomberg Intelligence. For more on what's actually driving the spending spree, let's bring in Bloomberg's Seth Fiegerman. And look, there was a worry about DeepSeek and some of these much more efficient and ultimately cheaper, less powerful models coming to bear. And we don't seem to need to worry about it. Hyperscalers are still going to flood the system for data centers, for infrastructure.
Business as usual. If anything, it's the opposite issue. Now we're seeing DeepSeek and the attention to it being kind of a catalyst here for the tech companies to say, well, we want to invest more to develop this technology, and specifically around inference. So I think a lot of the investment to date has been around training, building the models. But now with reasoning systems like DeepSeek's, there's more investment in how they operate after they've been trained. And if you're an investor right now, maybe the silver lining is more of that spending shifts to after the model has been developed and deployed.
But Seth, won't reasoning become more efficient as well? We'll be able to do more with less?
One would hope, although we're trying to build more sophisticated reasoning models, so TBD on that front. But I think the idea is as this gets developed at scale, deployed not just in the US, but abroad, you're going to see the amount of money that goes into inference to support reasoning really shoot up in the coming decade and really make up a much larger percentage of the whole.
So let's just go back to the anxiety that reporting of Microsoft pulling back on leases of data centers sent shockwaves through the market after we, of course, got the efficiencies of DeepSeek. That's not going on. We're still seeing an ever-scaling amount of money going into infrastructure.
Yeah, I mean, at least according to the Bloomberg Intelligence report, the pace of growth is actually greater than they had previously expected before DeepSeek and the shift towards reasoning models. So, again, business as usual to some extent, more investment in data centers, more in chips.
The tech community gears up for the company's GTC conference this week. We'll discuss what investors expect. Plus, our conversation with FTC Chairman Andrew Ferguson on how it's prioritizing big tech. And 2 NASA astronauts will soon return to Earth aboard a SpaceX Dragon capsule after more than 9 months stuck in space. But first, we return to this particular area of the world, and we're checking on the markets. We're off by 0.1% on the Nasdaq 100. We've been flip-flopping between gains and losses, but ultimately underwater after what had been a stellar rally on Friday. But the points drags to the downside are significant. You've got Tesla, Apple, Amazon, Broadcom, Meta, MicroStrategy, Google, but Nvidia a key one as well. The biggest points drag on the day, off by some 28 points, dragging the Nasdaq 100 lower, as we see Nvidia just seeing a little bit of cautious trading, of course, ahead of the all-important GTC event this week. What can Jensen Huang articulate to steady nerves? We're currently off by 1.8%, Tim.
Well, as you mentioned, Nvidia shares are lower. The company kicking off its annual GTC conference this week. Investors are focused in on CEO Jensen Huang's keynote set to be delivered tomorrow. For what we can expect, Bloomberg's Carmen Reinecke joins us now. Carmen, good to see you. What does Jensen need to do tomorrow? What does he need to tell investors to show that earnings haven't peaked and growth hasn't peaked?
Yeah, those are really the key things. I think what investors are looking for is that demand is good, that they're seeing people wanting to buy, the next iteration of chips, their Blackwell, and that ultimately NVIDIA sees a ton of growth ahead, that they're, still at the forefront of the AI trade, that they're seeing things that are good, that there's growth in the future.
My question, though, is what more can he say that he didn't get across in his earnings? He tried to talk about that future, about the next scaling laws that are upon us, but it didn't refuel, re-galvanize the trend higher for the stock.
I think that's a really good point. I think something that investors are looking for is maybe more information on the macro level. I think that they'll potentially be looking for anything that can be said about China, the impact there. And I think that there are also things outside of just chips that investors might be looking for. Hearing Jensen speak about things like robotics and, autonomous driving and other parts, just of the overall market where NVIDIA chips could be used. I mean, healthcare. There are just so many instances in which AI could benefit different sectors and companies. So I think that very future sort of view is something that people are really looking for. And we might also get, a little bit more information on gross margins. That was something that was, very top of mind for investors coming off of the earnings. And so any clarity or optimism that Jensen could give there may also really lift the stock.
We thank you, Carmen Reinecke, on all things NVIDIA. Can he vindicate the valuation? Let's talk about these valuations and broader tech markets. Tiffany Wade is with us, Columbia Threadneedle Senior Portfolio Manager. And we try to take stock of the sell-off that's already occurred, that we've seen tumbling 10% so far this year, for example, like an NVIDIA, but we're trading at 26 times future earnings. Are these valuations more attractive yet, or are we still trying to catch a falling knife?
I think we're starting to see the valuations for certain stocks are more attractive. If you think about NVIDIA, for example, it's trading significantly cheaper than where it has been for the last couple of years. And it's trading significantly cheaper than other parts of the market like staples while growing much faster. So there's certainly some areas of the market, certainly within tech that have sold off quite a bit over the last couple of weeks. So we think the valuations do look attractive.
Friday's move notwithstanding, but we're still down significantly from all-time highs hit earlier this year on the major indices. Do you think this is the end of the pullback, Tiffany?
Is more than a hotel. It's a cultural landmark, a symbol of timeless style and luxury. It's not just about expanding, it's about
Good morning. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up nearly about 0.7%. A couple of things to note. OECD reduction to growth forecast. The FOMC is beginning its two-day policy meeting. And, of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes, really, which is the amount it takes really to do the same here as far as your gas guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong, up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past two sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying, so this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage wage, protecting people's rights to paid leave. And that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime. And the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that their response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, as to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policy-making body is concerned, right? So neither the action plan nor the press conferences, to Min Min's point, actually gave you a lot of details. But all that being said, just to throw this forward, right? So according to Goldman Sachs, the two events to watch coming up will be the April Politburo meeting, as well as the nationwide childcare subsidy. So watch for that in the coming months. HSBC had a somewhat different take, fairly more bullish, fairly more comprehensive. A decisive change is how HSBC calls that as well. So it's unclear, again, to Min Min's point, how the trade policy or the trade war may evolve. But the shift to focus inward, look at domestic demand, is the best response yet. This puts more upside risk to their forecast of 4.5%. Let's bring in David Chu, of course, who's with us here on set as well, to give us their reaction to what you heard so far.
Well, yeah, if you look at the whole, for my side, I have been reading the world lifting consumption over the past decade for maybe 1,000 times. Yeah. So, yesterday when we came to the press conference and the document that he issued in over the weekend, and the Min Min has briefed it a lot, and I don't want to go through everything, but I want to say that yes, they gave some detailed and concrete ways to lift the income. So I think this makes the most difference compared with previous documents. And also, they decide that they are going to improve the social security's welfare, and also, for example, to give subsidies on no loans for children. These are all in the good direction and the correct direction in my way, in my thought. So it comes to another thing in my mind, that this is the first priority to-do thing in the government work report. If you look at it, it is the first thing in the to-do list. And last year, it was the third one. So that it tells us that for this year and maybe next year, this is the top priority for the economy policy and the policy orientation, in the government's to-do list. And we should say that this is really relevant to the economy situation. We just talked that China's economy is resilient, but I want to say it is resilient in the production side, but less resilient in the demand side. If you look at the demand side, export is facing great uncertainty because of the tariff, and the investment is dragged by the real estate sector a lot over the past 3 years. And now only the domestic consumption is the hope. It's a silver line for the economy in the demand side. So that is why it is the first top priority for this year.
The demand side problem, it would be a big shift for Beijing to really focus solely on that. But it's also very difficult, if not the most challenging sort of policy shift for them to engineer, not least very expensive. What are the key challenges here? And to what extent is this sort of stimulus package responsive to the backward-looking data that we saw for January, February? Or is this sort of a forward-looking approach, thinking about Trump, thinking about how it's going to deal with the US and global tariffs?
Yes, I think it's a more forward-looking one, because if you look at the track of the policy changes, you would see that from last year, from Q4, the government has called that the consumption is the key for the economy, and they show a strong willingness to lift the consumption. So I would say it is an outlook thing because of the uncertainty, as I said, uncertainty in the tariff side and in the export side, and also the sluggish investment side. So that, yes, it is a forward-looking thing. But the key difficulty or the key challenges is that how can we improve consumption in the short term? If we want to do it in the longer term, it would be easier because we have, for example, we can do it within 5 years or 10 years. We are lifting income of households and also to build up more social securities and such a kind of things to let people be more willing to spend. But how can we lift it in the short term? Because the external shock will take place in the short term, so that we need the consumption to offset that in the short term. So to do this, I think the fiscal side needed to do more.
Okay. Team, thank you so much. David Chu, of course, our from Bloomberg Economics, and here on set as well is Min Lo, of course, our China correspondent. Right, more on the breaking news that we've gotten in the last, let's call it 30 minutes or so. So a bit of background here before I get into the latest lines here. So earlier on, we did see some news that Israel was striking Hamas targets in Gaza. Now, more context coming through out of the Israeli Prime Minister's office commenting on that these strikes were in response to the refusal on the part of Hamas to release hostages, and that they will act against Hamas with increasing military strength. And now you can see, of course, these are live pictures coming through I believe, out of Gaza right now. So we'll keep you guys up to date and up to speed, of course, on more developments coming through. Certainly a risk to watch as we go into the thick of the trading session this Tuesday. Good morning. We're set for gains, as you can see, across these Chinese markets. So we're looking like, and we could actually be testing the recent highs in some of the Hong Kong benchmarks, and a couple of slides, we'll talk about this later, but perhaps we could see a record on that stock given just the moves overnight, right? I'm not speculating. I'm extrapolating based on the news flow and what we've seen so far. Anyway, we'll table that for now. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. Good morning and nice to see you, as usual.
Good morning.
We're trying to figure out how much the markets already discounted. Chinese markets have discounted based on all the stimulus that's been announced, and what looks optimistic and what looks maybe a bit more longer term.
Right. I don't think the Chinese market have discounted very much. If you look at the rally since January of this year, it's very clear that the rally was powered by a micro-thematic theme. It's on the back of optimism around AI. So if you look at the offshore stocks versus onshore stocks, the tech stocks versus non-tech stocks, tech stocks has fly high, but the non-tax part actually resisted very modest gains. So I think it's very clear that the market is trading on a secular micro themes, which is making the rally less sensitive to macroeconomic shocks. That's why the market is being able to power through, you could argue, a mediocre NPC, 10% additional tariffs from the U.S., and a daily dose of negative headlines coming from the U.S. almost over the past 2-3 months. So I think market hasn't really discounted that much of a policy stimulus, but AI certainly is in the market.
Okay, so what does it take to, I suppose, shift that momentum from being a micro-secular theme to something that is broader based? And is this consumption package that we've seen, even this shift to sort of the demand side emphasis, is that not enough to do it?
I think you need to see more of this. So clearly that the consumption, the 30-point consumption support package, it's a move in the right direction. It's coming on the hill, coming on the shortly after the National People's Congress, where they said that they're going to make a consumption the center of policy stimulus. So with this, 30-point plan, we're getting a little bit more details of how they're going to carry out this consumption support package. However, we don't really see all the details, right? We don't know how big this consumption plan is going to be. We don't know the implementation details. We don't have the information about who's going to pay for this consumption package. So I think this is definitely a move in the right direction. But the reason that you haven't really got the market really, really excited, the broadening of the rally and the consumption stock really fly high, it's because of the lacking of those details.
Is the lack of detail by design? And the reason I bring it up because we don't know what factors and how the economy looks in 6-12 months' time. We don't know how geopolitics looks, for example.
Sure.
In other words, is that necessarily a bad thing?
So I think last time I was on this program, I used the phrase crossing the river by filling the stones. Yeah. I think this is a very much an iterative process. They have a promise of hitting around the 5% growth target. They told you what they have told you what they're going to do in terms of stepping up a fiscal stimulus. A lot of that resources are going to be channeled into consumption and technology development. This is 30-point plan is essentially the next step of getting people comfortable with that plan. But clearly that they don't know how the external situation is going to evolve. They don't know the domestic economy is going to pan out over the coming months. So I think they are keeping the powder dry, sort of react to the additional developments coming from an internal and external arena.
So, as I understand it, correct me if I'm wrong, your view, as is sort of, we can probably say consensus in the market, is the stimulus package that was announced is just about enough, perhaps not quite enough, to deal with the tariff offset. I suppose I'm curious as to whether you agree with our Bloomberg economist who just came on saying that the issue for China is really the timeline here. They need to get consumption going in a very short period of time. They don't have a 5-year horizon. It's sort of a 1-year horizon. Do you think is the timeline issue the most pressing concern for offsetting those tariff risks?
I think both the timeline as well as the scale are both important. So if you look at the 30-point plan, it deals with some short-term cyclical issues, but it also covers the longer-term secular issues as well. On the short term, you have the consumption subsidies, you have the pledges to stabilize the labor market, stabilizing wage growth. You have quite a decisive sort of support for housing market and the property market as well as equity market to create a wealth effect for consumers. And for the longer term, you have initiatives to deal with the demographics, right? The subsidies for childbirth, child care. You have things like increasing the competitiveness of the services sector, liberalization of the services sector, and you have a lot of initiative to show up the social programs, social unemployment subsidies, recreational additional benefits. You have measures to increase education and healthcare, so on and so forth. One of the key reasons why Chinese consumers are very swift is because they don't have the government saving for them, so they have to increase the discretionary savings, and their consumptions obviously take a hit from that. If the government are saving for the households, then they can bring down that discretionary saving and increase the consumption share of the GDP.
I mean, you bring a very unique perspective here because you're both an economist, and right now, of course, you look at markets. So my question is, and I think just to build on what Rebecca was mentioning there, it's the first time in, as far as at least I can remember, that consumption is number one, right? When you come to GDP, there's consumption, there's exports, there's investment. The other two are easy, right? We can meet the target this way. So my question is, 30-point plan, the toolkit is arguably still geared towards the old economy. How do investors need to be thinking about execution?
This is very new, right? This is not the old playbook that local government, central government have been comfortable with sort of stimulating the economy. With investment and property and infrastructure-driven sort of a playbook, it's very easy. Once you throw the money, the GDP got to reflect it. I think consumption is a new model, and that's why maybe that Beijing has been hesitant in sort of moving in that direction. But I think the wake-up call is finally being sound. Right. We have seen that the consumption being center of the stimulus from the Central Economic Work Conference, from the 2 sessions, and now we actually have more concrete plans being laid out. So I think, to me, the significance of this announcement is not so much of delivering the concrete implementation details, but it's laying the groundwork and tell you the direction of travel.
More with Aiden Yao coming through as well here. Just very, very quickly, going into the open today, BYD is set to open at a record high. We're now called 406, 407, 408 rather, on the stock price right now. The bulls are out this morning. Good morning. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up just nearly about 0.7%. A couple of things to note. OECD reduction to growth forecast. The FOMC is beginning its 2-day policy meeting. And, of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes, really, which is the amount it takes really to do the same here as far as your gas guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong. up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past 2 sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying, so this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage, protecting people's rights to paid leave, and that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime, and the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that their response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, as to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well, coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policy-making body is concerned, right? So neither the action plan nor the press conferences, to Min Min's point, actually gave you a lot of details. But all that being said, just to throw this forward, right? So according to Goldman Sachs, the two events to watch coming up will be the April Politburo meeting, as well as the nationwide childcare subsidy. So watch for that in the coming months. HSBC had a somewhat different take, fairly more bullish, fairly more comprehensive. A decisive change is how HSBC calls that as well. So it's unclear, again, to Min Min's point, how the trade policy or the trade war may evolve. But the shift to focus inward, look at domestic demand, is the best response yet. This puts more upside risk to their forecast of 4.5%. Let's bring in David Chu, of course, who's with us here on set as well, to give us their reaction to what you heard so far.
Well, yeah, if you look at the whole, for my side, I have been reading the world lifting consumption over the past decade for maybe 1,000 times. Yeah. So yesterday when we came to the press conference and the document that he issued over the weekend, and the Min has briefed it a lot, and I don't want to go through everything, but I want to say that yes, they gave some detailed and concrete ways to lift the income. So I think this makes the most difference compared with previous documents. And also, they decide that they are going to improve the social security's welfare, and also, for example, to give subsidies on no loans for children. These are all in the good direction and the correct direction in my thought. So it comes to another thing in my mind, that this is the first priority to do thing in the government work report. If you look at it, it is the first thing in the to-do list. And last year it was the third one, so that it tells us that for this year and maybe next year, this is the top priority for the economy policy and the policy orientation, in the government's to-do list. And we should say that this is really relevant to the economy situation. We just talked that China's economy is resilient, but I want to say it is resilient in the production side, but less resilient in the demand side. If you look at the demand side, export is facing great uncertainty because of the tariff, and the investment is dragged by the real estate sector a lot over the past 3 years. And now only the domestic consumption is the hope. It's a silver line for the economy in the demand side. So that is why it is the first top priority for this year.
The demand side problem, it would be a big shift for Beijing to really focus solely on that. But it's also very difficult, if not the most challenging sort of policy shift for them to engineer, not least very expensive. What are the key challenges here? And to what extent is this sort of stimulus package responsive to the backward-looking data that we saw for January, February, or is this sort of a forward-looking approach, thinking about Trump, thinking about how it's going to deal with the US and global tariffs?
Yes, I think it's a more forward-looking one, because if you look at the track of the policy changes, you would see that from last year, from Q4, the government has called that the consumption is the key for the economy, and they show a strong willingness to lift the consumption. So I would say it is an outlook thing because of the uncertainty, as I said, uncertainty in the tariff side and in the export side, and also the sluggish investment side. So that, yes, it is a forward-looking thing. But the key difficulty or the key challenges is that how can we improve consumption in the short term? If we want to do it in the longer term, it would be easier because we have, for example, we can do it within 5 years or 10 years. We are lifting income of households and also to build up more social securities and such a kind of things to let people be more willing to spend. But how can we lift it in the short term? Because the external shock will take place in the short term, so that we need the consumption to offset that in the short term. So to do this, I think the fiscal side needed to do more.
Okay. Team, thank you so much. David Chu, of course, our from Bloomberg Economics, and here on set as well is Min Lo, of course, our China correspondent. Right, more on the breaking news that we've gotten in the last, let's call it 30 minutes or so. So a bit of background here before I get into the latest lines here. So earlier on, we did see some news that Israel was striking Hamas targets in Gaza. Now, more context coming through out of the Israeli Prime Minister's office commenting on that these strikes were in response to the refusal on the part of Hamas to release hostages, and that they will act against Hamas with increasing military strength. And now you can see, of course, these are live pictures coming through I believe, out of Gaza right now. So we'll keep you guys up to date and up to speed, of course, on more developments coming through. Certainly a risk to watch as we go into the thick of the trading session this Tuesday. Good morning. We're set for gains, as you can see, across these Chinese markets. So we're looking like, and we could actually be testing the recent highs in some of the Hong Kong benchmarks, and a couple of stocks like BYD. We'll talk about this later, but perhaps we could see a record on that stock given just the moves overnight, right? I'm not speculating. I'm extrapolating based on the news flow and what we've seen so far. Anyway, we'll table that for now. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. Good morning and nice to see you, as usual.
Good morning.
We're trying to figure out how much the markets already discounted. Chinese markets have discounted based on all the stimulus that's been announced, and what looks optimistic and what looks maybe a bit more longer term.
Right. I don't think the Chinese market have discounted very much. If you look at the rally since January of this year, it's very clear that the rally was powered by a micro-thematic theme. It's on the back of optimism around AI. So if you look at the offshore stocks versus onshore stocks, the tech stocks versus non-tech stocks has fly high, but the non-tax part actually resisted very modest gains. So I think it's very clear that the market is trading on a secular micro themes, which is making the rally less sensitive to macroeconomic shocks. That's why the market is being able to power through, you could argue, a mediocre NPC, 10% additional tariffs from the U.S., and a daily dose of negative headlines coming from the U.S. almost over the past 2-3 months. So I think market hasn't really discounted that much of a policy stimulus, but AI certainly is in the market.
Okay, so what does it take to, I suppose, shift that momentum from being a micro-secular theme to something that is broader based? And is this consumption package that we've seen, even this shift to sort of the demand side emphasis, is that not enough to do it?
I think you need to see more of this. So clearly that the consumption, the 30-point consumption support package, it's a move in the right direction. It's coming on the hill, coming on the shortly after the National People's Congress, where they said that they're going to make a consumption the center of policy stimulus. So with this, 30-point plan, we're getting a little bit more details of how they're going to carry out this consumption support package. However, we don't really see all the details, right? We don't know how big this consumption plan is going to be. We don't know the implementation details. We don't have the information about who's going to pay for this consumption package. So I think this is definitely a move in the right direction. But the reason that you haven't really got the market really, really excited, the broadening of the rally and the consumption stock really fly high, it's because of the lacking of those details.
Is the lack of detail by design? And the reason I bring it up because we don't know what factors and how the economy looks in 6-12 months' time. We don't know how geopolitics looks, for example?
Sure.
In other words, is that necessarily a bad thing?
So I think last time I was on this program, I used the phrase crossing the river by filling the stones.
Yeah.
I think this is a very much an iterative process. They have a promise of hitting around the 5% growth target. They tell you what they have told you what they're going to do in terms of stepping up a fiscal stimulus. A lot of that resources are going to be channeled into consumption and technology development. This 30-point plan is essentially the next step of getting people comfortable with that plan. But clearly that they don't know how the external situation is going to evolve. They don't know the domestic economy is going to pan out over the coming months. So I think they are keeping the powder dry, sort of react to the additional developments coming from an internal and external arena.
So, as I understand it, correct me if I'm wrong, your view, as is sort of, we can probably say consensus in the market, is the stimulus package that was announced is just about enough, perhaps not quite enough, to deal with the tariff offset. I suppose I'm curious as to whether you agree with our Bloomberg economics economist who just came on saying that the issue for China is really the timeline here. They need to get consumption going in a very short period of time. They don't have a 5-year horizon. It's sort of a 1-year horizon. Do you think is the timeline issue the most pressing concern for offsetting those tariff risks?
I think both the timeline as well as the scale are both important. So if you look at the 30-point plan, it deals with some short-term cyclical issues, but it also covers the longer-term secular issues as well. On the short term, you have the consumption subsidies, you have the pledges to stabilize the labor market, stabilizing wage growth. You have quite a decisive sort of support for housing market and the property market as well as equity market to create a wealth effect for consumers. And for the longer term, you have initiatives to deal with the demographics, right? The subsidies for childbirth, childcare. You have things like increasing the competitiveness of the services sector, liberalization of the services sector, and you have a lot of initiative to show up the social programs, social unemployment subsidies, recreational benefits. You have measures to increase education and healthcare, so on and so forth. One of the key reasons why Chinese consumers are very swift is because they don't have the government saving for them, so they have to increase the discretionary savings, and their consumptions obviously take a hit from that. If the government are saving for the households, then they can bring down that discretionary saving and increase the consumption share of the GDP.
I mean, you bring a very unique perspective here because you're both an economist, and right now, of course, you look at markets. So my question is, and I think just to build on what Rebecca was mentioning there, it's the first time in as far as at least I can remember that consumption is number one, right? When you come to GDP, there's consumption, there's exports, there's investment. The other two are easy, right? We can meet the target this way. So my question is, 30-point plan, the toolkit is arguably still geared towards the old economy. How do investors need to be thinking about execution risk?
I think execution risk is very much the key. As you point out, that this is very new, right? This is not the old playbook that local government, central government have been comfortable with sort of stimulating the economy. With investment and property and infrastructure-driven sort of a playbook, it's very easy. Once you throw the money, the GDP got reflected. I think consumption is a new model, and that's why maybe that Beijing has been hesitant in sort of moving in that direction. But I think the wake-up call is finally being sound. Right. We have seen that the consumption being center of the stimulus from the Central Economic Work Conference, from the 2 sessions, and now we actually have more concrete plans being laid out. So I think, to me, the significance of this announcement is not so much of delivering the concrete implementation details, but is laying the groundwork and tell you the direction of travel.
More with Ada now coming through as well here. Just very, very quickly, going into the open today, BYD is set to open at a record high. We're now called 406, 407, 408 rather, on the stock price right now. The bulls are out this morning. Good morning. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up about nearly about 0.7%. A couple of things to note. OECD reduction to growth forecast. The FOMC is beginning its two-day policy meeting. And, of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes. Really, which is the amount it takes really to do the same here as far as your gas guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong. Up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past two sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying, so this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage wage, protecting people's rights to paid leave. And that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime. And the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that their response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policy-making body is concerned, right? So neither the action plan nor the press conferences, to Min's point, actually gave you a lot of details. But all that being said, just to throw this forward, right? So according to Goldman Sachs, the two events to watch coming up will be the April Politburo meeting, as well as the nationwide childcare subsidy. So watch for that in the coming months. HSBC had a somewhat different take, fairly more bullish, fairly more comprehensive. A decisive change is how HSBC calls that as well. So it's unclear, again, to Min's point, how the trade policy or the trade war may evolve. But this shift to focus inward, look at domestic demand, is the best response yet. This puts more upside risk to their forecast of 4.5%. Let's bring in David Chu, of course, who's with us here on set as well, to give us their reaction to what you heard so far.
Well, if you look at the whole, for my side, I have been reading the world lifting consumption over the past decade for maybe 1,000 times. Yeah. So yesterday when we came to the press conference and the document that he issued in the over the weekend, and the Min has briefed it a lot, and I don't want to go through everything, but I want to say that yes, they gave some detailed and concrete ways to lift the income. So I think this makes the most difference compared with previous documents. And also, they decide that they are going to improve the social security's welfare, and also, for example, to give subsidies on no loans for children. These are all in the good direction and the correct direction in my way, in my thought. So it comes to another thing in my mind, that this is the first priority to do thing in the government work report. If you look at it, it is the first thing in the to-do list. And last year, it was the third one, so that it tells us that for this year and maybe next year, this is the top priority for the economy policy and the policy orientation, in the government's to-do list. And we should say that this is really relevant to the economy situation. We just talked that China's economy is resilient, but I want to say it is resilient in the production side, but less resilient in the demand side. If you look at the demand side, export is facing great uncertainty because of the tariff, and the investment is dragged by the real estate sector a lot over the past 3 years. And now only the domestic consumption is the hope. It's a silver line for the economy in the demand side. So that is why it is the first top priority for this year.
The demand side problem, it would be a big shift for Beijing to really focus solely on that. But it's also very difficult, if not the most challenging sort of policy shift for them to engineer, not least very expensive. What are the key challenges here? And to what extent is this sort of stimulus package responsive to the backward-looking data that we saw for January, February? Or is this sort of a forward-looking approach, thinking about Trump, thinking about how it's going to deal with the US and global tariffs?
Yes, I think it's a more forward-looking one, because if you look at the track of the policy changes, you would see that from last year, from Q4, the government has called that the consumption is the key for the economy, and they show a strong willingness to lift the consumption. So I would say it is an outlook thing because of the uncertainty, as I said, uncertainty in the tariff side and in the export side, and also the sluggish investment side. So that, yes, it is a forward-looking thing. But the key difficulty or the key challenges is that how can we improve consumption in the short term? If we want to do it in the longer term, it would be easier, because we have, for example, we can do it within 5 years or 10 years. We are lifting income of households, and also to build up more social securities and such a kind of things to let people be more willing to spend. But how can we lift it in the short term? Because the external shock will take place in the short term, so that we need the consumption to offset that in the short term. So to do this, I think the fiscal side needed to do more.
Okay. Team, thank you so much. David Chu, of course, our from Bloomberg Economics, and here on set as well is Min Lo, of course, our China correspondent. Right, more on the breaking news that we've gotten in the last, let's call it 30 minutes or so. So a bit of background here before I get into the latest lines here. So earlier on, we did see some news that Israel was striking Hamas targets in Gaza. Now, more context coming through out of the Israeli Prime Minister's office commenting on that these strikes were in response to the refusal on the part of Hamas to release hostages, and that they will act against Hamas with increasing military strength. And now you can see, of course, these are live pictures coming through I believe, out of Gaza right now. So we'll keep you guys up to date and up to speed, of course, on more developments coming through. Certainly a risk to watch as we go into the thick of the trading session this Tuesday.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends.
Get ahead of them. And so many more.
Good morning. We're set for gains, as you can see, across these Chinese markets. So we're looking like, and we could actually be testing the recent highs in some of the Hong Kong benchmarks, and a couple of stocks like BYD. We'll talk about this later, but perhaps we could see a record on that stock, given just the moves overnight, right? I'm not speculating. I'm extrapolating based on the news flow and what we've seen so far. Anyway, we'll table that for now. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Mundi Investment Institute. Good morning and nice to see you, as usual.
Good morning.
We're trying to figure out how much the markets already discounted, Chinese markets have discounted based on all the stimulus that's been announced and, what looks optimistic and what looks maybe a bit more longer term.
Right. I don't think the Chinese market have discounted very much. If you look at the rally since January of this year, it's very clear that the rally was powered by a micro-thematic theme. It's on the back of optimism around AI. So if you look at the offshore stocks versus onshore stocks, the tech stocks versus non-tech stocks has fly high, but the non-tax part actually resisted very modest gains. So I think it's very clear that the market is trading on a secular micro themes, which is making the rally less sensitive to macroeconomic shocks. That's why the market is being able to power through, you could argue, a mediocre MPC, 10% additional tariffs from the U.S., and a daily dose of negative headlines coming from the U.S. almost over the past 2-3 months. So I think market hasn't really discounted that much of a policy stimulus, but AI certainly is in the market.
Okay, so what does it take to, I suppose, shift that momentum from being a micro-secular theme to something that is broader based? And is this consumption package that we've seen, even this shift to sort of the demand side emphasis, is that not enough to do it?
I think you need to see more of this. So clearly that the consumption, the 30-point consumption support package, it's a move in the right direction. It's coming on the hill, coming on the shortly after the National People's Congress, where they said that they're going to make a consumption the center of policy stimulus. So with this, 30-point plan, we're getting a little bit more details of how they're going to carry out this consumption support package. However, we don't really see all the details, right? We don't know how big this consumption plan is going to be. We don't know the implementation details. We don't have the information about who's going to pay for this consumption package. So I think this is definitely a move in the right direction. But the reason that you haven't really got the market really, really excited, the broadening of the rally and the consumption stock really fly high, it's because of the lacking of those details.
Is the lack of detail by design? And the reason I bring it up because we don't know what factors and how the economy looks in 6-12 months' time. We don't know how geopolitics looks, for example.
Sure.
In other words, is that necessarily a bad thing?
So I think last time I was on this program, I used the phrase crossing the river by filling the stones. Yeah. I think this is a very much an iterative process. They have a promise of hitting around the 5% growth target. They tell you what they have told you what they're going to do in terms of stepping up a fiscal stimulus. A lot of that resources are going to be channeled into consumption and technology development. This is 30-point plan is essentially the next step of getting people comfortable with that plan. But clearly that they don't know how the external situation is going to evolve. They don't know the domestic economy is going to pan out over the coming months. So I think they are keeping the powder dry, sort of react to the additional developments coming from an internal and external arena.
So, as I understand it, correct me if I'm wrong, your view, as is sort of, we can probably say consensus in the market, is the stimulus package that was announced is just about enough, perhaps not quite enough, to deal with the tariff offset. I suppose I'm curious as to whether you agree with our Bloomberg economist who just came on saying that the issue for China is really the timeline here. They need to get consumption going in a very short period of time. They don't have a 5-year horizon. It's sort of a 1-year horizon. Do you think is the timeline issue the most pressing concern for offsetting those tariff risks?
I think both the timeline as well as the scale are both important. So if you look at the 30-point plan, it deals with some short-term cyclical issues, but it also covers the longer-term secular issues as well. On the short term, you have the consumption subsidies, you have the pledges to stabilize the labor market, stabilizing wage growth. You have quite a decisive sort of support for housing market and property property market as well as equity market to create a wealth effect for consumers. And for the longer term, you have initiatives to deal with the demographics, right? The subsidies for childbirth, child care. You have things like increasing the competitiveness of the services sector, liberalization of the services sector, and you have a lot of initiative to show up the social programs, social unemployment subsidies, recreational benefits. You have measures to increase education and healthcare, so on and so forth. One of the key reasons why Chinese consumers are very swift is because they don't have the government saving for them, so they have to increase the discretionary savings, and their consumptions obviously take a hit from that. If the government are saving for the households, then they can bring down that discretionary saving and increase the consumption share of the GDP.
I mean, you bring a very unique perspective here because you're both an economist, and right now, of course, you look at markets. So my question is, and I think just to build on what Rebecca was mentioning there, it's the first time in, as far as at least I can remember, that consumption is number one, right? When you come to GDP, there's consumption, there's exports, there's investment. The other two are easy, right? We can meet the target this way. So my question is, 30-point plan, the toolkit is arguably still geared towards the old economy. How do investors need to be thinking about execution risk?
I think execution risk is very much the key. As you point out, that this is very new, right? This is not the old playbook that local government, central government have been comfortable with sort of stimulating the economy. With investment and property and infrastructure-driven sort of a playbook, it's very easy. Once you throw the money, the GDP got to reflect it. I think consumption is a new model, and that's why maybe that Beijing has been hesitant in sort of moving in that direction. But I think the wake-up call is finally being sound. Right. We have seen that the consumption being center of the stimulus from the Central Economic Work Conference, from the 2 sessions, and now we actually have more concrete plans being laid out. So I think, to me, the significance of this announcement is not so much of delivering the concrete implementation details, but is laying the groundwork and tell you the direction of travel.
More with Aiden Yao coming through as well here. Just very, very quickly, going into the open today, BYD is set to open at a record high. We're now called 406, 407, 408 rather, on the stock price right now. The bulls are out this morning. Good morning. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up about just nearly about 0.7%. A couple of things to note. OECD reduction to growth forecast. The FOMC is beginning its 2-day policy meeting. And, of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes, really, which is the amount it takes really to do the same here as far as your gas guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong, up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past 2 sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying, so this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage, protecting people's rights to paid leave, and that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime, and the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that they're response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, as to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms, basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policymaking body is concerned, right? So neither the action plan nor the press conferences, to Min-Min's point, actually gave you a lot of details. But all that being said, just to throw this forward, right? So according to Goldman Sachs, the two events to watch coming up will be the April Politburo meeting, as well as the nationwide childcare subsidy. So watch for that in the coming months. HSBC had a somewhat different take, fairly more bullish, fairly more comprehensive. A decisive change is how HSBC calls that as well. So it's unclear, again, to Min-Min's point, how the trade policy or the trade war may evolve. But the shift to focus inward, look at domestic demand, is the best response yet. This puts more upside risk to their forecast of 4.5%. Let's bring in David Chu, of course, who's with us here on set as well, to give us their reaction to what you heard so far.
Well, yeah, if you look at the whole, for my side, I have been reading the world lifting consumption over the past decade for maybe 1,000 times. Yeah. So yesterday when we came to the press conference and the document that he issued in over the weekend, and the Min has briefed it a lot, and I don't want to go through everything, but I want to say that yes, they gave some detailed and concrete ways to lift the income. So I think this makes the most difference compared with previous documents. And also, they decide that they are going to improve the social security's welfare, and also, for example, to give subsidies on no loans for children. These are all in the good direction and the correct direction in my way, in my thought. So it comes to another thing in my mind, that this is the first priority to do thing in the government work report. If you look at it, it is the first thing in the to-do list. And last year it was the third one, so that it tells us that for this year and maybe next year, this is the top priority for the economy policy and the policy orientation, in the government's to-do list. And we should say that this is really relevant to the economy situation. We just talked that China's economy is resilient, but I want to say it is resilient in the production side, but less resilient in the demand side. If you look at the demand side, export is facing great uncertainty because of the tariff, and the investment is dragged by the real estate sector a lot over the past 3 years. And now only the domestic consumption is the hope. It's a silver line for the economy in the demand side. So that is why it is the first top priority for this year.
The demand side problem, it would be a big shift for Beijing to really focus solely on that. But it's also very difficult, if not the most challenging sort of policy shift for them to engineer, not least very expensive. What are the key challenges here? And to what extent is this sort of stimulus package responsive to the backward-looking data that we saw for January, February, or is this sort of a forward-looking approach, thinking about Trump, thinking about how it's going to deal with the US and global tariffs?
Yes, I think it's a more forward-looking one, because if you look at the track of the policy changes, you would see that from last year, from Q4, the government has called that the consumption is the key for the economy, and they show a strong willingness to lift the consumption. So I would say it is an outlook thing because of the uncertainty, as I said, uncertainty in the tariff side and in the export side, and also the sluggish investment side. So that, yes, it is a forward-looking thing. But the key difficulty or the key challenges is that how can we improve consumption in the short term? If we want to do it in the longer term, it would be easier because we have, for example, we can do it within 5 years or 10 years. We are lifting income of households and also to build up more social securities and such a kind of things to let people be more willing to spend. But how can we lift it in the short term? Because the external shock will take place in the short term, so that we need the consumption to offset that in the short term. So to do this, I think the fiscal side needed to do more.
Okay. Team, thank you so much. David Chu, of course, our from Bloomberg Economics, and here on set as well is Min Min Lo, of course, our China correspondent. Right, more on the breaking news that we've gotten in the last, let's call it 30 minutes or so. So a bit of background here before I get into the latest lines here. So earlier on, we did see some news that Israel was striking Hamas targets in Gaza. Now, more context coming through out of the Israeli Prime Minister's office commenting on that these strikes were in response to the refusal on the part of Hamas to release hostages, and that they will act against Hamas with increasing military strength. And now you can see, of course, these are live pictures coming through I believe, out of Gaza right now. So we'll keep you guys up to date and up to speed, of course, on more developments coming through. Certainly a risk to watch as we go into the thick of the trading session this Tuesday.
The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style and luxury. It's not just about expanding, it's about thoughtful growth. Each location reflects our dedication to preserving heritage and creating something extraordinary. That, coupled with our own legacy for having been around for over 160 years, that's what sets us apart. A focus on your story, our legacy.
Good morning. We're set for gains, as you can see, across these Chinese markets. So we're looking like, and we could actually be testing the recent highs in some of the Hong Kong benchmarks, and a couple of stocks like BYD. We'll talk about this later, but perhaps we could see a record on that stock given just the moves overnight, right? I'm not speculating. I'm extrapolating based on the news flow and what we've seen so far. Anyway, we'll table that for now. Let's bring in Aidan Yao, Senior Investment Strategist for Asia at Amundi Investment Institute. Good morning and nice to see you, as usual.
Good morning.
We're trying to figure out how much the markets already discounted. Chinese markets have discounted based on all the stimulus that's been announced, and what looks optimistic and what looks maybe a bit more longer term.
Right. I don't think the Chinese market have discounted very much. If you look at the rally since January of this year, it's very clear that the rally was powered by a micro-thematic theme. It's on the back of optimism around AI. So if you look at the offshore stocks versus onshore stocks, the tech stocks versus non-tech stocks, tech stocks has fly high, but the non-tax part actually registered very modest gains. So I think it's very clear that the market is trading on a secular micro themes, which is making the rally less sensitive to macroeconomic shocks. That's why the market is being able to power through, you could argue, a mediocre NPC, 10% additional tariffs from the U.S., and a daily dose of negative headlines coming from the U.S. Almost over the past 2-3 months. So I think market hasn't really discounted that much of a policy stimulus, but AI certainly is in the market.
Okay, so what does it take to, I suppose, shift that momentum from being a micro-secular theme to something that is broader based? And is this consumption package that we've seen, even this shift to sort of the demand side emphasis, is that not enough to do it?
I think you need to see more of this. So clearly that the consumption, the 30-point consumption support package, it's a move in the right direction. It's coming on the hill, coming on the shortly after the National People's Congress, where they said that they're going to make a consumption the center of policy stimulus. So with this, 30-point plan, we're getting a little bit more details of how they're going to carry out this consumption support package. However, we don't really see all the details, right? We don't know how big this consumption plan is going to be. We don't know the implementation details. We don't have the information about who's going to pay for this consumption package. So I think this is definitely a move in the right direction. But the reason that you haven't really got the market really excited, the broadening of the rally and the consumption stock really fly high, it's because of the lacking of those details.
Is the lack of detail by design? And the reason I bring it up because we don't know what factors and how the economy looks in 6-12 months' time. We don't know how geopolitics looks, for example.
Sure.
In other words, is that necessarily a bad thing?
So I think last time I was on this program, I used the phrase crossing the river by filling the stones.
Yeah.
I think this is a very much an iterative process. They have a promise of hitting around the 5% growth target. They tell you what they have told you what they're going to do in terms of stepping up a fiscal stimulus. A lot of that resources are going to be channeled into consumption and technology development. This is 30-point plan is essentially the next step of getting people comfortable with that plan. But clearly that they don't know how the external situation is going to evolve. They don't know the domestic economy is going to pan out over the coming months. So I think they are keeping the powder dry, sort of react to the additional developments coming from an internal and external arena.
So, as I understand it, correct me if I'm wrong, your view, as is sort of, we can probably say consensus in the market, is the stimulus package that was announced is just about enough, perhaps not quite enough, to deal with the tariff offset. I suppose I'm curious as to whether you agree with our Bloomberg economist who just came on saying that the issue for China is really the timeline here. They need to get consumption going in a very short period of time. They don't have a 5-year horizon. It's sort of a 1-year horizon. Do you think is the timeline issue the most pressing concern for offsetting those tariff risks?
I think both the timeline as well as the scale are both important. So if you look at the 30-point plan, it deals with some short-term cyclical issues, but it also covers the longer-term secular issues as well. On the short term, you have the consumption subsidies, you have the pledges to stabilize the labor market, stabilizing wage growth. You have quite a decisive sort of support for housing market and the property market as well as equity market to create a wealth effect for consumers. And for the longer term, you have initiatives to deal with the demographics, right? The subsidies for childbirth, child care. You have things like increasing the competitiveness of the services sector, liberalization of the services sector, and you have a lot of initiative to show up the social programs, social unemployment subsidies, recreational benefits. You have measures to increase education and healthcare, so on and so forth. One of the key reasons why Chinese consumers are very swift is because they don't have the government saving for them. So they have to increase the discretionary savings, and their consumptions obviously take a hit from that. If the government are saving for the households, then they can bring down that discretionary saving and increase the consumption share of the GDP.
I mean, you bring a very unique perspective here because you're both an economist, and right now, of course, you look at markets. So my question is, and I think just to build on what Rebecca was mentioning there, it's the first time in, as far as at least I can remember, that consumption is number one, right? When you come to GDP, there's consumption, there's exports, there's investment. The other two are easy, right? We can meet the target this way. So my question is, 30-point plan, the toolkit is arguably still geared towards the old economy. How do investors need to be thinking about execution risk?
I think execution risk is very much the key. As you point out, that this is very new, right? This is not the old playbook that local government, central government have been comfortable with sort of stimulating the economy. With investment and property and infrastructure-driven sort of a playbook, it's very easy. Once you throw the money, the GDP got to reflect it. I think a consumption is a new model, and that's why maybe that Beijing has been hesitant in sort of moving in that direction. But I think being sound, right? We have seen that the consumption being center of the stimulus from the Central Economic Work Conference, from the 2 sessions, and now we actually have more concrete plans being laid out. So I think, to me, the significance of this announcement is not so much of delivering the concrete implementation details, but it's laying the groundwork and tell you the direction of travel.
More with Aiden Yao coming through as well here. Just very, very quickly, going into the open today, BYD is set to open at a record high. We're now called 406, 407, 408 rather, on the stock price right now. The bulls are out this morning. Good morning. Just half an hour to the open here in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I am David Ingles with Rebecca Chung-Wilkins.
Our top stories this morning. Asian stocks rise, tracking gains from Wall Street after fresh U.S. economic data eases recession concerns.
Now, optimism for China's economy also boosting market sentiment here. The central bank pledging to support government measures to boost consumption with new policy tools.
And the Kremlin confirms President Putin and President Trump will speak on Tuesday as the U.S. leader pushes for a Ukraine ceasefire.
Good Tuesday morning from the Asia Pacific. Thank you for joining us right now. As we approach the open, we are looking at gains just about across the board here. So we're up 0.5% on the benchmark. U.S. futures are pulling back following the rally we had overnight on Wall Street. You do have the likes of the Nikkei 225 being buffeted, if you will, by the further pivot from Berkshire, of course, into the trading houses, 1.5% to the upside. Taiwan is coming online, as you can see, and that one is up about nearly about 0.7%. A couple of things to note. OECD, reduction to growth forecast. The FOMC is beginning its 2-day policy meeting. And, of course, as we go into the BOJ, a couple of other risks to watch here. We understand Israel, there we go, bottom of your screens, is currently, we understand, launching strikes on Hamas targets in Gaza. Flip the boards, please, and have a look at how we did overnight on the U.S. session of some of these Chinese-listed names. So you have Baidu up 9%, so we should see a follow-through move in the Asia-Pacific. BYD is going to be interesting today. So that's what it did on the ADRs. Of course, as far as the news goes, you have this unveiling of this charging system that effectively allows people to charge their EVs up 5 minutes, really, which is the amount it takes really to do the same here as far as your gas-guzzling vehicle is concerned. So that's the story there. And it's actually very near, and we could see that happen today, hit a new record as far as BYD shares are concerned. Right, so the approach to the open, we have futures coming online in Singapore and also here in Hong Kong, up by a similar amount. As you can see, we're up to 1.9 again here on the Chinese 10-year yield. And I guess just to underscore the risk rally we're seeing here, copper futures in Shanghai are just coming online. And certainly when you look at the London contract and this one likely as well here, we are effectively at 5-month highs as far as Dr. Copper is concerned. Rebecca.
Yeah, we'll be keeping an eye on copper today. But, I mean, elsewhere, to your point earlier about the sort of positive momentum that we're seeing start to come back into markets, keeping a close eye on the Hong Kong stock rally. We did see the HSI Enterprises Index closing about 0.6% higher last night. The CSI 300 actually closed a touch down, but it has had these 2 weeks of gains. And it's really all off the back of the consumption news that we've had, as well as, of course, some of the positive news on AI. AI that's still spurring some of that tech optimism that we're seeing coming through. Quite a busy day in terms of earnings. Speaking of tech, we have Xiaomi, ZTO, Express, and Xpeng all coming through. Elsewhere, just keep an eye on the yuan. So we saw the yuan advancing in the past two sessions, onshore and offshore. We are getting close to that 200-day moving average. That's the level that you're just seeing on your screen there, 7.2215% to keep an eye. Of course, we've seen the dollar extending losses and Chinese equities rallying. So this broader lifting of sentiment going on as well, Dave.
Yeah, and we'll likely see, we'll see, of course, how far we are really from the benchmarks themselves. We could actually retest, as Rebecca was pointing out, the highs of early March on the Hang Seng Index and the Hang Seng China Index there. Right, let's bring in our team to just unpack the news flow coming out of China and commentary these last, let's call it, 18 hours or so. Min Lo, our China correspondent, and also David Chu, who covers China's economy for us at Bloomberg Economics. Min, I'll start with you. So we had this press briefing that started, I think, right after onshore markets closed yesterday. So just the takeaways for you.
Well, it was nothing really to get excited about, and I think analysts...
Okay, Min, thank you so much. Now, go ahead.
The consensus so far was that it didn't really tell us anything new that we don't already know from the NPC and also from that action plan that was revealed over the weekend. But still, to be fair, I think a few things stood out to me. I think one is that the action plan so far focused a lot more on demand-side stimulus rather than supply-side. So there was a lot of focus on raising income and adjusting the minimum wage, protecting people's rights to paid leave, and that was already something that's been talked about before. Some companies like DJI, Midea are already taking the initiative to discourage people from working overtime, and the idea is that when people work less, then you have more time to go out, to spend money, to be entertained, and to go for leisure activities. And then the other thing is that the government is signaling that their response so far is being quite flexible. You look at how authorities were responding to a question from reporters about how they are going to expand that equipment upgrading program, and the response was that they will monitor how it goes first and they may decide later. And I think this signals that the government may still release more stimulus further down the road as they monitor the impact of tariffs, maybe come April. So they're not releasing all their cards at one go. That's two. And the other thing is also this focus on addressing people's livelihoods and their social welfare. So there's been, policy announcements around raising pension, incentives or subsidies for childcare, and Hohhot, which is in Inner Mongolia. That's one locality that has announced that they will be giving out subsidies, 10,000 yuan, a one-off subsidy for the first child, and 10,000 yuan per year for 5 years for the second child, and 10,000 yuan for 10 years for the third child. So that's pretty significant, and that's just one locality, and I think there could be more places that would follow with such policies, and it really depends on how the local governments take their own initiative to implement the directive from the central government and adding on their own local incentives to what the central government has already done.
So no major fireworks, but still, as to your point, a lot of the significance here is the signalling from the government in terms of particularly the emphasis on demand. Tell us what we are seeing in state commentary. What is that giving us a flavour of?
Yes, so I would say not a lot of meat on state commentary. There has been a number of articles on these state media platforms basically piling praises on their own action plan to boost consumption. I believe China Daily had an article talking about how the Chinese economy is resilient because of the 1.4 billion consumers. But I think my takeaway from my last 2 weeks when I was in Beijing during the NPC week, when I talked to people there, my sense is that the government is not so concerned about tariffs at the moment. They're concerned, but it's not the top priority. They're patient about it because they know that the external shocks are a factor that they cannot really control. So they're focusing on doubling down on domestic consumption, ensuring that the industrial ecosystem is healthy enough to pay dividends in the long term, especially when it comes to the tech sector, and cleaning up the risks in the economy right now.
Right. Just some commentary to tell our viewers about as well coming through out of the street here. So you have Goldman Sachs, in fact, just putting out their initial reaction piece to what Min just laid out here. The lack of details, but certainly it does give you a window into sort of high-level thinking as far as the policy-making body is concerned, right? So neither the action plan nor the press conferences, to Min-Min's point, actually gave you a lot of details. But
news when you want it with Bloomberg News Now. I'm Karen Moscow. President Trump speaks with Russian President Vladimir Putin this morning about ending the war in Ukraine. Sources tell Bloomberg Putin is demanding that all weapons deliveries to Ukraine be suspended as part of any ceasefire. Wendy Schiller is head of political science at Brown University.
Trump has to decide, whether, he can persuade Ukraine to accept that kind of term. But, Trump wants to deal. And he sees Putin, I think, and Russia in the more advantageous position. He doesn't want to keep spending money, that's what he says, paying U.S. defense manufacturers for weapons to send to Ukraine with nothing in return.
Brown University's Wendy Schiller, a senior European official, says Europe is concerned that Russia could rearm if weapon shipments to Ukraine are put on hold. Meanwhile, President Trump will also meet with China's Xi Jinping. Trump said it will happen in the not-too-distant future. The U.S. and China have been discussing a possible birthday summit between the two leaders in June. The Chinese Foreign Ministry says it has nothing new to add about plans for a meeting. New developments in the war in the Middle East. Israel has launched a series of airstrikes on Gaza, effectively ending a nearly 2-month ceasefire. We get more with Bloomberg's Jumana Bersetchi in Dubai.
These are the biggest wave of airstrikes we've seen in that part of the world since the phase 1 of the ceasefire kicked in on January the 19th. The bombardments came overnight in what was a bit of a shock to many of the Palestinians. The IDF say that they were targeting what they called terror targets, and the Israeli Prime Minister office putting out a statement saying that the move follows Hamas's repeated refusal to release hostages, as well as their rejection of all of the proposals it has received from the U.S. And then later on, we heard from the Israeli defense minister saying that Israel from now on will act with increasing military strength and that they will not stop these attacks until all the hostages are released.
And that's Bloomberg's Jumana Bersetchi. Palestinian health officials say the airstrikes have resulted in more than 400 people being killed. Federal agencies say they have fired nearly 25,000 probationary federal employees since Inauguration Day. And we get the latest with Bloomberg's John Tucker. John.
These figures actually come from the Trump administration after they were demanded by a judge. It's the fullest accounting yet of cuts in the federal workforce. The Treasury Department fired the largest percent of its workforce at 7%. That's about 7,600 employees. Agriculture fired 6% of its employees. The abrupt firings led to lawsuits in California and Maryland, and judges ordered a slew of agencies to temporarily reinstate the employees. The Trump administration is appealing those rulings. I'm John Tucker, Bloomberg Radio.
All right, John, thank you. The Washington-based U.S. Institute of Peace says staffers with Elon Musk's Department of Government Efficiency tried to enter the building last night. That led to the police being called. The Institute says it's an independent nonprofit, not a government agency, and it receives its funding directly from Congress. George Moose is its acting president.
Somehow all of those arguments have not prevailed in the conversations we've been having with DOJ, with OMB, and with others going now back almost a month.
George Moose has been the Institute's acting president since last April, but the Trump administration moved to fire him after DOJ staffers were turned away from the building last week. The Pentagon says internet pages honoring a Black Medal of Honor winner and Japanese-American service members were mistakenly taken down, but it is staunchly defending its overall campaign to strip out content singling out the contributions by women and minority groups, which the Trump administration considers DEI. A Defense Department website honoring Black Medal of Honor recipient Army Major General Charles Calvin Rogers was taken down last week. Another page that was removed featured the World War II Japanese-American 442nd Regimental Combat Team. Both were back online yesterday. NASA's 2 stuck astronauts are finally on their way home after more than 9 months in space. Butch Wilmore and Sonny Williams left the International Space Station in a SpaceX capsule early this morning. The capsule is due to splash down in the evening off the Florida coast, weather permitting. And futures are lower this morning. S&P futures down 0.2%, Dow futures down 0.2%, NASDAQ futures down 0.3%, ahead of that phone call between President Trump and Russian President Vladimir Putin, and the 10-year Treasury yield at 4.31%. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow, and this is Bloomberg.
It's a cultural landmark, a symbol of timeless style.
We really do now have a sort of tale of two narratives. On the one hand, fading US exceptionalism. On the other hand, this big, deep-seek, micro-secular momentum rally that you're talking about. Which one is pulling international investors into Chinese equities?
Both. Right. So I think this fading of U.S. exceptionalism is driven by both the developments within the U.S. and outside the U.S. I sort of characterize this U.S. exceptionalism by three things. A very resilient economy over the last 2 years. Everybody thought that the U.S. were going into a hard landing 23, 24, no hard landing whatsoever. Policy was very supportive as well. Obviously, monetary policies was tightening sort of a territory, but fiscal policy was outrageously expansionary. And number three, you had the AI thematics that powered the Max 7 higher and dragging the entire market higher with it. You can see that all three of those drivers of exceptionalism are fading. The U.S. economy is running into a wall. We don't think it's going to be a recession, but certainly the slowdown is very clear. U.S. policies, whether it's trade policies, are hurting the consumer confidence. Monetary policy, the Fed is on hold with interest rate in the tightening territory. And fiscal policy on paper is still expansionary, but with what Doge is doing certainly doesn't feel expansionary on the ground. It feels like the U.S. government is undergoing quite a severe austerity. And then finally, on AI, I think the rise of DeepSeek is upending the old model. Before the rise of DeepSeek, Max 7 was the only AI game in town. And now we have a much diverse range of possibilities to play the AI themes. A lot of AI companies in China are being bought by U.S. Global investors. So clearly the U.S. development is fading that U.S. exceptionalism. And what's happening outside is accelerating that trend as well. With Europe, the German elections has brought a watershed moment with respect to infrastructure and military spending. And in China, I think China really represents a much more formidable challenge to that U.S. exceptionalist story. If I use those three things that underpin the U.S. exceptionalism, economy, policy, and AI, the DeepSeek has brought AI thematics for China. So China is now enjoying this leadership in some areas of AI development. Policy, the policy predictability and accountability is almost night and day between U.S. and China nowadays. In the U.S., you can't even predict what Trump is going to say or do tonight, whereas in Beijing, they just told you that they're going to hit around 5% growth for this year. And finally, the economy. I think economy is really the only missing link. Right now in China, we don't have a broad-based stabilization of the economy, but we do have some green shoots. Right, top-tier cities, property market. We have just seen yesterday the better than expected the January and February number. With the policy really hitting the ground, I think that stabilization could be a byproduct of a more forceful policy coming through. So I think the stars are getting aligned for the Chinese market to perform.
I'm just trying to think whether it's useful to think about the pullback in U.S. markets almost as a one-for-one in China. In other words, there is an overlap of investors there.
Sure.
I would imagine there's still a group of investors that have yet to be sold on the China story. And if they are sold on that story, they probably will only go into the usual tech names. And I'm wondering where the incremental buyer will be coming from.
I think the incremental buying could come both within China and from the U.S. We have seen a lot of hedge funds participating in the recent rally, but the global-only investors have not really been going in wholeheartedly. The most of the buying since January was essentially southbound flows, right? Mainland Chinese money. And you can understand why, because for the past 2 years, Chinese investors have been absent from this AI thematic. Because of capital account control, they can't actually buy U.S. stocks. And before the rise of DeepSeek, they were not aware of the behind-the-door progress in China's own technology development. So DeepSeek is really changing that calculus. And we're starting to see a lot of mainland Chinese buying the best tech companies that listed offshore. So I think with 160 trillion of deposits still sitting in the bank, I think even without foreign investor participation, this is still a lot of buying power to sustain this rally just within China. But as this rally continue to go on, China continue to outperform, a lot of those underweight by global only investors will have to think twice. So I think the incremental buying coming from both within and outside China can be quite significant.
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME futures across equity indices, interest rates, FX, energy, agriculture, and metals. Access CME futures around the clock at Interactive Brokers.
All right, we are looking a little bit of a bounce this morning, 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is on assignment, and Bloomberg Open Interest starts.
Coming up, Fed Chair Jay Powell faces a tricky task this week of assuring investors the economy remains on a solid footing. Retail data out this morning adds to concerns of a pullback in consumer spending. And Treasury Secretary Scott Bessent says he's not worried about the market, but Wall Street doesn't seem convinced. RBC's Lori Calvasina cut her S&P 500 target on growth risks, and she joins Open Interest this hour. Also, our big stocks focus today, NVIDIA. Investors hope a keynote speech from CEO Jensen Huang at the chip giant's much anticipated AI conference this week will give the stock and the sector some badly needed momentum. Let's take a look right now at where markets are trading. We did see a little bit of bounce, very little. NASDAQ 100 futures are still up 0.1%. Maybe that's on hopes the GTC conference from NVIDIA will give us something. You can see S&P futures right now, little change, but there's a red arrow. And the 10-year yield also very little change, holding at that 430 level that Shanali has been watching so closely. I'm watching NVIDIA stock right now because it's a pivotal week for that company and that sector. NVIDIA developers, its developers conference getting underway. The GTC, which I think is GPU Technology Conference, pushing the shares in the pre-market up 1% and change. And you're watching something related.
I am. Pour one out for the humanoids. That is what Morgan Stanley is watching, the humanoid trade here. That is in part in Tesla. The idea here is that the NVIDIA conference could have implications on Tesla's stock, which has seen investor sentiment plummet this year. And remember, Tesla is one of your worst performers on the S&P 500, certainly the worst on the Magnificent Seven. Let's see if NVIDIA can help turn it around. Meanwhile, also politics in focus because Treasury Secretary Scott Bessent says he's not worried about the decline that's wiped out trillions of dollars from the stock market. Bessent spoke on NBC's Meet the Press on Sunday.
Corrections are healthy. They're normal. What's not healthy is straight up that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
All right, so Scott Bessent there assuring the market, but the market's not really assured, right? We've had a number of people cutting targets. Again this week, Lori Calvasina, who's going to join us shortly, has cut her target. And Mike Wilson, in a note I was reading over the weekend, says, you know, the pro-market policy coming out of the Trump administration isn't going to come out till later in the second half at the earliest. So they've really got to reassure us with something else first.
Well, that's the problem. Where's the bottom? Is it in April after we see the next wave of tariffs, or is it later this year after we see the brunt of that pain really come through? That's what no one can tell. And until that's kind of cleared up, it's hard to know how to buy the bottom, isn't it?
And the wealth effect may be hurting consumer sentiment. Take a look at the retail data that we had out across the last hour. Shanali and I were looking at the ECAN function, ECAN Go, on your Bloomberg terminal, and just breaking it down into sectors over the last year. The auto sales have been a real problem. Click into that blue box there, and you can see this is auto sales and auto parts. They just continue to come down. So Mike McKee joins us here on set with his own look at the data. Mike, you've had a half hour now to look through it. What do you see?
Well, ओके गाइस, ये क्रूड ऑयल में देखो यहाँ पर एक बाइंग का ट्रेड प्लान है. लास्ट कैंडल ओपन इक्वल टू हाई बनी थी तो डायरेक्टली बाय नहीं कर सकते थे, बट अगर ये ऊपर जाता है तो एक बाइंग का प्लान रखेंगे. छोटा सा एसएल रहेगा. 7 बजे यूएस मार्केट भी ओपन होने वाला है, तो ध्यान रखना ऐसा ना हो कि वापस ओपन इक्वल टू हाई बनाते हुए प्राइस नीचे चला जाए. लास्ट कैंडल पे वैसे बाइंग कर लेते, बट वो डायरेक्टली आई लेवल पे ओपन इक्वल टू हाई बनाते हुए तो उस पर नहीं कर सकते बाय डायरेक्टली. ये वापस ऊपर जाती है कैंडल, या फिर मान लो ये कैंडल यहीं पर रुक गई, नेक्स्ट कैंडल ऊपर जाती है तो एक बाइंग का ट्रेड रहेगा. डायरेक्टली मत लेना, ठीक है, क्योंकि कैंडल ओपन इक्वल टू हाई है तो वो थोड़ा कैंडल डायरेक्टली बाइंग के लिए प्रपोज नहीं होती है। छोटा सा एसएल है, इससे बड़ा एसएल लेंगे नहीं। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक दिस स्ट्रीम। इसमें भी एक सेलिंग का प्लान वापस से। क्रूड ऑयल भी, नेचुरल गैस भी देखोगे, कल वाला जो वीक सपोर्ट था ऐसा लग रहा था ब्रेक हो जाएगा, ब्रेक हुआ भी, बट वो थोड़ा सा होल्ड कर गया उस लेवल को वापस से। हाँ, सात बजे यूएस मार्केट भी ओपन होगा। यहाँ पर नेचुरल गैस में भी एक सेलिंग का प्लान रखना, ठीक है? सेलिंग प्लान नेचुरल गैस एज वेल। एक बार इसका एसएल देख लेते हैं कितना जाएगा ऊपर की ओर। ज़्यादा नहीं है, ठीक है? कल वाले रेजिस्टेंस पर ही है। इस एरिया से एक सेलिंग का प्लान यहाँ वापस हो जाएगा। रेजिस्टेंस अभी भी ठीक ही है, स्ट्रॉन्ग ही है ऊपर नेचुरल गैस में, कोई सुनिए। कि फिर इसके बाद सीधा कल का हाई का लेवल भी रहेगा एज अ रेजिस्टेंस जोन। नहीं किया इसने अभी तक। आज कोई डेटा नहीं है खास। 6 PM का डेटा था बिल्डिंग परमिट का, वो और हाउसिंग स्टार्ट का ऑलरेडी आ ही चुका है। श्योर। अभी बाय मत करना क्रूड में, यूएस मार्केट के बाद ही करना, लेवल के ऊपर निकलेगा तो, क्योंकि लास्ट कैंडल ओपन इक्वल टू हाई बना के आई है, तो देयर इज अ वेरी हाई चांसेस जानबूझ के बनाई गई है कैंडल लेवल पे सपोर्ट के, डायरेक्टली नहीं कर सकते बाय, कैंडल ही ओपन इक्वल टू हाई बन गई। अगर ऊपर नेक्स्ट कैंडल जाती है 8 PM वाली तब करना, अगर नहीं जाती है मान लो यहीं से रिजेक्शन लेके नीचे आ जाए तो फिर थोड़ा और वेट करेंगे, उस केस में प्राइस को थोड़ा और नीचे आने देंगे। ठीक है, ज़्यादा नहीं, ये मान के चलो लाइक, क्योंकि नेक्स्ट फिर सपोर्ट यहीं बनेगा। बाकी ध्यान रखना ये आपका चार्ट कौन से मंथ का है। ठीक है, अगर ये यहाँ से ऊपर नहीं जाता है नेक्स्ट कैंडल पे तो फिर सेलिंग नेक्स्ट थोड़ा सा नीचे वाले लेवल से होगी, अराउंड दिस जोन। इसका भी एसएल 15 पॉइंट का कर देते हैं, ज़्यादा नहीं होगा। ठीक है, यहाँ कहीं से अगर ये इस ब्लू कलर की लाइन के ऊपर नहीं जाता है तो चला गया तो यहीं से आ जाएगी बाइंग, ध्यान रखना। नहीं गया तो फिर इट मींस जानबूझ के ओपन इक्वल टू हाई कैंडल बनाई गई है सो दैट द सपोर्ट ब्रेक हो जाए। बाकी अगर चला गया ऊपर वाली ब्लू कलर की लाइन के ऊपर से तो वहीं से बाइंग कर लेना, नहीं आता है तो फिर ये रहेगा सपोर्ट। यहाँ पर भी ध्यान रखना बाइंग करते वक्त ओपन इक्वल टू हाई ना बने कैंडल, ओपन इक्वल टू हाई बनेगी तो इंटरेस्टेड नहीं रहेंगे बिल्कुल भी। पाँच मिनट रह गए हैं यूएस मार्केट ओपनिंग में।
That Klarna partners up with Walmart, like, oh, they got a new JV. They're displacing a firm, and that's a big move for the stock. Still ahead, RBC cuts its S&P 500 year-end target on growth risks. Lori Calvasina joins us at the desk in just a few minutes to talk about what's going on with her targets and if we could see a sustained bounce now. Plus, President Trump and Putin are set to discuss ending the war in Ukraine tomorrow. More on that next. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. The OECD predicts the pace of global expansion will slow to 3.1% this year. The Paris-based club of 38 rich countries cut its outlook for global growth, pointing to trade barriers and uncertainty as the reason for the drag. The Kremlin has confirmed that Russian President Vladimir Putin is due to speak with President Trump tomorrow. The U.S. is pushing for a 30-day ceasefire in the war in Ukraine. Trump told reporters aboard Air Force One on Sunday there's a very good chance for a deal. Those are his words. And the White House is defending its move to expel hundreds of alleged members of a Venezuelan gang to El Salvador for imprisonment. A federal judge ordered a halt to some of those deportations. White House Press Secretary Carolyn Leavitt said that the order does not conflict with the administration's actions. Shonali?
And Matt, we're going to look at some of the sectors that have been impacted by what is going on under the market today. We're looking deeper into chip stocks, of course. We're waiting for that big event from NVIDIA. Listening to CEO Jensen Huang on Wednesday, you were seeing NVIDIA on the move this morning prior to really anything happening with that event. Tesla, though, still down. We've been talking about it. Morgan Stanley seeing a potential for some change there. Our own Mandeep Singh at Bloomberg Intelligence sees a long way to go, though, in terms of gains for Tesla, in terms of humanoid activity based on what NVIDIA has got going on.
Yeah, and Baidu out with a new chatbot over the weekend called Ernie. Ernie X1 is apparently better at explaining its reasoning to users. We're looking at retailers and auto retailers, especially because of the retail sales number that came out. You had a little bit of a disappointment for auto sales, but here are the big retail movers pre-market. Walmart down right now, as well as Costco and Home Depot. Amazon putting up gains. I think really the defense sector is one of the most interesting to watch today because of that move by a Canadian minister that over the weekend joining Portugal Portugal and saying they're going to reevaluate their contract to buy F-35s. That affects a slew of companies from Lockheed Martin to Raytheon to Northrop Grumman. I mean, there's like 10 General Electric companies working on this project. So if they pull out of that...
I think that is interesting. You're talking about Canada making this move. The question of the push-pull between international countries here pulling into their defense spending while the U.S. has been talking about cutting down some of their defense spending is still an uncertain outcome here, I think, for a lot of these folks.
Yeah, absolutely. Let's get a quick check on futures ahead of the opening bell coming up in just 12 minutes time. We see little change in terms of S&P futures right now, down about 0.04% after that correction, and then a pretty sweet recovery on Friday. NASDAQ futures are gaining, but also very little change right now, so not a lot of movement ahead of the opening bell. When we come back, Lori Calvasina joins us, RBC Capital Markets head of U.S. equity strategy. She's cut her outlook. We'll ask her if she thinks we could see a sustained rally after this. This is Bloomberg.
Markets never sleep, and neither does Interactive Brokers. Discover more opportunities with CME futures across equity indices, interest rates, FX, energy, agriculture, and metals. CME futures offer around-the-clock access, deep liquidity, and capital-efficient margins, helping you seize opportunities whenever they happen. The best-informed investors choose Interactive Brokers.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Jay Williams.
I want to be an owner one day.
Billie Jean King.
Learn the business.
Paul Rabel.
Don't chase trends. Get ahead of them.
And so many more.
Quick check on futures ahead of the opening bell. We just got about 9 minutes to go. S&P futures, NASDAQ futures, Russell futures, little change, but all showing red arrows at the moment. Let's talk about this with Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. RBC, they just lowered their year-end target for the S&P 500 to 6,200 from 6,600. So, Lori, you're still, positive from here, right? You just don't think we're going to get as much bang as you previously had thought. Why is that?
So, this was honestly triggered last week. Our economic and rate strategy team updated their forecast, and this is something they do on a pretty regular cadence. But their GDP number went from 2% down to 1.6%, and that triggers a change on one of the models that we use to come up with the S&P forecast. So we have 5 different models. It's very quantitative. My clients joke I'm all about the math, less about the story. But one of those models, and we had signaled this as something we were struggling with in the year ahead outlook, that when you are in the 2 to 3% GDP range, and consensus has been around 2-3, our team was previously right at 2, it's a good environment for the stock market, right? And we all had this idea that the vibes were going to be strong and we had a more business-friendly political backdrop. But they took the number down to 1.6, and that's right in the middle of this kind of 1 to 2% range. That is a very tricky environment for the stock market. You're down more often than up, and your average gain is about, actually it's a decline of about minus 3.4%. So that was one of the changes that flowed through. There were also some changes to our valuation model, which is based on PCE, 10-year yields and Fed funds. And so we had to make some adjustments there. We also made some adjustments to our earnings number, which went from 271 to 264. And a lot of that was the GDP, as well as us reining in our own margin assumptions. So it kind of all fit together. And look, I'll tell you, Matt, that 6,200 is predicated on the idea that this is about the low, right? This sort of 10% type number. We're not going to get too much worse from that. My conviction in that is not huge. We have to sort of watch the market in here. I see some things on the sentiment side that say this could be a bottom, but I see other things that say maybe we need to go more. So we're just going to have to watch the market a little bit in here.
Not to be a Debbie Downer on a Monday morning, but I think
you can be. The sentiment is very bad,
it's
right?
Very bad, and I think privately people say worse things that they're saying publicly, right? So what is...
That would be a concern because they're saying very bad things publicly. Look at the AAII bullish bearish. Yeah. Joe, you have that. Pull up the AAII chart and look how bearish the market is publicly the street is publicly
I can't tell
the
you
worst since 2022.
How many people wish they said they sold when I was down in Miami for future proof this weekend? Those are RIAs. These are people managing other portfolio stocks. What is the downside risk?
So look, we've got this new table in the report, and we've been talking about this as a framework I've used for years, but we call it like the 4 tiers of fear. And I know that's a very sort of scary, sort of label to put on it, but it has been coming up, right? When people have been saying, what is this that we're dealing with? What does this look like? 5 to 10% is tier 1, garden variety pullback. We're in that. We're at the bottom. So what's the next tier of fear? I think it's what I call tier 2, the growth scares, which is a 14 to 20% drawdown. And that's, if that happens, that takes the S&P to sort of like a 4,900, 5,300 roughly. That idea is based on the post-GFC pre-COVID growth scares, which were all in that range. So 2010, 2011, 15, 16 industrial recession, and the 2018 trade war, which was under Trump's first term. That was a 20% drawdown peak to trough and a 6% decline on the year. So that's kind of the next tier of fear. Otherwise, it's recession, 25 to 33%. Crisis, you lose 50% of the market value. I don't think we're in tier 3 or 4, but I do think the risks of tier 2 have significantly risen. And if we don't hold around this 10% mark, I think that's where we're going.
Well, and Shonali on our call this morning was talking about the damage that's been done technically, right? As we broke through 200-day moving averages on, every major U.S. index, right? And I think it's even worse for the Russell 2000, like down below its 200-week moving average. Yeah. What kind of value do you give to technical analysis, Lori?
So I think it's important the traders watch it. It informs sentiment. And, you go back to AAII. I have this whole list of things I look at when you're in really bad markets to gauge whether fear has gone too far. And we have to watch that kind of data because we are all subject to that same kind of fear. AAII is technically sending you a buy signal, right? It is so bad. It's actually at GFC lows as well. It does tend to get stuck there for a little while, but on a back test, 9 months later, we should be up about 10%. Things like CFTC, the weekly positioning data, that's early innings of declining. We only have that data through last Tuesday. We'll see where we are this coming Friday. But you've got things like that need to catch down. And I think that's probably the sentiment you're picking up. I'll also tell you, Shonali, though, I was at a dinner last week, and, I was talking to a bunch of people who wanted to buy the dip. So, and still saying there was a Trump put. And I sort of joked, and I said, well, we're not really going to bottom until nobody's saying there's a Trump put. Yeah. So we're dealing with those kinds of dynamics.
Yeah, Lori, stick with us. Perhaps just as much of an issue is there a Fed put anymore, as long as people are looking for a Fed and Trump put. That is Lori Calvasina of RBC. She's sticking with us, and we are less than 4 minutes to the opening bell. It's a tough open. It's a tough tape out there. Stick with us. We'll bring you everything you need to know at the market open. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures that are bouncing back and forth between gains and losses this morning. Right now, we're looking at all red arrows, but they're very slight, right? 0.07% down on S&P futures. The same is true on NASDAQ futures. Russell 2000 futures moving a little bit lower. And as we were talking about before, they've been hit the hardest in terms of technical damage. You hear the opening bell on the New York Stock Exchange. British American Tobacco and R.J. Reynolds celebrating 150 years of making smokes. They're the Camel guys there. Down on the NASDAQ market site, Yahoo Sports has some kind of March Madness like bracket challenge, but it doesn't matter because Bloomberg, we have our own bracket challenge. If you type in BRKT GO, then you can enter your own bracket on the Bloomberg and compete against the smartest minds on Wall Street. In terms of what's going on in the indexes right now, let's take a look at the live trade a few seconds after the kickoff. You can see things are settling lower. So S&P 500 as well as NASDAQ 100 futures down about 0.1%. I am telling you, wait this week to see what we get out of that NVIDIA conference, because any huge announcements by Jensen Huang could drive up the big tech stock, could drive up the Mag 7, and that would pull up, obviously, these two indexes with it. The Russell 2000 index, the small caps, lower quality stocks doing worse, right? Down 0.2%. We'll continue to keep an eye on that, but this is really where growth scare hurts. This is where rates hurt. and I don't know how much they're going to be helped by a big AI conference. In terms of the stocks to watch, individual stocks, NVIDIA obviously is a huge focus, the second or third biggest stock in the world, depending on Microsoft's market cap. Right now, NVIDIA gaining, but only about 0.5% to 122.17. That conference this week really could be a catalyst, as Shanali was pointing out earlier, for Tesla. It could be a catalyst for Micron, the memory maker. It could be a catalyst for Baidu with their new chatbot, Ernie X1 out. So NVIDIA is one, Shanali, that we're watching very closely.
But I think the operative word of what you had there is could. This is such a market built on hope, and one place it could help, to your point here, is Tesla. It's now almost wiping out all of its gains from Friday. We have it down more than 3.6%, fluctuating a bit at the market open. Remember, Matt, what's fascinating, Tesla at $240 is about $20 below its one-year average. So analysts like those at Morgan Stanley are believing that what NVIDIA says about the humanoid potential of what it does in AI could impact Tesla. Could be a while till we see it, but of course, this is off its lows for a year, but meaningfully lower than its average.
Yeah, let's get back right now to Lori Calvasina to talk a little bit about the broader market, and maybe we can bring in some of those threads, right? We had retail sales that were kind of disappointing. We have hope for AI, but that's like a B2B play. Lori Calvasina from RBC Capital Markets. You have cut, as we were talking about, your target, but still 6,200, so still a ways up from here. What drives us there? Is the big tech play? Is the AI conference? Is, NVIDIA charging $1 million a chip? Is that going to help?
I think it's that we've simply got to get to the other side of this moment that we're stuck in right now. I think if we look back historically, when we have sort of these GDP blips in a given quarter, sometimes those lead to growth scares and sometimes they don't, right? And so I think it's really just kind of the relief on the other side. And, we're all talking about the retail sales data this morning. I haven't really had a chance to dig into it too deeply, but what I'm seeing based on how the headlines are fluctuating is that the market is trying to figure this out. And I think that's what it ultimately comes down to, right? Are we just going through a sentiment shock, or is this sentiment shock really creating some lasting damage with tails? And we just don't know that yet. We've got to get this hard data in and parse it and go through it, and we've got to get a little bit of duration on this hard data as well. I think, frankly, we need to reset earnings. I don't think people are going to trust anything I say on valuation until we get a sense that there's a little bit more certainty into earnings outlooks.
It's interesting. When you look at the sectors for the year, I think I'm just stunned by how much consumer discretionary has lagged the broader market. I get it, fine. A lot of that is things like Tesla and Amazon as well. But with retail sales the way they are and a lot more consumer sentiment data ahead, even if you have investors parsing even home sales now to see how the retail sector is doing, how much more pain is there and what does it mean for the broader market?
So look, I'll tell you, Shanali, two thoughts on that is I spent some time last week going through conference transcripts and earnings call transcripts of retailers and other consumer-related sectors across the Russell 3000. So not just the big cap companies, but the small cap companies. And I was stunned how many things seem to be hitting the consumer right now. It's not just tariffs and policy uncertainty, weather, fires, interest rates, inflation, the flu. I don't think that's gotten enough airtime in the media, just how nasty this flu season has been. What that means, though, is, it is going to take a lot to sort of repair that damage, right? There's a lot of different fronts that have to be attacked. I think the other thing, too, frankly, is if you look at the University of Michigan data, we're close to recession lows. And if you want to sort of back up a step and maybe look at small businesses, there's a little bit of a conundrum in that data because you've got sentiment and optimism and economic optimism that's been, kind of taken a hit, right, but is up around all-time highs. So it's telling you there's froth that needs to come out. But then uncertainty is almost back to peak. So which is it? Are people too scared or are people too optimistic? It's a really confusing moment for the consumer right now.
Speaking of the consumer, we are almost exactly 1 month from big bank earnings, the unofficial start to earnings season. And if the consumer is weakening, you have to wonder how that really rolls through into those first set of earnings results. Can you believe it? I'm already looking.
Shanali is already thinking about big bank earnings.
How could you not?
And I'm like, at least we have a month until big bank earnings.
I love them.
How are they going to do, Lori? If you have this kind of concern about the consumer, you have this much concern about, you mentioned small businesses, right? The NFIB, commitment to expansion is very low. So that can't be good.
Well, and their commitment to raise prices is moving up, right?
Yeah.
I mean, so you're seeing that. Look, I'll tell you, at our financials conference, the bank sounded calm, cool, and collected. They acknowledged, I think, especially on day 2 of our conference, that there was a pause that they were seeing in terms of activity. And, I think, one of the gentlemen who presented said, we all just need to turn the news off. I know that's not good for you guys, but, just sort of speak into the idea, right, of the news flow and how that was impacting activity.
But remember when Jamie Dimon said, even bankers who didn't vote for Donald Trump are dancing in the streets right now? They're probably not dancing as much this year.
Well, certainly the M&A activity, right, has been depressed, and that directly relates to confidence. And if you even look at that Business Roundtable survey last week, right, I think the headlines were all, sort of it's resilient, but it went down a little bit versus the last quarter, and it's been in a pretty weak recovery off the lows. So I don't think anybody's dancing right now.
Lori, not to make this about bonds, but to the point that you're making earlier, you have a 2-year yield that was sustainably below 4%. Pretty much for the last 2.5 weeks. Yeah. You are now well above 4% once again on that 2-year. And I'm wondering, at what point do these kind of sticky higher interest rates matter? You're already perhaps seeing it in the Russell 2000. Where else does it count?
So I've been more focused on the 10-year yield. And I know obviously, that's where a lot of the conversation has been happening, trying to take that yield lower. What I see on my data is that makes sense. I mean, it's really the thing that matters, frankly, more than the Fed funds rate if I'm looking at interest expense or if I'm, looking at or if I'm looking at debt levels over time or effective interest rates that companies are paying. I will tell you in my earnings forecast, I modeled in the 4.2% number that our team is highlighting for the end of the year, but they also have it going lower in the interim before coming back up. So that all flowed through into my model. So I have interest expense coming way down in that earnings calculation for this year, and that's helping my new number. Unfortunately, it's not offsetting the weaker GDP reads. It's not offsetting my more pessimistic margin assumptions, but it is helping.
Lori, we thank you so much for setting the stage. Of course, it's a complicated market and a lot of negative sentiment out there, but we take a measured tone here.
I love it when Lori goes on Nathan Hager's radio show in the morning before she comes on with us. So I get a little bit of a preview, and it makes things so great.
But we have now an outline of every tier of fear.
Tiers for fears.
Tiers for fear. We're going to be keeping a close eye on those tiers. We also want to talk about some things moving under the radar because Intel is on a tear, Matt. If you take a look at it, it is a very warm reception for the incoming CEO, Lip-Bu Tan. He has been signaling that he's going to stick with the plan for its foundry business to make chips for other companies. The market seems to like it. You are seeing Intel now up more than 5.7%. It was up more than 6% a little earlier.
Yeah, I think the market likes the idea that he's going to cut some jobs as well. So restructuring the company's approach to AI.
Hard for Ohio.
They haven't gone there quite yet, but you're right. It's a very difficult story for the great state of Ohio. At least we won the national championship in football. This is Bloomberg. This is Open Interest.
This is Open Interest, and it's time now for our top calls. Some of the analyst action in focus this morning. First up, we're watching JP Morgan upgrading Norwegian Cruise Lines to overweight after the stock posted its biggest gains in a month on Friday. The Wall Street Journal says it's wave season for bookings. They need that boost. A lot of uncertainty around the cruise lines, up now 3.8%. Next up, we're watching DocuSign getting an upgrade from William Blair. The analyst is bullish on the new product cycle's ability to re-accelerate growth back to double digits. Also on the rise, we're watching DocuSign up almost 2.3%. And finally, we're watching MoffettNathanson raising Netflix to a buy from neutral. And the analyst is saying that the company's ability to better monetize is underappreciated. Netflix up 4.2%. I've been watching a lot of that lately, Matt.
18 minutes into the trade, what's going on with the major averages? You can see green arrows now across the screen. The S&P 500 up 0.4%. The NASDAQ 100 gaining as well right now, and we're looking at a 1/3% gain. Russell 2000 shares doing twice as well as the rest of the indexes, major indexes there. I'm looking to see who the biggest points gainers are, and Netflix is right up there. Maybe because of the Goldie Hawn show. And Berkshire Hathaway.
Goldie Hawn's daughter.
Her daughter, Kate Hudson.
Yes.
Right? And Berkshire Hathaway, look, they have so much cash, right?
Yeah.
If there is somebody out there that could buy the dip in size. Warren Buffett has to be the man.
Right, and also if you have the 2-year rising to 4.05% as we saw this morning, then cash feels good. You know, I would also say, though, if you look under the hood of the S&P 500, the sectors that are gaining are quite defensive still. You have healthcare, energy, utilities, consumer staples, real estate. You're seeing green on the screen, but it doesn't scream confident.
Yeah, because the biggest losers are Nvidia, right? Tesla, Amazon, Broadcom. So those big tech stocks that should be getting a boost from this GTC are not. Coming up, the OECD says Trump's aggressive trade policies have abruptly set the world onto a path of slower growth. More on that outlook and how Wall Street is coping. This is Open Interest.
While cyclicality has suffered domestically, cyclicality is alive and well in Europe. It's alive and well in Asia. The cyclicals in Europe continue to outperform. The cyclicals in Asia continue to outperform. So, kind of our big call this year was cyclicality isn't extinguished domestically. It's just migrating globally.
That's strategist partner Chris Verone on the show last week. We're going to talk also about how Wall Street strategists are coping with what's going on, because you're looking also now at all the gains that are being seen this morning. Very volatile. You're looking at the NASDAQ 100 that was up just a few moments ago, now erasing a lot of its gains. It's not quite at session lows on the day, but it is trying to regain that bid. Across Wall Street, you're looking at strategists trying to cope with this dynamic. Are we at the low? Are we not? And one of the biggest bulls on Wall Street, Ed Yardeni, is seeing some pressure under the surface. We're going to bring in Bloomberg's Michael Masika to talk more about what's going on. I was really struck over the weekend by Yardeni's note, because he said that he's calling it now the Trump thump. This idea that the best trade has been to short the S&P 500 since February, yet you're looking at a lot of investors now without even the firepower to go short. He says that they're not convinced that the correction is over despite the rally on Friday, and that there's extremely bearish sentiment readings, which tend to be bullish from a contrarian perspective, but he doesn't know if this time is true. So when you're looking across the street, Michael, ultimately, how many people are willing to dive into what has been extremely negative sentiment relative to what we've had in the past year?
Well, that's a good question. To be perfectly honest with you, it doesn't seem that the buy the dip moment that we expect has happened yet. There's been some deep buying. Some investors are looking to buy. Last week, a lot of hedge funds started to buy that little dips in U.S. equities. But it lacks conviction. Lacks convictions because volatility remains very high, because the trade uncertainty is very high as well. We don't know what's going to happen until the first tariff are going to be put in place in April. So all that is keeping investors really on their toes and not willing to dig in just yet.
You know, I was reading Mike Wilson's note over the weekend, and he points out we could see a little rally here. He thinks we started one at Thursday when we hit 55.05, but he doesn't see it really as sustainable. He says, we believe that earnings revisions is the most important variable, and it will take a few quarters for this factor to resume a positive uptrend. So I went and looked at the Citigroup earnings revisions index, and it does not look very good, Michael. I mean, down, down, down. When we came into this year, I was hearing 15% earnings growth, and now the average on the S&P is for 9%. How bad is it?
That's right. It's been like downgraded and degraded again, but it hasn't really fed into earning estimates for the year, or just barely. So we might have a lot more earnings downgrade, and it might just like be shown at an index level a bit later on this year. What's going on is like you have now a lot of economic data in the US that is rolling over. Consumer confidence is a bit down. The job market is shaky. You don't expect the Fed to act anytime soon. Yeah. So we'll see what's happening with the U.S. economic growth, but it's likely to be downgraded this year. Yeah. And earnings will follow as well. And so I think until we start seeing some of those, and some of those being priced in the market, then there is a big risk that we see some more drawdown.
Michael, great to have you on the show. Michael Masika there out of London. Just want to point out quickly, Shonali, that if I'll bring up the ECAN again, right? ECAN Go on the Bloomberg terminal, because he mentions economic growth getting downgraded. And ECAN now has Atlanta Now, the Atlanta Fed GDP Now forecast. You can see how much lower it's gone. And if you click into that blue box, which is exports, the real problem is imports. They've just dragged on tariff concern. Coming up in the next hour, Mira Pandit joins us from JP Morgan Asset Management. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today. And coming up, Fed Chair Powell faces a tricky task this week of assuring investors the economy remains on solid footing. Retail data out this morning adding to concerns of a pullback in consumer spending. And NVIDIA investors hope a keynote speech from CEO Jensen Huang at the chip giant's much anticipated AI conference this week will give the stock some momentum. Plus, pushing for an end to the war. President Trump says he'll speak with President Putin tomorrow, saying progress is being made.
All right, let's get a check right now what's going on in the markets just a half hour into the trade, and looking better than you might have expected if you took a look at futures this morning that were bouncing back and forth between red and green. Pretty solidly up on the S&P 500, 0.4% at 56.61, 56.62. Don't forget that we hit 55.05 on Thursday. That was Mike Wilson's level, and he called for a rally after that, at least for a while. NASDAQ 100 gaining as well, even without the support of the gigantic mega cap stocks that are on the downside, and then the 10-year yield holding right now at Shonali, you basically called this 430 level, right? You said this is like the new level.
Right, this is the new level. If we break too much in or out of it, you have to worry again about growth concerns to a greater degree. If we break too much above it, then you're worried about inflation and fiscal deficits. Neither of those are good things.
All right. Great that we got that cleared up. Let's bring in Mira Pandit now, JP Morgan Asset Management, global market strategist. Mira, great to have you here. I guess a growth scare is really the concern for this market, right? I mean, after we saw the OECD revisions, as we look at the Atlanta Fed GDP Now cast, the concern is that we don't get, 2% or more GDP growth. What do you think?
What we do need to be considerate of is starting points. Starting points matter. When we think about GDP over the last 4 years, it's been growing at an above trend pace. 9 out of the last 10 quarters have been at an above-trend pace. If we think about profits, we're coming into another strong expectation of profit years. Profit growth of 12%, even if we see half of that, and we're likely to see some degree of downward revisions, that would still be in line with a normal profit growth year. But it works both ways. We also entered the year with valuations very much extended. So really this sell-off was a question of when, not if, to see a pullback at some point this year. And the tariffs, the uncertainty, that's the why.
Now, one question I have, in addition to levels, you had Mike Wilson calling for 5,500 as a low. We've had other strategists call as low as 5,200. With that kind of uncertainty.
Leaving Kolonovich out, right?
Yeah.
Because he said the 4,000s.
Oh, right. Yes, that's a whole other thing. But, if you think about not only the level, but the time, there's a sense that maybe April could start to clear up some of this uncertainty. But there are others who believe it could take a lot longer, maybe the second half of the year. When do you think the clouds start to clear?
Let's put the volatility in context first. On average, we see about a 14% sell-off every single year. So what we're seeing so far this year is in line with averages. We've seen less volatility in the last 2 years, so we've just been a little bit out of practice. And 75% of the time, the market does end up positive to end the calendar year. So I do think that price targets that call for a higher S&P by the end of the year are still reasonable. But I think we need to see 4 things when we think about that time frame. One would be valuations coming down a bit more. The overall index is still about 20% more expensive than its long-term averages. Even if you take out the 10 best stocks or the largest stocks, they're still about 13% more expensive. Tied to that is earnings. See a bit more of an earnings downward revision from the heights we are today. That's going to have a bit of a valuation impact, so you're probably going to have to see prices move even a little bit lower. Third would be continuing to see somewhat more of Goldilocks data. Jobs, inflation, retail sales has been reasonably solid, although moderating. And then lastly, it's not that we need to see tariffs go away, but starting to see maybe a little bit of consolidation around tariff announcements or some more of a strategic direction that will help us rule out some of these second-order impacts to the economy.
Well,
and
winning,
growth.
right? I mean, what if we start to see Trump's tariff war win? For example, if the EU were to back down on its auto tariffs, dairy tariffs, meat tariffs, he already got Doug Ford to back down on his electricity surcharge. If you see that, and then you get tax cuts or, tax cut extension and real deregulation, if you get M&A starting to take off, we've all been waiting for it and it hasn't really happened. Are those things a catalyst?
That certainly presents the upside case and a pretty compelling one. Let's see how all of that does play out, because it's clear that with the deregulatory agenda, there's a bit of a push and a pull. It's not that all of the antitrust efforts towards tech have been taken off full sail. We still haven't seen as much movement on that agenda yet. And with the tax cuts, we're probably going to see an extension of the Tax Cuts and Jobs Act, but hard to put a lot more on that when we think about debt and deficits as a concern and how the bond market has been reacting to debt and deficits as of the last 6 months or so. But nonetheless, it can clear some of that uncertainty, and in and of itself, that is a catalyst.
One element of uncertainty, too, is when you look at what we saw out of the retail data this morning, the consumer picture overall, how the consumer contributes to growth, especially when the muddiness of the U.S. layoffs at federal agencies is not really seen through the data in full yet. So how much uncertainty is there, and what role does the consumer play in this market?
Right now, when we think about our forecast for this quarter, where we're seeing some of the least weakness is still around the consumer because of the very strong base, where that consumption has been pretty solid. And if you do look at measures of confidence relative to what consumers do, it's not always a one-to-one relationship. I mean, the pandemic is a great example where we saw 20 million people lose their jobs in a month, and yet people continued to spend throughout the pandemic. Now, there was stimulus there were other factors at play, but the consumer in the U.S. is often pretty resilient, so those consumer confidence measures may not tell us as much about that growth scare. What is interesting about some of those consumer sentiment measures, though, when we think about it from a market's perspective, is right now consumer sentiment is not so far away from where we were in 2011 during the debt downgrade, in 2008 during the financial crisis. And when we get to those kind of troughs in sentiment, what we tend to see is a pretty big market response a year later. So if you look at the peaks in sentiment over the last couple of decades, on average, 12 months later, you would have gotten a 3.5% return on the S&P 500. If you look at the troughs in sentiment, on average, you get about a 24% return. Again, valuations matter. We're not expecting another 20+% year, but there is some scope for recovery.
Mira, we thank you so much for your time this morning. That is, of course, we're looking for the measured view in this market because a lot of tough sentiment out there, but people are looking for that opportunity to buy the dip. Now, speaking of buying and selling, we're going to get a look under the hood with stocks moving this hour with Bloomberg's Isabel Lee. And, of course, we're doing my favorite story first when it comes to M&A. We're looking at Pepsi announcing a deal. We cover those beverage stocks a lot on this program, don't we?
So Pepsi is interesting because it's confirming its purchase of Poppi, which is a prebiotic soda brand, for a net price of $1.65 billion. So the total deal is $1.95 billion. It includes around $300 million of anticipated cash benefits. And the deal includes a potential earn-out consideration. Basically, this incentivizes sellers to still stay on board and still help with the goals and the milestones of the company. So recall that Pepsi has tried to launch its own brand called Soul Boost, but it wasn't really successful, so I guess they turned to just acquire. Well, now they have.
Yeah.
Poppi. And the so-called functional soda category is gaining traction. We have the likes of Fresh Direct CEO saying it's on fire. I do the quotes because he really said it. So it's really an interesting field because imagine you're drinking soda, but it has fiber and prebiotics. Would you try it?
I had been a big Poppi consumer.
Oh, yeah, you have?
No, see, Shonali will drink any new beverage, right? She's all about it.
Yeah,
I like just drinking water.
I'll get you hooked. You have no idea. The kombucha really takes off in the morning. I drink it most in the morning. It's interesting. Stock is up. I think that bodes well for M&A as you're talking about. There's another stock we're looking at as well that is not doing as pretty today.
Really not doing well. It's like
crushed.
down, 13% because it's dethroned by Klarna. So Klarna on Monday announced a partnership with OnePay, that's a Walmart-backed firm, to offer buy now, pay later to U.S. shoppers. So OnePay is a finance app, and Klarna will become the official exclusive option once it rolls out this year. And you can see shares in the firm really edging lower by 14%. And this is a big deal. We have the CEO of Klarna saying that this is a game changer because this comes ahead of their IPO and it comes ahead of their really big financial earnings last year. And the deal really gives Klarna access to Walmart's millions of customers.
It does not get much better. I mean, if you're a buy now, pay later app about to IPO and you make a deal with the biggest retailer in the world,
the only
gold.
thing you could have that's better is exclusivity with Amazon, one would argue. But to your point here, Walmart is the giant in the room. And honestly, with Klarna's IPO expected early April, huge rivalry to watch, Matt.
And they're Stockholm founded, and their company revenue climbed 24% last year. So who knows what that will be this year.
You are also watching Isabel Deckers. I was interested in that because going into today, it was the worst performer on the S&P 500.
By the way, I always think this is the company that makes porches, like decks.
Like decks?
Okay.
That's actually Trex. I confuse them, but this is not
they're
like
the
a
maker
paneling.
of Hoka and Uggs, so they're the worst
favorite for me and
today.
Katie.
You like
Yes,
Uggs?
I wish Katie would.
Katie wears Hoka shoes, and you wear Uggs.
I do.
Not for me.
Yeah, me too. But others do, and that's great. So they've been really having a tough time. And actually, if you look at the S&P 500 MEMB, M-E-M-B, they're down by 13.60%. Not Hoka, but the S&P Footwear Index. So can you believe it? So I think consumer discretionary is just really struggling because inflation is high. Consumers in general are struggling. But we have Hoka as the crowning glory of the company because we have a Bloomberg Intelligence note saying that there's plenty of room for growth and that Hoka could become a $2 billion brand in fiscal 2025. So one more thing. I also cover index rebalancings, and Outdoor Deckers was added to the S&P last March, actually.
You say Outdoor Deckers?
Deckers Outdoors.
Deckers Outdoors.
Deckers Outdoors.
That's why I think it's, okay.
Anyway, they're down by more than 20% since they were added.
Brutal.
So bye-bye to the index.
You know they own also Teva, which for me, when I was
I still wear Teva.
dousing myself in patchouli and bringing my hacky sack to see fish at Denison University, I was wearing Teva.
I wear Tevas
sandals,
when I go to the beach. Still.
Yeah?
Yeah, maybe I am out of touch, but I don't know. You know what's interesting to me about that?
You're all in on Deckers Outdoors.
I am. I wear a lot of it. But to the point that Isabel was making, a lot of index rebalancing funds got super burned, if you might remember. This is just one example
reading that on the Bloomberg terminal.
of exactly why. Isabel, we thank you so much for your time. That is Isabel Lee. We are actually going to talk more about what's going on under the surface of those big Wall Street funds. In particular, we're going to talk about dark pools because they're touting an even more opaque way to trade. We're going to discuss the boom in so-called private rooms.
Private rooms.
Ooh, on Wall Street.
Has a whole new meaning on Wall Street.
That's next. This is Bloomberg.
The Langham is more than a hotel. It's a cultural landmark, a symbol of timeless style and luxury. It's not just about expanding, it's about thoughtful growth. Each location reflects our dedication to preserving heritage and creating something extraordinary. That coupled with our own legacy for having been around for over 160 years, that's what sets us apart. A focus on your story, our legacy.
Let's get out of high interest to look at what's making headlines around the world. U.S. retail sales rose by less than forecast in February. Consumers pulling back on spending on autos, electronics, apparel, and they're eating out less as well. Despite the weak data, equities are rebounding because the spending pullback wasn't as bad as had been expected. And Chinese EV maker BYD has unveiled a new battery system that it says can charge a vehicle nearly as fast as it takes to refuel a regular gasoline-powered car. Based on the test, the company says the system can give nearly 300 miles of range in 5 minutes of charging on its new Han L sedan. BYD ADRs are up nearly 50% this year. And America's most prestigious colleges are rushing to the debt market at the fastest pace on record. Harvard, University of Pennsylvania, Stanford, all crowding to sell bonds, all within the span of weeks. The rush to sell debt is driven by worries over potential changes in tax and funding policies. By the way, Harvard also announced that it is eliminating tuition for students with families that have combined incomes of $200,000 or less. So that's pretty good news, Shonali.
There is a huge sea change in higher ed. Perhaps we'll get to it later, because for now it's time for the Wall Street beat. There's a story that is just soaring on the Bloomberg terminal, and that is Wall Street's infamous dark pools. They are getting even darker. It's today's big take. These are private rooms booming by taking off-exchange trading platforms and adding another layer of exclusivity. To talk about what's happening under the surface, Bloomberg finance reporter Catherine Doherty. You know, I was stunned by the data that you presented in this story. How have these dark pools gotten so big? These are not brand names. This is not the Goldman Sachs of JP Morgans of the world, although Morgan Stanley is up there. These are names like Intelligent Cross and Blue Ocean and DealerWeb. Who are they? What do they do?
So each of these off-exchange trading venues, they have a flavor of what appeals to individual investment firms, broker-dealers that are trying to figure out where am I going to get my best execution. And this depends on the size of the trade, the speed at which they need to fulfill the trade, and oftentimes who they're filling the trade with. So the introduction of private rooms within alternative trading systems, dark pools, is given investors the ability, and the brokers that are executing on behalf of the ability, to really figure out where am I going to get the best execution, because I know who is in this proverbial room, who is going to be the type of either market maker or broker dealer that is on the other side of my trade. And that gives just a little bit more certainty. Many of the market participants that I spoke to just talked about the fact that when you have the knowledge of who is potentially on the other side, maybe not a name, but the type of player that you're going up against and that you're going to fulfill your trade, that allows you to kind of sit back and know the type of execution, or you can expect the type of execution that you're going to get when the trade is fulfilled.
So what's the problem with private rooms? I feel like if I were a big institution, I might want to use those private rooms for certain advantages. Who's disadvantaged?
So the problems per se that have been coming up is this idea of transparency and the access to liquidity. So these dark pools, they do report their trading, their execution quality, and the volumes are very, very public. However, the volumes within a private room specifically are not broken out. So then that brings up questions of, if you just broke out those specific, even by percentage, how much is happening within this private room? How many private rooms exist within these dark pools? These are a lot of questions that got brought up in talking to a lot of the market participants. Even those that use them are saying, you know what, some transparency about that wouldn't hurt. It might even help, because if you think about the access to liquidity on a dark pool, you might only get 70% rather than the 100% that you're expected to be playing around with and to access.
Let's double down on what this means for market liquidity, because really so much of this is a function of so much activity since 2008 moving away from the banks into unregulated markets. Some people say this is a good thing, the banks are constrained. Some people say, well, wait a minute, where's all the activity going? And does it make up, I think this is the most important part, for the lack of liquidity you would get from banks stepping back? How do you know the answer to that?
So these are regulated marketplaces. So I'll just start by saying that. And many of the banks actually access some of these or run. You have Morgan Stanley running 3 dark pools, their own ATSs. These private rooms are operated by smaller broker dealers that the cost to set up either a single dealer platform or their own ATS is not enough.
Alternative trading system.
It's not enough to make up for when they're doing the cost, the benefit. It's just too much. And so the private rooms allow them to basically operate in a way their own ATS, but it's within the broader dark pool and an alternative trading system that is an independent alternative trading system that's not operated by one of the big banks. So that's where you're seeing a lot of the move of, instead of the big public lit markets, the exchanges NASDAQ and NYSE. Many of the volumes have been moving. We saw it at the end of last year for the first time surpass 50%. So it's become the majority of trading.
Very interesting stuff and a great story, Cato. I read this last night, and I knew it would be a hot one today. Wall Street's private rooms making dark pools even darker, written by Catherine Doherty. Check it out on your Bloomberg terminal or on Bloomberg.com. Still ahead, retailer Forever 21 files for bankruptcy for a second time. They still exist?
I was a big shopper there.
More on that next, and not a surprise from Shonali. This is Bloomberg.
And it's time now for social climbers. The company's making waves this morning. And first up, we're watching U.S. Steel because it says the Justice Department filed a motion to extend the briefing deadlines for a Nippon deal, rescheduling the oral arguments to the week of May 12th. And it will allow the government to complete ongoing discussions with the parties regarding the merger talks that never end. But U.S. Steel is up almost 2% on the news. And up next, Intel shares rising. Reuters reporting that incoming CEO Lip-Bu Tan considered significant changes to chip manufacturing methods and AI strategies as well. They're revamping the company's manufacturing operations, and that is one of Tan's core priorities. Markets like it. It's up more than 8.2%. And finally, keeping an eye on mall-related stocks after Guess received a takeout offer, and Forever 21 filed for bankruptcy after years of poor performance. Forever 21 has been battling rising inflation, intense competition in a fast fashion sector. Matt, I used to shop here a lot. This was the place we went to growing up. Forever 21 becomes Forever 25, as Jim Bianco called it online. And it's just one of many consumer companies that have been facing bankruptcies. Express cons among retailers in the past year, making it the largest sector to file for bankruptcies in the last year.
Yeah, there is the pie chart there. BCY Go is a fantastic function on the Bloomberg terminal that you can scroll through to check out all of the bankruptcies and see where they're split up. Consumer discretionary as the biggest, obviously the biggest slice of that pie. Healthcare and then industrials and real estate kind of bringing up the rear there. But very interesting stuff, and we'll see if this increases. Want to quickly get a check on the markets. We are almost an hour into the trading day, and we're still looking at green arrows across the board in terms of the indexes, even though we don't have really an outperformance of the biggest stocks on the S&P. Nvidia holding its GTC this week, and it is taking away 5 points from the S&P 500. Coming up, we'll take a look at the consumer and travel. This is Bloomberg Open Interest. Let's get a look at what's going on in the stock market an hour into the session. We still see green arrows on the S&P 500 up 0.25%. The NASDAQ really unchanged at this point, and that's because you have those big tech stocks down. Nvidia is down. Tesla is down. Amazon is down. Broadcom is down. Meta is down. Google is down. Apple is down. And all of those are the biggest losers on the S&P 500.
Yeah, you walked in this morning, Nvidia had a little bit of a boost. All of that is erased and more. And it's because, of course, that excitement around the Nvidia story this week, that big conference they have, is a show me story. This is a show me market. And we're going to get a look at more stocks that are showing investors something on either direction. With Bloomberg's Denitsa Seikova, what are you taking a look at? Netflix was interesting us this morning because of the Mag 7. It's a bright spot.
Yeah, let's start with one winner. That's Netflix. We saw a big upgrade at MoffettNathanson, which predicts 20% gain from here. So the target is 1,100, and that's 4% gain for Netflix today. It comes after a Good Friday, another like 3-4% gain. And it's based on the company's effort to monetize advertising, which is turning out to be quite well. We remember in January, they increased the price for that lower tier that comes with ads, and that's a bright spot where analysts see opportunities for growth. The company is off to a shaky start this year, but last year, obviously, it was up 83%. Subscribers grew another 20 million in the last quarter, and we're over 300 million subscribers. So clearly the business is growing and there is a lot of optimism around it.
Basically, investors liking Netflix streaming television looking more like normal television where you get ads.
Exactly.
It's, you know what, it was a FANG stock and it's not a Mag 7 stock.
That is crazy.
It's only a $400 billion market cap.
And especially because if you think about how poorly the Mag 7 has been doing, you're actually watching Netflix up on the year almost 7%.
Yeah, 6.5%.
Looks like weak sauce, but it's better than what you're seeing in most of the Mag 7.
I like that you're starting to use that phrase. DocuSign is... I love using the functionality that DocuSign
This is
offers.
the third time I hear this.
Right?
Everyone's so excited about it.
Yeah, but what's the deal with the stock?
Well, they have even more functionality for you. They're launching more AI tools, and we had a big upgrade from William Blair, and now the stock is up. Obviously, Friday we had earnings from them. We had like a 15% jump in the stock, so it's doing quite well. And of course, we're going back to AI, all those tools, simplifying signing agreements. And in the fourth quarter, we saw higher than expected profit and revenue, and boosted by this new artificial intelligence software. And the stock is still down year to date, but of course we're seeing optimism during it.
It's done nothing over the last 5 years. I mean, it's up like 20%.
Yeah, the pandemic times, this was the best year. So
pandemic was a huge jump. It lost all that, and then it's flatlined ever since.
Exactly.
But, you know, I was talking to Kyla Scanlon over the weekend, and she says, buy the stocks that you use. So we're back to kind of almost Warren Buffett type value thinking.
That's interesting. You know what Barry Ritholtz always says? Like, if you want to buy a Mac, take that money and buy Apple stock instead.
Yeah, absolutely. Because, you know, we're waiting for the upgrade.
Here's a 5-year of DocuSign, by the way.
Never come. Anyways, you know, let's move on to the Norwegian cruise line shares, too. I'm really interested in this, Anita, because cruise lines were such a hot trade last year. They were a gangbusters trade coming out of the pandemic. They've been hitting a blockage. Norwegian down more than 20%, but rising today.
Yeah, what we've seen with the whole travel industry is that there has been a lot of losses, and it comes back to that pressure on the high-end consumer and the consumer overall. We're actually seeing some optimism when it comes to Norwegian and a few other cruise lines. It's coming from JP Morgan, and they're upgrading to outperform, and a big part of it is how much it's down, so it's obviously attractive buy opportunity, but they're not seeing that huge hit to demand in 2025, which obviously has been a big concern. Everyone's so worried about the cruise industry. They have similar forecasts about Royal Caribbean, so clearly it's more of a wider industry thing than just the one particular name. Obviously, the target for Norwegian is pretty high. It's 56% upside from here, so quite bullish, obviously coming from a big sell-off. But yeah, we're seeing, obviously, Delta had some warnings about the consumer, so everyone's on edge when it comes to travel, but we're seeing some bright spots.
Yeah, we're going to talk to Elaine Becker in a second about the consumer and travel, but I read in the Journal this morning, it's wave season. Whatever that, Spencer Jacob, writes that stock movers thing. He says it's wave season. Like, there are increasing signs pointing to higher bookings, but if I'm trying to save money, if I'm worried about my job, a growth slowdown, the economy, if I'm worried about the stock market, the very last thing I'm going to do is book a cruise, right?
Yeah, they call it the wealth effect.
Yeah.
Stocks down, you don't want to buy expensive stuff.
But it depends on how much you're getting for it. If you look for a spring break ticket now, just to go to the Caribbean, you're screwed.
That's a really good point, because if you're going to travel anyway, right, if you have to do something and you had some fantastic expensive trip planned, then maybe you say, well, I'll do a cruise instead.
And we do have the perfect person to talk to.
Yeah, Denitsa, thank you very much. Denitsa Tsakova there, Shanali moving me along as usual to talk with Elaine Becker about the travel theme. Last week we found out from airlines that American travelers are booking fewer domestic flights. Elaine joins us now from TD Cowen, where she is a senior research analyst. So, Elaine, what do we know about the consumer right now? We've seen some pretty disappointing confidence numbers out of the University of Michigan, for example. How do you see it coming through in the booking data?
Yeah, so good question. We're seeing that the data is slowing on a year-on-year basis. A year ago, we were seeing traffic on a regular basis being up about 5 or 6%. And now we're seeing it in flat to plus or minus 2 or 3%. So we think that we think 24 was probably the peak, and 25 is shaping up not to be as good a year as the airlines thought it would be just 4 months ago.
So just 4 months ago, I was thinking about what me and Matt were talking about that weakening consumer data that we are seeing. How does that hit the tape when it comes to a lot of these travel companies? Are you seeing people just trade down, or are you starting to see people stop spending?
So it's a combination of both. And I know that's like the typical analyst answer. But if the airlines lower prices to attract demand, hotel companies and car rental companies haven't lowered their prices. And our very good hotel analyst, Kevin Koppelman, was commenting earlier today that they're not seeing any demand weakness and the hotels are telling him they're not seeing any demand weakness right now. So even if the airlines would lower fares, people are still looking at the total cost of the trip and saying, you know, hotels are really expensive. We have to either trade down there or we have to figure out a way to save costs. And it just doesn't work from a demand perspective for the airlines in that regard. So, you know, we think we're seeing a shift. Corporate travel is starting to come back a little bit as companies are making people come back to office 4 and 5 days a week. So that will offset some of the weakness in leisure travel, and also lower fuel prices will offset some of the weakness on the expense side. So margins, even though we're forecasting they'll come under some pressure, it won't be as ugly as it could have been if fuel prices stayed high.
Helene, I want to ask you to step back and take a look at this industry over time. I was living in Europe for the past 6 years before I moved back here, and we were flying from Berlin to Rome for 20 euros or Berlin to Madrid for 40, you know, and that was how it always was, incredibly cheap to get around Europe. And that was fantastic. And it makes you like okay with the hellishness of flying in economy class, right? Now that I'm back in the U.S., I'm paying much higher prices to travel around the United States of America, and Delta, American Airlines, United, all the same kind of hell in economy, right? For someone who's 6'3", it's just a horribly uncomfortable place to be, and they don't make it any better with the services. Why is it so bad in this country? Is this from like deregulation under Carter, or how come the airlines can't give us a better product?
Yeah, that's a good question. So here's the thing. The big difference between the U.S. and Europe is that Europe has an awful lot of secondary airports that some of the lower cost airlines like EasyJet and Ryanair, Wizz Air, and others make use of. And that enables them to keep their costs lower. In the U.S., and by the way, that's, as you pointed out, that's about half the market. About half the market in Europe is low-cost airlines versus less than 10% in the U.S. So it's significantly different. The U.S. doesn't have those secondary airports. Not only that, but we have fewer airlines, to your point. That's certainly going through the past 40 or 50 years since deregulation. And that obviously makes it difficult. Plus the airlines, plus they have very expensive labor contracts. That and fuel are their two largest expenses. So that weighs on expenses. And then the other thing that we see happening with the airlines too is airport costs. Airlines have been talking about this for the past year and a half, in the sense that a lot of airports, LaGuardia comes to mind, JFK, Newark, Chicago, they're undergoing massive build-outs, new terminals. I was in Atlanta over the weekend, and they're building a new terminal in Atlanta at Hartsfield. And when you think about the cost of building these terminals in the billions of dollars, and when you start to figure out what it will cost to move a passenger through the airport, the cost goes from something like $8 or $10 a passenger to $35 plus per passenger. So it's really hard to charge $29 or $39 for a ticket when it costs you $35 just to move the passenger through the airport, and you're not even looking at the direct operating costs, the cost of fuel, the cost of plane, the cost of the flight attendants, the crew, and so on. So I think that's a big difference.
Helene, we thank you so much for joining.
It does answer my question to some extent, but it's just frustrating. You know that for some reason in this country we have to pay so much more. I mean, sometimes 10x for such a bad experience. If I want, to fly like a normal human being, I've got to shell out thousands for a business ticket. Otherwise, I'm riding like luggage.
And it's interesting.
She's moving me along.
We have
time. We have time.
We're being told to leave. Matt, you're getting me in trouble. Helene, we thank you so much for your time today. And of course, as someone who just got home at 2 in the morning because of airplane delays, I feel you. I was in economy. The girl next to me all night was screaming in my ear about something or another. Anyways, we're going to move on. President Trump is set for talks with his Russian counterpart, Vladimir Putin. Of course, a lot of ramifications on what is going on with the war in Ukraine. We're going to discuss it with Wendy Schiller of Brown University and try to make sense of it all for you. This is Open Interest. Now, the Kremlin has confirmed that Russian President Vladimir Putin is due to speak to President Trump tomorrow. The U.S. is pushing for a 30-day ceasefire in the war in Ukraine. Trump told reporters aboard Air Force One on Sunday that there's a very good chance for a deal. For analysis, we're joined by Wendy Schiller. She's the director of the Taubman Center for American Politics and Policy at Brown University. Now, there's been a lot of turmoil, of course, in the relationship between the Ukraine and the United States. And if you think about the potential for a ceasefire, we have certainly seen hiccups to get to that path before and recently. So what is the uncertainty as we think through these discussions that are ahead between the president and the Russian president?
Well, I mean, I certainly think Putin is always a gamble. I think trusting Putin is a difficult thing with any certainty, but the same thing is true now for Donald Trump. He's shown the world that he can turn on a dime as well. Zelensky's troops have made moves, right? They've withdrawn from some limited Russian territory, and Zelensky has tried to sort of make up a little bit with Trump. But I think Trump has also said to Putin, we'll slap more sanctions on you. We will certainly turn on you as well. Trump wants to be the guy that ends this war. Obama couldn't do it when it first broke out in 2014. Biden couldn't do it. But if Trump can do it, I think he views it as a really important signal of credibility on the world stage. Even if the United States is going to withdraw from some things, you still want to be a player and influential. And I think that's really where Trump is playing both sides, or at least trying to play both sides against each other.
I mean, it would be easy enough if you can just give Vladimir Putin Ukraine and, offer him like a slice of Romania. But that's not really a win, is it? Doesn't he have to get something from the Russians? Doesn't he have to move them out of Ukraine in order for this to be considered a good deal?
I mean, what we've seen so far from the Trump administration is getting something from Ukraine, which is access to or part ownership of minerals and natural resources, which Ukraine has a lot of, not only what the United States needs, but what the world needs. Trump is looking for a benefit for the United States, not just to pay back the money that we've spent paying our own defense manufacturers for weapons we ship to Ukraine, which is the bulk of the aid we send to Ukraine, but some stake in Ukraine. And I think if Ukraine is strategic, they have to understand that Trump will stick with you if there's a stake for America in it, for him. I think just pushing Russia out doesn't do much for Trump's motivation. I don't think that's going to make him really go to the mat, but also establishing that Putin can't just go wherever he wants without the United States as a player. It's a projection of power. And Trump likes projection of power when he can see an end line, an end game that he can claim credit for.
Wendy, while we have the United States looking to their strategy abroad, there are also a lot of questions here at home. One of them is in regard to how the administration, particularly Elon Musk and his DOGE efforts, has been handling the firing of federal workers, and a very mixed response and a lot of pushback from American judges on how the DOGE efforts are being handled and how the data is being handled. What kind of pushback do you think will start to build, particularly as we head even further into the midterms, as they continue to try to cut costs throughout the U.S. government and the impacts that has on American workforce and American economy?
Well, there's two different strains. One is political and practical, right? We have government policies in effect that help or assist or serve millions and millions of Americans, 50 million, 70, 100 million Americans depend on things, anywhere from food stamps to veterans of Social Security. If they stop working, those millions of Americans will be very angry. And they will try to take their anger out on members of Congress, but that won't happen until 2026. And Trump is not on the ballot technically in 2026. But we don't want a lot of unrest. I mean, that's bad for the economy, it's bad for approval ratings, and it's bad for Trump's popularity. So there's a practical impact to all these cuts. But there's a political one as well, which is the House of Representatives, and now even the Republicans in the Senate are basically 100% aligned behind Trump. There is no breaking that bond that we can see right now in the immediate future. So unless there is a practical impact where the economy of towns where lots of federal workers were laid off, that they start to break, in other words, they start to flounder, and people can't get answers, that will push the congressional pressure. But how much the Trump administration regards congressional pressure in a time when even the Democrats sort of caved last week, that's a real question mark for us. As far as the courts go, Trump is pushing the federal courts in terms of balance of power with the executive as much, if not more, than Richard Nixon did. And we just don't know how this will turn out. The Supreme Court will be instrumental in ways that we probably couldn't even have imagined a couple of years ago on the overall constraint on the executive in the United States political system.
Wendy, leaving that aside, right, as an historian who has seen prior administrations try and reduce federal spending, seen prior administrations try and shrink the size of government, what kind of grade would you give the Trump administration, and what kind of likelihood is there that they actually managed to get our deficit down to 3% of GDP?
I have a more than $7 trillion budget. You have 2.4 million federal employees. Maybe now we have 2.3 million federal employees. If they've managed to eliminate 100,000 positions, still a pretty big government. The issue is you can eliminate the employees, but if you don't eliminate the programs themselves, the congressionally created programs that people depend on, then you're just going to have to rehire people or find another way to pay for the servicing of the programs. So reducing the scale of federal programs is something they haven't even begun to touch. So I just don't know how much progress they will be able to make. Some of these jobs have gone away to AI anyway, maybe not park ranger jobs, but other jobs that we've seen in bureaucracies. So how much of a dent they're making in the scope of federal government, we haven't begun to see that happen, and that will require Congress.
Wendy, we thank you so much for your time and analysis. This is obviously an ongoing discussion. We're looking forward to hearing your thoughts moving forward. That is Wendy Schiller of Brown University. And later today, we're going to hear from Council of Foreign Relations President and former U.S. Trade Representative Michael Froman. You're not going to want to miss that. It's at 4 p.m. New York time. This is Bloomberg.
Apple's upcoming iPhone 17, the main product, will still have a charging port. Apple has been looking into adopting a port-free design and will do so with its iPhone Air. But for the regular iPhone 17, it's going to keep a USB-C connector. This new phone, the main phone, is moving in the direction of a port-free future, and we'll see that with the slimmer iPhone Air, but the main one still is going to have a place to plug in. You don't really need it, right, anymore. I mean, I charge my iPhone every night just by a wireless connection, and I never plug it in for juice. So
I guess you can use the magnet.
Exactly. I use the MagSafe thing. I put it next to my bed. But the interesting thing to me will be if you don't have a port, you don't even have a place to put in headphones. You don't have a place for fast transfer of data. So
right. And what do you do when you're on a plane? Last night, I needed to charge my iPhone on the plane.
I'm sure.
So it kind of all ties together there. There's your tie-in.
I'm sure. Interesting to see Apple down this morning on the S&P right now. And we're seeing all the big tech stocks on the downside. If you put up your move function, you'll see NVIDIA, Tesla, Apple, Amazon, Meta, Broadcom, Microsoft, and Google, all the biggest losers in terms of deducting points from the S&P 500.
Yeah, it's interesting. Let's see if NVIDIA could turn that story around this week. So far, not looking good for today, though.
All right, that's all for open interest. Victoria Fernandez of Crossmark joins us tomorrow, as well as Goldman's David Costin and Ireland's Deputy Prime Minister. This is Bloomberg.
क्रूड ऑयल ओपन इक्वल टू हाई अगेन, हाँ फिर से ओपन इक्वल टू हाई ही बना है वहाँ पर। लास्ट 2 कैंडल देखोगे, ये भी ओपन इक्वल टू हाई था, ये भी ओपन इक्वल टू हाई था। ये जानबूझ के बार बार ओपन इक्वल टू हाई बनते जा रहा है। ऊपर भी देखोगे ये कैंडल सेम ओपन इक्वल टू हाई बन गई। इस सपोर्ट एरिया पे भी ओपन इक्वल टू हाई और ये भी ओपन इक्वल टू हाई। ध्यान रखना कल आपका सीपीआई का डेटा है, सॉरी रेट कट का डेटा आने वाला है। डेटा इन द सेंस ऑफ एफओएमसी डेटा कट होगा कल, उसका इम्पैक्ट पड़ेगा तो मार्केट हो सकता है थोड़ा साइलेंट हो जाए कल। आज और कोई डेटा है नहीं बिकॉज, तो कल इवनिंग पे क्रूड ऑयल की इन्वेंट्री है, फिर रात को 11:30 बजे फेडरल फंड रेट कट का डिसीजन आएगा। फिलहाल फोरकास्ट तो न्यूट्रल ही है, कुछ नहीं होने वाला। देखते हैं कुछ होता है तो स्टेटमेंट जरूर देखेंगे, तो इसका इम्पैक्ट इंडियन मार्केट में परसों, बाकी यूएस मार्केट में कल ही मिल जाएगा। बाकी थोड़ा सा यूएस में भी ध्यान रखना। यूएस में आप लोगों को पता होगा वहाँ पर 2017 के बाद H7N9 H7N9 जो बर्ड फ्लू होता है, उसके भी बहुत सारे केसेस आने लग गए हैं। तो वहाँ पर भी एक स्टेट है, मुझे उसका नाम याद नहीं आ रहा, वहाँ पर हेल्थ इमरजेंसी लगी हुई है ऑलरेडी। अगर पूरे स्टेट में फैल गया तो उसका एक नेगेटिव इम्पैक्ट इकोनॉमी पे भी हो सकता है, मार्केट पे भी हो सकता है। अभी इतना स्प्रेड हुआ नहीं है, बट पिछले काफ़ी टाइम से कंटिन्यूसली ज़्यादा ही केस आए जा रहे हैं यूएस में स्पेसिफिकली। नॉर्मली 1-2 केस आ जाए तो इतना कुछ इशू होता नहीं, बट वहाँ पर एक तरह से आउटब्रेक हो रखा है उस स्टेट में।
News when you want it with Bloomberg News Now. I'm Nathan Hager. President Trump speaks this morning with Russian President Vladimir Putin. It is a high-stakes call on ways to end the war in Ukraine. Bloomberg's Tyler Kendall reports the Russian leader is already making demands.
Putin wants to see all weapons flows to Ukraine halted amid Bloomberg News reporting that he could really slow-roll these negotiations over concerns about Western security assistance, Ukraine's neutrality, and seized territory. Now, for the most part, this White House, as you heard there from President Trump, has remained relatively optimistic despite Vladimir Putin failing to publicly commit to that 30-day peace plan that the U.S. is backing. I spoke to one foreign policy expert who described this as a tightrope for the Kremlin, considering Moscow does want those strengthening in relations with Washington.
Bloomberg's Tyler Kendall reporting from the White House. President Trump is calling for the judge who ordered a halt to his deportation flights to be impeached. The president went on Truth Social this morning to call federal Judge James Boasberg a, quote, radical left lunatic. That's a day after Justice Department lawyers refused to give the judge answers on whether Trump violated his order by flying hundreds of accused Venezuelan gang members to El Salvador. Trump used the Wartime Alien Enemies Act of 1798 to expedite those removals. The judge is now giving lawyers till noon today, Wall Street time, to file the information he's looking for in a sworn statement. The ceasefire between Israel and Hamas appears to be shattered. Israel carried out multiple airstrikes in Gaza overnight, killing more than 400 people, according to Palestinian health officials. UN Ambassador Danny Danone says the attacks won't stop.
We will make it very clear to the Security Council that if they want to stop the war in Gaza, they have to ensure that the hostages are coming back to Israel.
Some hostage families are criticizing the Israeli government for resuming the fighting, but the White House says Hamas chose war by refusing to release hostages. On Wall Street, stocks are taking a turn lower as the Fed begins its two-day policy meeting. Policymakers are expected to keep interest rates on hold while they wait to see the impact of President Trump's trade policies. Treasury Secretary Scott Bessent says reciprocal tariffs on individual countries will be a win-win.
On April 2nd, we're going to produce a list of other countries' tariffs, and we are going to go to them and say, look, here's where we think the tariff levels are, non-tariff barriers, currency manipulation, unfair funding, labor suppression, and if you will stop this, we will not put up the tariff wall.
Treasury Secretary Scott Bessent says there's no reason for the U.S. to enter a recession, but he says there could be a pause as the economy transitions from relying on government spending. Bessent appeared on Fox Business this morning. We did get some more economic data from the Fed. Factory production rose 0.9% last month. That was the biggest jump in a year on a surge in car manufacturing. And new home construction jumped more than 11% in February after a weather-related plunge the month before. Our coverage of the Fed's March decision begins tomorrow afternoon at 1:30 Wall Street time on a special edition of Bloomberg Surveillance. The Fed Decides on Bloomberg Radio and Television and on the Bloomberg podcast page on YouTube. Ahead of it, though, the S&P 500 is down 1.1%. The Dow is 0.5% lower. The tech-heavy NASDAQ composite is leading the declines, now down 1.9%. Tesla shares are down about 6.5% after a big breakthrough reported from its biggest Chinese competitor, BYD. Bloomberg's Kriti Gupta has that.
They released data around an EV that suggests that they can charge their electric car in just 5 minutes. Now, that is charging time that really eclipses a lot of the other competitors that they've been dealing with, not just with Tesla,
people think
but
about in
with likes of
comparison.
Mercedes-Benz here in Europe as well.
That's Bloomberg's Kriti Gupta.
क्रूड ऑयल में बाई मत करना गाइस अभी, ठीक है। वो लास्ट दोनों कैंडल ओपन इक्वल टू हाई बनी है, तो ओपन इक्वल टू हाई पे डायरेक्टली बाई नहीं कर सकते। बाइंग आनी होगी तो एक कैंडल वापस अगर क्लोज करती है ब्लू कलर की लाइन के ऊपर, फिर उसके नेक्स्ट कैंडल पे ट्राई करेंगे। अगर नहीं होता है, नीचे आ जाता है, तो लेट इट गो। इट मींस सपोर्ट होल्ड नहीं हो रहा है, वी कांट बाय ऑन दैट केस।
On top of that, RBC analysts cut their price target for Tesla to $320 a share. They say they don't think the company's going to charge enough for full self-driving. Right now, Tesla shares are trading at about $222. After 9 long months, 2 NASA astronauts are finally away from the International Space Station.
Docking confirmed. Freedom is free of its moorings. Sonny Williams and Butch Wilmore begin their belated trip home.
Mission Control in Houston captured the moment the SpaceX Dragon capsule left the station early this morning. It is now due to splash down along the Florida coast around 6 o'clock this evening, Wall Street time. That's news when you want it. With Bloomberg News Now, I'm Nathan Hager, and this is Bloomberg.
I think super positive. I mean, I think it was promises made, promises kept. And I think the SBR, for most people that were crypto native, were not expecting open market buying. And I think this actually is a good next step to get these various pieces of regulation that we need. So we've already seen the Genius Act with the stable coins, and I think we will get a market microstructure bill sometime during the Trump presidency, which is so important at helping to ensure that the U.S. is the home of crypto innovation, not just in the Trump administration, but from here forward. These executive orders are really exciting and enticing a lot of ways, but those can always be undone, right? And that's what the Trump administration has, hopefully promised will bring forward, is actual regulation that will be put into law and then will be here forward.
All right, Rich, thanks so much for joining us. Appreciate it.
Thanks for having me.
Coming up, we're going to take a look at what investors should expect from the auto world with tariff uncertainty looming. We'll have that for you next on Catalysts.
We're doing pretty well, I think, with Russia. And,
so, Dan,
we'll
talk to us about this escalation and really what this means for potential ceasefire talks in this conflict.
Good morning. Well, there was no ceasefire, so really this resumption of fighting was just a matter of time. There may be an element of tactical surprise here. Indeed, Israeli public opinion was largely diverted in recent hours by internal discussions about the fate of Israel's Shin Bet security chief, his termination. It could be that that discussion was actually meant to provide a smokescreen for the resumption of these Israeli attacks. But nonetheless, given that the last agreed ceasefire expired 17 days ago, a resumption of fighting was to be expected. Israel, with the backing of the United States,
Today,
accused Hamas of...
Palestinian authorities say hundreds are killed as Israel strikes Gaza. Trump and Putin are set to discuss the war in Ukraine and control over Europe's largest nuclear power plant.
And 2 astronauts stranded on the International Space Station begin their journey back to Earth. It's Tuesday, March 18th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Christopher Waljasper in Chicago.
And I'm Tara Oakes in Liverpool. An ambulance races to the site of an airstrike in Gaza. Israel has pounded the enclave, collapsing a 2-month ceasefire with Hamas. Palestinian health authorities say over 300 people have been killed, many of whom were children. Panic at hospitals as injured Gazans are brought in. Piles of dead bodies covered in white, blood-smeared plastic stacked up on the ground. The strikes were reported across multiple locations in the Strip. Hamas has issued a statement accusing Israel of violating the truce.
The Israeli military says it targeted mid-level Hamas commanders and leadership, as well as Hamas infrastructure. They say the offensive will continue for as long as necessary and extend beyond airstrikes. There are still 59 hostages being held in Gaza, whose fate remains uncertain. A White House spokesperson says Israel consulted with the Trump administration before it carried out the strikes.
US President Donald Trump is set to speak to Russia's Vladimir Putin this morning about ending the Ukraine war. Territorial concessions by Kyiv are likely to feature prominently in the talks, as is control of Zaporizhia, Europe's largest nuclear power plant. Christian Lowe has been following the story in Kyiv. So, Christian, what's happening at Zaporizhia on the ground right now?
The situation on the ground is that for some time now, Zaporizhia nuclear power plant has been controlled by Russia. So after Russian forces pushed through westward into that part of Ukraine, they took control of the power plant. It's basically been partially shut down. It's not actively producing power. And there are lots of concerns about the safety of this nuclear power plant because, in essence, there's a war going on around it. And there have been instances where munitions have landed on or near to the nuclear power station, and that's caused real concern by the UN agencies that are responsible for nuclear safety, because their point is you cannot wage a war around a nuclear power plant. That could be catastrophic. And this is, let's remember, in a country that had the Chernobyl nuclear disaster. So there's real concern about this, and I think a desire to resolve this situation.
So what does Russian control mean at the plant?
It doesn't help Russia enormously because it's not actually functioning. And part of the problem is that a nuclear power station needs vast quantities of water for cooling. The water is no longer available because a dam that created the reservoir that supplied the water blew up earlier in the war. So it's hard to see any immediate effective future for the power station. One of the scenarios could be that Russia actually decides to hand it back to Ukraine, letting the Ukrainians take it back. There's no longer a conflict going on around it. That would ease lots of concerns about nuclear safety. And Ukraine, at some point in the future, could start using it to supply its electricity grid.
What's the Kremlin said about it?
The Kremlin hasn't really commented on Zaporizhia at all. So their position is, we control it, we're trying to keep it safe. They accuse Ukraine, actually, of creating risks to it. They say that Ukraine fires on it. Ukraine says it's actually the opposite, and Russia is creating the risks for the Zaporizhia power station. In terms of what they want to do and get out of the talks with Trump about the power station, we just don't know at this stage. They're keeping their cards pretty close to their chest.
A federal judge has given the Trump administration a deadline of today. He wants details about plane loads of Venezuelans who were deported to El Salvador, despite orders not to. Trump claims they are members of the prison gang Tren de Aragua, which he has designated as a foreign terrorist organisation.
Mr. Carney, would you like the Prime Minister to show more support to Canada?
Canada's Prime Minister Mark Carney arriving at Downing Street, where he says he is strengthening ties with reliable allies. And the new leader is sending a clear message to the US as tensions rise between the two countries.
We've called out those comments. They're disrespectful.
Carney met with British and French leaders on his first overseas visit. If you want to know more about what Carney's up against as Canada's new Prime Minister, we released an episode over the weekend that goes into all of it. There's a link in the podcast description.
Hong Kong shares hit a 3-year peak on Tuesday, with Chinese electric automaker BYD leading the charge. Pun intended there. Carmel Crimmins has more.
Nice, Tara. I see what you did there. So BYD shares jumped 6% after it unveiled a new charging system that it says can charge an EV as fast as it takes to refuel a regular car. This could be a game changer, convincing drivers who aren't willing to make lengthy stops to go electric and kick off a new supercharging race. It also underlines how investors are turning positive on China. Chinese government promises to support consumption and the rise of AI group DeepSeek have triggered a big rally in Chinese stocks, with the Hang Seng up 23% so far this year, easily the largest of any major market.
Butch Wilmore and Sunny Williams are returning home after an 8-day-long test flight of the Boeing Starliner spacecraft turned into being stranded in space for 9 months due to technical problems with the Boeing craft. The NASA astronauts have undocked from the International Space Station and are expected to splash down off the Florida coast later today. Joey Roulette has been following the mission.
Butch and Sunny have been on the ISS since June, and a lot of people think that they're either floating out there in space or something, or it's like Sandra Bullock in Gravity where everything's really dire. But the reality is they had their test mission turned into just like a normal astronaut stay on the ISS. And so they've had company with Russian astronauts, Japanese astronauts, and their fellow United States astronauts as well. And they've been doing research, all different types of experiments and maintenance on the ISS. And in fact, Sunny Williams did, I think, 2 spacewalks while she was up there on the ISS. But that doesn't really negate the fact that it is probably hard being up there for on a mission that you thought would only last 8 days. I think the psychological toll that would take on anybody would be great. But these are veteran U.S. Navy test pilots and veteran NASA astronauts too. And so when you ask them how they feel, or how does it feel to be stuck in space for that long, unexpectedly, they say, we trained for this. Although our mission was supposed to last 8 days, we prepared for the unexpected. That's what we do. We're astronauts. So they sound good. They sound like they're doing healthy and they're doing well.
So what happens once they make it back to Earth?
So they splash down. They'll be helicoptered over to NASA's Johnson Space Center, and they'll spend several days there for medical checks. NASA scientists and health officials from the astronaut office are going to do the most intense physical they've probably ever gotten to see how their body has changed while they were up there on the International Space Station.
And for today's recommended read, an exclusive on Intel's new CEO and his plans. Lip-Bu-Tan is considering an overhaul to the ailing tech giant's chip manufacturing methods and its AI strategies. There's a link to the story to find out more in the pod description.
For more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favorite podcast player. We'll be back tomorrow with our daily headline show.
One portfolio manager describes why 2025 is the time to lean into the value trade. And Harvard is offering free tuition for families making under $200,000. But the big question is, are all of your costs really covered? We discuss with an expert from the Princeton Review. Plus, it's travel week on Wealth. Ahead of the spring and summer travel seasons, we're bringing you tips for families to budget wisely for that upcoming vacation. All we ever wanted, gotta get away. All right, but first, we take a look at some of the market action. 90 minutes into the trading day, stocks sliding as volatility continues following two winning sessions that we have seen. Take a look at the major averages down across the board. The NASDAQ leading those declines right now by about 2%. The top mega cap tech names have been taking a beating so far this year, with the Magnificent 7 ETF down over 12% year to date. And as the tech trade unwinds, our next guest says 2025 could be a tough year, and it's a good time to lean into the value trade. Here with more, we've got Matt Powers, Powers Advisory Group Managing Partner. Always a great pleasure to grab some time with you. So let's just take a step back and just define the value trade and how you're kind of assessing the opportunity within that element for folks' portfolios out there.
Hey, Brad, good morning. Thanks for having me. Yeah, it's there's been a big shift from the last 2 years. This narrow focus on the Mag 7, the AI trade is getting hit hard in 2025. You just showed those numbers. But those same stocks made up, half of the S&P's returns last year. Now they're down, averages 12%. It's driving a lot of the market losses this year. We all know valuations were stretched, and now they've come to reasonable levels. But there's momentum. There's a reversal trade taking place. Kind of came quietly, but it's in the forefront now. We've got sectors like healthcare, staples, and materials leading. I say this a lot, but this year is just gonna look a lot different than what we've seen, and could shape up to be a tough year, especially broad-based index investors. It's easy to index on the way down. But bottom line is we're moving back to where you have to be more selective, back to some of the tried and true fundamentals, which leads into that value trade.
And so what is an investor's checklist for other opportunities and identifying those other opportunities given the unwind that you were mentioning within the Mag 7?
Yeah, it's, so some of the sectors, I guess if you went into the sectors that we like, they're not exciting. It's not names that they're household names, put it that way. But we're looking, more of an entry point into traditional names with incredibly strong fundamentals. And, they're ones that we like, and they continually hit our screens. And we think this is exactly what investors should be looking at right now. There's really no need. I mean, right now you could buy the dip, which historically is the right move for long-term investors, but there's no need to make drastic allocation shifts until all of this heightened uncertainty settles. We all know what it's around. The word tariff is thrown out. And, I mean, you've heard it more than I ever have. And, leaning into that value trade, into dividends, and overweight some defensive areas of the market, uncertainty always drives volatility. But that combination of growing dividends and attractive relative valuations, it gives investors a higher level of predictability.
Yeah, for many investors, this is the first time that they've heard the word tariff this much, especially as compared to the last 10 years, according to FactSet. This is the first time that we've seen this many mention of tariff on earnings calls for S&P 500 companies over that 10-year time span. So all of that considered here, within the value trade, are there specific picks that you would be monitoring right now and suggesting to some of your own clients?
Yeah, going back to that, our picks, they're, again, right now, and I think this is where you need to be, they're not exciting. But it's somewhat of a level of protection, and which is tough to find right now. So one thing I'd like to say is that we're seeing this rotation out of tech, but it's not moving to cash. It's actually moving to other areas. And two areas we like are leading, two of the leading sectors year to date, but healthcare and staples. I mean, healthcare, clearly defensive. They've got a headwinds from aging population, should drive long-term demand, and essential services are always there. And consumer staples, I mean, steady, reliable, dividend payers, lower volatility. It's some of this inflationary issues, they can pass on the rising costs without losing demand, but specific companies. So in healthcare, we like J&J. I mean, they've got an attractive relative valuation. Yields a little bit lower, but they've got a long history of growing it. We all know they've been in and out of legal battles, it seems like forever. But the stock's maintained its strength, and we like Pepsi. So interesting one here. It's trades well below its 5-year average PE, forward PE at 18 versus 21. And it's lagging the staple sector, but a great dividend payout. And yesterday, I think everyone has seen this news. I didn't know much. We liked Pepsi before this, but they announced the acquisition of Poppi, which is a healthy soda. My teenagers love it. Had never heard of it until just recently, but they're always wanting it. For around $2 billion, traditional soda sales are declining and moving towards a healthier direction. So on surface, it appears to be a positive step in the right direction.
Matt, always a pleasure to grab some time with you, and seeing the bracket roll out. Good luck to Duke in the coming weeks as well.
Thank you. Agreed. SIUE, upset alert. That's my son's school. So
there you go.
Good talking to you.
Likewise. Good to see you. It's now time for some of today's trending tickers. Scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, U.S. listed shares of Grab Holdings. They are rising after the ride-hailing and food delivery company said it's going ahead with its attempted takeover of rival GoTo Group. This is according to Bloomberg. Now, Grab is assessing GoTo's accounts and operations. Talks are reportedly ongoing, but may not lead to a transaction, according to people familiar with the matter. Grab Holdings is backed by Uber. Next up, PepsiCo downgraded to equal weight from overweight at Barclays. The price target reduced to $156 a share from $168. The analyst citing some concerns over the snacking business, particularly in the Pepsi brand Frito-Lay's, which has seen 6 sequential quarters of volume declines. The analyst also says the economic pressures have weighed on the snack market overall. And finally here, Ralph Lauren getting an upgrade to buy from neutral at Goldman Sachs. Price target set to $286 a share there. That is 30% upside from the stock's last close. And the analyst sees recent volatility in consumer discretionary as a buying opportunity in strong brands. The analyst saying improving execution and brand momentum will help gain market share and expand margins. The analyst also mentions that Ralph Lauren has limited exposure to risks like tariffs, department store slowdowns, and health of lower income shoppers versus competitors. Another trending ticker this morning, NVIDIA CEO Jensen Huang takes the stage today for the company's annual GTC conference. Our very own Dan Halley is on the ground in San Jose, California, and joins us now with the latest there. Dan, all right, the sun's out since the last time we checked in with you. What are we anticipating here as Jensen Huang is set to take the lapel mic, if you will?
Yeah, Brad, we're expecting a slew of announcements from NVIDIA here with the SAP Center in San Jose. And essentially the big news that we're looking for is around NVIDIA's next generation lines of chips. There's expectations that we'll see what they call the Blackwell Ultra, and then beyond that, the Vera Rubin line of chips that they have kind of hinted at in the past with some roadmaps. So hopefully we hear more about those. I think the big deal we're going to see is NVIDIA addressing all the fears around DeepSeek. Now, you remember when DeepSeek was shown off in late December, that it sent NVIDIA shares plummeting, as well as a number of other AI stocks, just on the fear that that model being built reportedly for about $6 million compared to the hundreds of millions of dollars that Silicon Valley companies had spent, meant that they wouldn't have to purchase as many high-powered GPUs. And so NVIDIA has been pushing back against that, essentially saying, look, these reasoning models, these thinking models like DeepSeek R1, like OpenAI 1, like Google's Gemini Flash thinking, they benefit from more high-powered chips. And the reason being is that with those chips, they're able to reason faster and provide faster responses than if you were using low-end chips. So expect Jensen to dive into that, kind of go through how these reasoning models are going to benefit from NVIDIA's latest lines of chips. And then there's also the discussion on quantum computing. Now, that's something that's raised eyebrows. Jensen Huang had said that quantum isn't really near a practical use case at this point. Other CEOs like Google Sundar Pichai have said, well, it's 5 to 10 years we'll see something. But the reality is nobody really knows at this point. But NVIDIA is hosting its first quantum day. So that's very important to look out for. There'll be CEOs from quantum firms having a panel discussion with Jensen. And I think more broadly, you can expect plenty of software announcements from NVIDIA. We talk mostly about the chips, but they are a software company as well. They offer a plethora of software options for taking advantage of their chips, as well as building additionally on those. So it's going to be a packed show.
All right, Dan, we see the sun rising over some of the skyline there, hitting the SAP Center behind you. We'll allow you to get on inside and take a look at the vibe that's really transpiring in a moment from now. Thanks so much, Dan. Coming up, we dive into the state of the housing market with the latest data showing an uptick in new home construction. But how big of an impact could it have on supply? That's the big question. We dive into that after the break.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
New home construction surged more than anticipated in February, up more than 11% from January. Senior reporter Danny Romero joins us now on set with more here. So Danny, what do we know?
Brad, builders broke ground on more housing projects in February. Housing starts rose more than 11% to a seasonally adjusted annual pace of 1.5 million units. And that beat economists' expectations, who were expecting an annual pace of 1.38 million units. The rebound in housing starts really was led by single-family construction. And what's really interesting from all of this is that this data comes out when home builders are really feeling not that confident about the housing market, and that they're dealing with President Trump's tariff policies, the ongoing challenges of high housing costs. Remember, Trump last week imposed a 25% tariff on all imported steel and aluminum products, a policy move that will likely push housing costs even higher. According to the National Association of Home Builders, they revealed in their March survey that they're estimating that tariffs could increase the cost of a home by $9,200. And economists are expecting that home builder confidence will likely fall, and it then also will put pressure on new construction during the second half of this year.
And Danny, Redfin data out this morning as well that we just saw says that home prices in February actually grew at their slowest pace since July on a month-over-month basis. What can you tell, Sarah?
There's good news for both buyers and sellers as we kick off this spring selling season. Like you said, Redfin reported that U.S. home prices rose 0.4% in February on a monthly basis. That is the slowest pace since July of 2024. The combination of mortgage rates moving lower, also the slower price growth could bring out more buyers from the sidelines. However, some areas in the country like Texas and Florida are dealing with homes sitting on the market, but this is an opportunity for buyers to negotiate the price. It's becoming more of a buyer's market in some areas.
In some areas, okay. Danny, we're going to be watching closely for where it becomes a buyer's market in other areas too. Hopefully that grows out a little bit more. Appreciate it, Danny. The Trump administration is taking steps to combat housing affordability. Secretary Scott Turner and Secretary Doug Burgum announced the formation of a task force to identify federal land where affordable housing can be built. Jessica Lautz, National Association of Realtors Deputy Chief Economist and Vice President of Research, joins us now. Jessica, what would efforts like this ultimately take? And then what type of relief could we see on the affordability side if this were to come to fruition?
Yeah, absolutely. Thank you for having me back. So, I mean, certainly if we can free up any land to actually build homes, especially at affordable price points, that could be some relief for home buyers who really have been shut out of the market in the last few years, especially as we think about this inventory crisis. Now, if we look at areas perhaps like Las Vegas, that could free up some inventory. And we know that home prices have really been on the rise in that area.
And so what else does the federal government, also in tandem to just freeing up land, need to do to combat the affordability crisis?
So when we think about the affordability crisis and we think about the inventory crisis, a lot of this is actually based in local markets, in local regulations. So as we think about this, it really is helping to free up building at the local level. And some of that really does come down to NIMBYism, not wanting this new development in my backyard, but really thinking about how we do need that development to come in. So perhaps thinking about adaptive reuse, using those vacant hotel motels, those vacant schools to bring in residential units could really be helpful in local areas.
You know, this is interesting because we've also seen some of the climate considerations and insurability in specific markets also impact the home buyer sentiment and ultimate kind of thought process. How are you kind of measuring that up against some of the typical hotspots that we've seen in years past versus where some of that insurability is taking a hold among buyer mindsets right now?
Well, certainly this is a nationwide issue when we think about just adding on insurance into the cost of home. And so while we think about perhaps weather events happening in localized areas, that actually does impact on a nationwide scale. But I think what we're looking at is home buyers really factoring in the total cost of home ownership. So thinking about insurance costs, but also thinking about what are my commuting costs if I now have to be into work 5 days a week when perhaps I could work remote. All of those are big factors when we think about how consumers are approaching homeownership. And perhaps that's been a little different than what we have seen during the pandemic years versus where we are right now.
All right, I got to hustle to my finish here, but I want to get into two topics. One of them, spring home buying season. What are your projections there? What are you anticipating?
Well, certainly we are expecting that there will be more homes coming into the market. More inventory could help for consumers, and we've started to see a trickle of that. Certainly, hopefully, home buyers are really having better traction this year than they had in the last 2 years with more inventory and lower interest rates as well.
And then another major topic here, especially as we're considering and going into that home buying season, and how this could prove beneficial or a major pivotal season for different ethnic groups, and particularly the National Association of Realtors, the NAR study that looked across black home ownership still trailing white home ownership in 2023. What did we ultimately see kind of transpire into 2024 for black American home ownership? And what are some of the pivotal aspects of this home buying season that could ultimately perhaps narrow that gap and the 30% trailing that you were mentioning?
Yeah, so brand new report, hot off the presses from NAR just yesterday. What we saw is a growth actually in black homeownership. That being said, that gap is very persistent. It's still nearly 30 points as wide as what we see for the white homeownership rate, which is actually above 70%. So when we look at that gap, it's very persistent. What I do think is important, though, is that we did see growth there. The other thing that is very important is that for all non-white home buyers, what we see is nearly half of them are actually first-time homebuyers, really led by black homebuyers having a really predominant share, being first-time homebuyers in the market. So really trying to enter into homeownership and really surpass the odds.
I want to get off the sidelines myself, Jessica. I'm ready to throw my hat in the ring on some bidding soon. I got to save up a little bit more, though. Jessica, appreciate the time.
Thank you.
The price of food is beginning to increase at a slower rate. It's up 0.2% month over month in February compared to the 0.4% rise in the month prior. But the escalating global trade war could have a negative effect and send prices higher once again. That's what we're tracking up against here. And joining me now, we've got Ricky Volpe, who is the former USDA economist and Cal Poly professor of agribusiness. Good to have you back on the program. Always value your insights. How are you viewing the potential impacts of tariffs on food prices?
Well, yeah, thank you for having me. Been getting a lot of questions about tariffs recently, and what makes this challenging is that the situation is so fluid. As I'm sure most of your listeners know, the tariffs are announced, and the tariffs are sort of partially pulled back, and then in some cases immediately pulled back entirely. There's absolutely no question that tariffs with our major trade partners represents a distortion. And, in the short term, just market distortions almost always increase prices. So it is something that I'm concerned about since we just wrapped up, 2024 was a year of below average food price inflation. There was a little bit of relief for customers. Despite all the headlines about eggs and a little bit about beef and sugar and a few other commodities, most food prices right now are still trended in that direction towards, lower than average food price inflation and increased affordability. Tariffs have the potential to change that, but the extent to which tariffs could affect food prices, of course, depends on the countries they're being slapped on, the perishability of the products we're talking about, the importance of imports to how much of it we consume or we eat in the U.S. And then another factor that I heard you talk about with the previous guest are the recently announced tariffs on, steel and aluminum, these sort of fundamental industrial building blocks. They don't often get talked about with respect to food, but there's absolutely no question those are going to drive up packaging and storage and transportation costs for food. They have the potential to drive those costs up in a big way.
Yeah, and this has a lot of the food and beverage industry executives trying to make their case for certain exemptions so that they don't get it and have to then pass that price on to the consumer. But I guess from your early evaluation and predictive analysis based on what we've seen in the past, are there parts of the basket and which parts of the shopping cart are most prone, based on the countries that we're having the negotiations with, most prone to potentially seeing higher prices in this near term?
I think let's assume that the tariffs that President Trump has announced or threatened with Canada and Mexico, if we assume that they go fully into effect at the rates they've been announced, then I would expect to see the quickest and largest impacts with respect to fruits, vegetables, beef, and liquor. Those are the areas where we can expect to see those impacts, because we're talking about commodities when we talk about beef, tomatoes, avocados, and then of course when we talk about tequila and certain beers and bottled liquors. Some of these products, our trade relationships with Canada and Mexico account for nearly all of our domestic consumption. So it's not like we have other trade partners that we can pivot to if these tariffs go into effect. There's really no choice but for these food companies, these importers and manufacturers and so on, to sort of pass those on to consumers because they're already operating on thin margins.
While we have you, I want to talk about a development that we've seen at a major company, a household known name in Dole. They are taking some efforts and actually raising their pineapple prices, but as we think about the broader kind of citrus category, if you will, that Dole is known for, especially in the fruits and whatnot, how are you evaluating this, and what are the other foods that could potentially be in danger of some of those price fluctuations higher?
Yeah, that's a great point. We haven't really been talking about citrus fruit much recently. Of course, eggs have been dominating the headlines, and I'm actually kind of thankful that we haven't been talking about eggs today. But citrus is facing sort of a two-pronged assault right now. Domestically, as a lot of folks know, citrus greening is a disease vector that's affecting citrus production in the southeast United States, mostly Florida. We don't have an answer to it yet. Producers don't have a solution to it. So we're seeing the production of processing fruit in the American Southeast declining really rapidly, and that's already translated into a higher cost for orange juice, as a great example. And then there's sort of a latitudinal belt on the globe that stretches from Central South America over to Africa that's been experiencing a lot of wild weather in the last few months. And that's been affecting everything from, you mentioned pineapples to other citrus fruits to avocados at some point to sugar and to cocoa. And these are all categories that right now we're starting to see inflation really pick up. So a lot of it has to do with weather. The domestic issue, the domestic side of that right now is sort of systemic, and we're looking at that to be baked into the cake for years to come.
Oh my goodness. All right. You've given me a new rabbit hole to go down after I get off the set here. Huanglongbing, I believe it's called, as the technical name, HLB for citrus screening, as you were mentioning. I'm going to be looking into it a little bit more. Ricky, thanks so much for taking the time.
Thanks. It was great.
Coming up, everyone, Harvard announcing free tuition for students whose families make $200,000 or less. We've got the details after the break.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Harvard announcing accepted students from families making under $200,000 a year will get free tuition. The Ivy League, just the latest school to give free tuition to some students following MIT, Stanford. You've got Columbia, who's also made the announcement, and more who have similar programs. So what do students and parents need to really know about these programs? Joining me now, we've got Rob Franek. He is the editor-in-chief of the Princeton Review. Rob, good to have you here with us. So what do students need to know, and is it really free?
That's the $1 trillion question, Brad, and I appreciate the opportunity. Well, free tuition is free tuition. So when we think about sticker cost, and we could talk about this all the time at the Princeton Review, total cost of attendance is the big four. And that is tuition, room and board, fees, and books. So if the family is making $200,000 or less at Harvard, that takes care of tuition, which is about $56,000. It leaves $26,000 in room and board, fees, and other costs for students. So just to keep an open mind. This is a tectonic shift, as you had noted, from $85,000 to $200,000. Hats off to Harvard and the other schools that are able to do it. MIT, University of Pennsylvania, starting this trend as well. But again, just thinking about how attractive this is to so many college-bound students and their parents because debt is such a specter.
Why do you think this makes sense for the schools, for the universities to be rolling out?
Well, a couple of reasons. Number one, schools, Harvard on down, want to attract lots of different students to their school. And addressing the number one fear for students and parents, which is debt. We've been collecting this information for 13 years now consecutively at the Princeton Review. The biggest fear has been assuming too much debt to pay for college. So addressing that head on, saying, we see you, we hear you, we understand that debt is a big issue for students and parents, and saying that if you're under this threshold, then you should not have the same fears that other students might have. So I feel like doing that is a good move. We should also know that colleges have been doing this for a long time. There are over 100 schools across the country that have different financial thresholds from $30,000 on up. So there's lots of schools besides the Ivy League that are doing this as well.
And so as you're thinking about this, how does this kind of reset the mindset for a lot of people, families, potential enrollees in these classes and in college experiences about what they should be considering when choosing a school and the best schools for their money?
A couple of things, and I'm glad you brought up the question. We talk about this all the time at the Princeton Review. It's about fit, right? So addressing financial concerns is a big part of fit. It's a four-part process. So an academic fit, obviously, campus culture fit, financial aid fit, and career services fit. So we talk about this to make sure that a student's going to be happy not only in the classroom, but engaged in that community outside the classroom as well. And I think taking away this financial, nervousness and worry is a big driver to get to students to a place of confidence and their parents as well.
And certainly. And so as we're thinking about what is really attracting students right now, it's trying to make sure that they're choosing the school that has the major that is going to make sure that they are insulated from any type of economic cycle or change in labor market needs. Which schools are adequately doing that and making sure that their majors reflect what the real economy is moving towards, and what are some of the best majors that might be recession-proof or economic cycle-proof?
Oh, Brad, I appreciate this question. Thinking about what is going to be our students' return on their investment, their academic investment if they're students, and their financial investment if they're students and families, and factoring out what's going to happen through a career development, career resource center when a student is on campus. One of our most popular ranking lists at the Princeton Review is our best career services ranking list. So I think what you're going to find, or what parents and students are going to find, are schools that are addressing career development through internships and co-ops and experiential learning. What are students doing from first year in college through senior year to complement what they're studying in the classroom with an outside of the classroom experience? And this is glorious for students because it's vaulting them onto jobs of substance upon graduation, or onto a professional school and then jobs of substance. And you had noted just a couple of Teflon, areas, career disciplines that students are moving into. Certainly thinking about healthcare workers and education. So we need teachers and healthcare professionals without question. Anything in business management, from accounting, finance, marketing, in incredible need. And then also computer science, different verticals for game design, sort of the cross-section between art and computer science. We have a new ranking list out on that today as well at the Princeton Review. So just really good stuff, and I think students can get excited about it.
Rob, I got to hustle to my finish, but I'm going to try and squeeze in two quick questions here. Number one, more people applying to law school amid recession fears. Is now the time for people to say, all right, you know what, law school, grad school, maybe I should be looking into that opportunity?
If history proves true, Brad, then that is likely going to happen. Any downturn in the economy, question of recession, students or prospective students think about upskilling. So moving on to law school, business school particularly, but grad and professional schools in general. So I think we're going to see that moving forward as we move forward in our times.
Just lastly here, what needs to be the pitch from colleges, from university, higher education more broadly, in the U.S. education system, especially as you're seeing more of a reconsideration from some of the countries who we've been trading partners with, some of the countries who have sent their students, their family members here, but are noticing that there's a shift in the mindset from some of our political leaders and trying to figure out, okay, how does that translate through to what ultimately is going to be valued and whether or not we're going to stay in a different schooling or education experience?
Yeah, it's a super good question, and I appreciate it. I would say that college is worth it. It is worth it for any number of reasons, and holding up the American model as, superlative in that way, thinking about what students will do with their degrees. They report far lower unemployment rates throughout their career lifetime. They make $1 million+ more. So when we think about just the value of the American education system, I don't think that is going to change as we move forward. And just to remind students of that, that's what I'm doing out here every day, students, parents, and counselors.
All right, Rob, maybe we'll do this from a PJ Pancake House or something next time we discuss.
I'd love it. Good to see you.
Good to see you too. Thanks. Coming up, we're going to help you tackle some financial anxiety with 3 tips to handle all this recession talk that you might be hearing. Stay tuned.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Consumer sentiment dropped to a 2.5-year low as inflation expectations rose amid President Trump's recent tariff campaigns. The data from the University of Michigan, alongside the recent move to the downside in equity markets, reflect many of the financial anxieties Americans are currently feeling. We want to wade through some of these anxieties and give people some actionable advice to handle their money in this moment. Here with more, we've got financial therapist Amanda Clayman. All right. Deep breath here. Amanda, where should we begin here, especially as there is market uncertainty amid this recent downturn? How do you make decisions about where to put your money in an environment like this?
Ideally, we make decisions holistically as opposed to reactively to some very distressing emotional triggers here.
Certainly. Okay. And so with that, how do we cope with that financial anxiety that naturally arises, and what are some actionable steps?
Yeah. The first place that I really like to begin with people is taking the opportunity to notice how we are experiencing our body. Fear is really, really felt in our physiological arousal system. You may have heard fight or flight as a reaction. And a lot of us, when we hear distressing financial news, go into that fight or flight reaction. So we want to engage the body and speak to the body in the body's own language. And one of the ways that we can do that is with breath. A really great technique is what's called 4-7-8 breathing, where you breathe in, you inhale for a count of 4, you hold the breath for a count of 7, and then you release the breath slowly over a count of 8. And this is a way that we can, even without changing the content of our scary thoughts or changing our environment, we can start to at least begin to respond from a more regulated place.
And so with that in mind, as we're thinking through so many decisions that people hopefully aren't just making by themselves, but talking to their partner with, how can you make sure that those actionable steps are involving that conversation with your partner, with your family members, whoever you have, to kind of try and pour into that and relieve some of that stress from just making the decision in a silo?
Talking to people is a really great way for us to kind of engage a larger brain, if you will, more than just kind of what our own thoughts or our own reactions are telling us. It's helpful, I would say, in ideal circumstances, if we already have a regular practice of talking with some trusted folks. Maybe that's an advisor, maybe that's a spouse or partner, or somebody else who we really trust their perspective when it comes to what's happening in the markets, when it comes to decision making about money. So yes, ideally we have those conversations already in practice. But if this is new, the place that we would really start in being able to bring this up into a topic of conversation is, boy, I'm really worried about this situation, or I'm having some scary thoughts about volatility in the market right now. So to frame it not necessarily as what I'm looking for is advice on what I should do with my money, but really like, I want to connect with you from a place of what my concerns are, what my fears and experience are. And that can help us to let the other person know what it is exactly that we're looking for.
This also comes back to how people think about their overall career prospects or employment opportunities. And that's something that we've been consistently tracking month over month in prints like the Consumer Confidence Index. And so with that in mind, how can the career outlook factor into making these financial decisions?
It's interesting. I've been in this space for a couple of decades now, and in the time that I've been practicing financial therapy, I feel like the trend overall has been that work is in many ways becoming more episodic. We're having portfolio careers. Flexibility really is a wonderful skill and mindset to have as we approach our long-term career path planning. But that means really going back to the first point, getting out of reactivity. We don't want to just be jumping from choice to choice, path to path because we're stressed out. We want to be able to respond to some of these environmental cues that may be telling us, hey, the economy is trending away from this. You know, we're seeing impacts from AI, for example, and thinking about, is my career path going to be impacted by some of these changes and developments with AI? So we do want to be responsive to things, but it helps when we can track these things over time, really have this, engage with this as an ongoing conversation that we're having about our lives, as opposed to the place where I think a lot of us are coming into it, which is, oh no, there's danger, and I really have to act fast in order to avoid this danger.
Amanda, thanks so much for taking the time here with us today.
Thanks for having me.
U.S. unemployment remains historically low at 4.1% according to the latest jobs report, but the University of Michigan's Consumer Sentiment Survey found the share of U.S. consumers expecting unemployment to rise topped 60% in the month of March, its highest level in over 6 months. If you're wondering how you can prepare your personal finances for higher volatility under the Trump administration, we have David and John Ottenschneider, the debt-free guys and the hosts of Living Not So Fabulously, here with their tips. Great to see you both. John, what should you do if you're concerned about job cuts and other economic uncertainty?
Yeah, we have some tactical tips here for you to complement Amanda's suggestions. Our first suggestion is to set up a arm's length away emergency savings account. And with whatever amount you can contribute on a reoccurring basis, go ahead and start contributing to that as soon as possible. But the question is, what's an arm's length away savings account? Well, it's one that's not at your current credit union or your current bank, and it has no fancy features like check writing or debit card. You want to try to create somewhat of a roadblock so you can actually say, talk to the hand rather than looking at my wallet when you're trying to buy something that might not actually be an emergency.
And so, David, how can you adjust your spending habits there?
Yeah, so Brad, one of the things that we love is we have some friends over at Price of Avocado Toast podcast. They shared with us one time their definition of budgets, and they say we all really have two budgets. We have our sushi budget and our can of tuna budget. Our sushi budget is when our personal financial economy is doing well. Our can of tuna budget is when it's not doing so well. And so if you are thinking about, or your job has been doged or possibly is going to get doged, focus your spending on necessities. It may be time to put a little bit of a hold on some of that unnecessary spending.
I'm not sure if I was ready for doge to become a verb yet, but here we are. John, how can your credit card help you save?
Yeah, different credit cards have some great tools that you can use. And one such credit card is the 0% on new purchase credit cards. So if you don't have a flush emergency savings account or you've run into a precarious situation, maybe consider getting one of these types of credit cards and consider applying for and adding payment protection insurance or PPI to this particular credit card. And what that'll allow you to do is it'll cover you in case you're not actually able to make payments on time. It's a great way to protect your credit score and reduce some financial anxiety, but you want to investigate the costs first, and don't forget that the insurance won't actually cover your entire payment in perpetuity. It'll only cover your minimum monthly payments for a limited period of time.
Well, I suppose that raises the question, David, then if you miss a payment, what should you do?
Well, the most important thing here is to communicate with your credit card companies, especially before you've missed a payment or that payment date comes due. Ask if you can have a waiver of the fee for that missed payment if it hasn't happened yet or if it's the first time. Then you might want to move to some other strategies, like asking if they have a temporary hardship program that may allow you to lower your payment, lower your interest, or waive some other fees. The other thing is you can ask to have your payment date moved out. We've done this personally. You can move your payment date out so that maybe if you are just running a little bit behind on money and you will be able to make that payment, you can hit it. Probably the last resort here is to look at maybe a balance transfer card that has a zero interest so you can actually reduce your monthly payments.
John and David, thanks so much for taking the time here with us.
Thanks for having us.
Thank you.
And everyone, you can listen to new episodes of Living Not So Fabulously Wednesdays at noon. A programming note in this week's episode of Decoding Retirement, host Bob Powell speaks with the author of Retirement Planning Guidebook about the tools that you need to mitigate risks in retirement.
It's great to live a long time. It's just financially more expensive. And so longevity risk is the risk you live longer than expected and outlive your financial plan. If you're retiring in your 60s and your life expectancy is your 80s, there's a 50% chance you live beyond your life expectancy. So then you may start, well, what if I outlive my assets? What if I have to plan to age 95 or plan to 100 or whatever the case may be? And then with an investment strategy, that means spending less to make sure you can stretch those assets out over a long-term horizon. So with managing longevity risk, the key things you have available, delaying Social Security helps to provide a lot of longevity protection, especially for the high earner in a couple whose benefit will become a survivor benefit potentially as well. And also using risk pooling type products such as annuities as part of the planning process can help manage that longevity risk as well.
You can catch episodes of Decoding Retirement Tuesdays, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Coming up, planning your family vacation, we're giving you all the tips that you need to take some well-deserved time off without draining the kids' college fund. That's next.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
क्रूड ऑयल बाइंग हियर अवॉइड करो गाइस, अवॉइड करो। यही एक ट्रेड बन सकता था ऊपर, ये दोनों जगह पे, यहाँ पर एक जो सपोर्ट था और ये सपोर्ट था, बिकॉज सपोर्ट है, यहाँ पर भी एक सपोर्ट था, यहाँ पर भी ओपन इक्वल टू हाई कैंडल बन गई, यहाँ पर भी ओपन इक्वल टू हाई बन गई। दोनों ही जगह एंट्री नहीं मिली, मार्केट कंटिन्यूसली फॉल ही करता चला गया, काफ़ी अच्छा फॉल कर गया, जितना बाइंग आई थी मॉर्निंग से उतना ही फॉल भी हो गया। अभी दोबारा बाई मत करो यहाँ पर, वेट। नेचुरल गैस में कर सकते हो ऊपर से सेल, नेचुरल गैस रेजिस्टेंस स्ट्रॉन्ग है, क्रूड का थोड़ा वेट करना चाहिए मेरे अकॉर्डिंग।
That enables you to cut costs on hotel, but also then you can eat in that house sometimes instead of going out.
Certainly. So what are the best ways to save up for a planned vacation, putting those expenses together and really knowing what the marker is that you need to hit?
Yeah, well, come up with what your budget is. Where do you want to go? I just got back from a ski trip with my family.
Congrats.
Thank you. I survived, is all I'll say. But that's expensive because you have the equipment, the lift tickets, the airfare. So really lay out what your costs are for that vacation and put a target date for it, and then allocate a certain amount of money with every paycheck to that account. Either create a separate travel account or use some automated tools that move money directly from your checking account into your savings account.
And what about couples? How can you work together to prepare for a trip?
Well, that can be hard because couples aren't always on the same page. And so that's start with, what are your priorities? Where do you want to go? Like with my family, my husband likes extra legroom. I don't care. I'm short. I'd rather have a nicer hotel. So figure out what means the most and come up with that plan. And remember, not everything has to cost money. If you go on a beach vacation, you just really need a bathing suit. Hikes are free. So have that balance of those special excursions that cost money with just doing things together.
Some key reminders there. So also, how can families find deals to maximize savings?
Well, there are a lot of apps out there that collect all of the deals, and you should really look at those to make sure you're getting the best price on whether airfare or hotel. Also, take advantage of all the loyalty programs for airfare, hotels, excursions, because then you can actually earn rewards to help pay. And then always use a rewards card when you're traveling or making those purchases so you can offset yours. Like the trip I just took to Utah, all of my flights were covered by my Bank of America rewards points.
Wow. All right. Sounds like you're layering some rewards out there and putting those all together to make the trip happen. Mary, thanks so much. Sounds like you guys had a great trip. Let's do a final check of the market here. Taking a look at the Dow, the S&P 500, and the NASDAQ, we are lower across the board off of the session lows. The NASDAQ still down 1.9% though. The Dow, fractional declines there, 0.9%. S&P 500, that moving lower by 1.3%. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. That does it for us, but you can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up 3 p.m. Eastern Time. You don't want to miss it.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Podcast that will make you a smarter investor.
Welcome to Stocks in Translation. I'm your host, Jared Blickery. Welcome to Financial Freestyle.
Hi, I'm Bob Powell, and welcome to Decoding Retirement. Welcome to Living Not So Fabulously.
Welcome to Trader Talk, the podcast that dishes out the market straight up.
Welcome to Capital Gains. I'm your host, Madison Mills.
Welcome to Word Money. I'm Patrick Murphy.
And I'm Dan Coons.
From Wall Street to Main Street to the C-Suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
It's time for Yahoo Finance's Market Minute. Stocks selling off once again after 2 days in the green. Investors concerned about an economic slowdown and now looking to the Federal Reserve's policy meeting for insight. Magnificent 7 names leading a lot of today's declines. Nvidia, Meta, Amazon, all selling off as the U.S. exceptionalism trade fades. Meta on track to wipe out its year-to-date gains as investors look to Nvidia's GTC conference for some optimism in the AI space. Meanwhile, Reddit shares plunging after Redburn Atlantic initiated coverage of the stock with a sell rating. The analyst flagging potential risks from Google's algorithm changes and saying the breadth of Reddit's popularity has been overstated. And Pepsi ticking lower on a downgrade from Barclays. The analyst citing concerns over the snacking business amid growing economic pressures. That is your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Many pre-retirees and retirees often wonder whether they're on track financially to retire. Do they have enough money to last a lifetime? Well, here to talk with me about that is Wade Pfau. He's the author of the Retirement Planning Guidebook. I'm Bob Powell, and welcome to Decoding Retirement, Wade.
Thanks, Bob. It's great to be here.
Oh, it's great to have you here, and it will be great to have you sort of walk us through the framework for people to decide whether they actually have enough money to retire. Where to begin?
Right. I think that's the biggest question people have leading up to retirement. So we do the Retirement Income Challenge where we talk about a 3-step framework, really. You need to quantify the financial goals for retirement. I call those the 4 Ls: longevity, lifestyle, legacy, and liquidity. And this is really what you're seeking to fund in retirement. And that really translates into expenses for your retirement. So step 1 is figuring that out. Step 2 is then really being careful and thoughtful about what assets do you have available for your retirement. Social Security, investment assets, home equity, potentially part-time work. Any asset which includes future income streams like Social Security or work, assessing what you have there available to fund those liabilities. And then step 3 to figure that out is calculating your funded ratio, which is simply the ratio of the assets you have to your liabilities or expenses that you're trying to fund, using a relatively conservative rate of return assumption about what your assets will do in the future. And for me, I think that's really the best starting point for thinking about, am I on track to being able to successfully cover my retirement expenses?
Yeah, a couple questions, Wade. As you think about someone guessing, estimating what their expenses will be in retirement, is there a point at which it's more reasonable to do that, say at 55 or 60 or 65, given that you certainly don't know what your expenses will be over the course of, say, 30 or 35 years of retirement?
Oh, sure, absolutely. I mean, I think it's useful on an ongoing basis to have a sense of how much you're spending from year to year. Of course, there's a lot of things that can change in retirement, but certainly the pre-retirement expenses that you have are going to be the most useful for figuring out what that might translate into post-retirement. Some expenses may change, and especially if you're thinking to move in retirement, that can impact a lot of your expenses. But probably in the 5 or 10 years leading up to retirement, you're getting a sense of what it costs to fund your lifestyle. And that becomes a really good starting point for then thinking about what might adjust or what might change. What do you need to plan and prepare for your post-retirement spending plan?
Right. And so when you think about matching your assets to your liabilities, the thought is that you have lifestyle needs, whatever they might be. You have discretionary expenses that you have, as you mentioned, contingency or legacy expenses, which might be your reserves. And then you have maybe legacy goals. How does one go about sort of allocating their assets to those different components?
Mm-hmm. Yeah. So the 4 Ls, that longevity is your essential spending, lifestyle is more discretionary types of expenses that you view as part of having a good and successful retirement, legacy goals, and then liquidity for the spending shocks, long-term care, healthcare, that sort of thing. So that's then what you're trying to fund. And so with your question about linking assets to those expenses, When we think about retirement assets, I like to categorize them in three broad groups. There's reliable income assets, which are best earmarked to cover longevity expenses. These are the core fixed type expenses that you want to make sure you can cover no matter how long you live in retirement. So generally looking for some sort of lifetime protection or at least some sort of contractual protection behind the assets that are part of your reliable income. Then second, you have the diversified portfolio, and that's really your investments where you're building that diversified approach, seeking a market growth as well as just trying to manage volatility for those assets, but looking for the risk-adjusted return that you feel comfortable seeking, and then earmarking that more to the discretionary lifestyle goals as well as potentially legacy. And then once you've figured out what you need to cover spending, longevity and lifestyle, as well as any legacy goals, then other assets can be earmarked as reserves, where you actually can quantify and set aside whether it's the home equity, whether it is part of your investment assets because you have a surplus, whether it's different insurance policies, whatever you have available that can then be earmarked to cover those unexpected spending surprises in retirement. That third category, that's your reserve assets. So it's reliable income, diversified portfolio, and reserves.
Right. I want to go back to something that you mentioned earlier, Wade, which is the funded ratio and this notion of dividing your assets and liabilities to determine whether you have 100% of your liabilities covered by your assets. The thought is that this ratio is similar to what defined benefit plans use to determine whether they're funded or not to meet the obligations for their pensioners. And the thought is if you're 100% or above in terms of your funded ratio, you're fine. But if you're under 100%, things are less fine. And perhaps you need to start thinking about maybe some adjustments, maybe trimming expenses or working longer or saving more or investing more aggressively. What advice do you have for people who are in that position where their funded ratio is below 100%?
Yeah, you did touch upon really, there's only a few basic options about what to do. You need to either increase your asset base, which implies potentially working longer, or you need to decrease your retirement liabilities, which just means cutting expenses, whether that's just trimming some of the discretionary expenses or maybe reducing the legacy goal. Just reducing what you're trying to fund helps to get the funded ratio in alignment. And then the other option that you mentioned is seeking that higher investment return. That would be just using a higher interest rate to calculate your funded ratio. Now, that's a risky approach. The funded ratio is different from the Monte Carlo financial planning that we hear a lot about. But if you're using a conservative rate of return to estimate your funded ratio, that would correspond to a high probability of success. If you're assuming you're going to earn a higher investment return and use a higher interest rate to calculate your funded ratio, that can make your plan look more funded, but it would correspond to a lower probability of success because there's less chance that you're going to outperform that return assumption that you're using. So I do suggest using caution by going the route of assuming a higher investment return. But yeah, at the end of the day, it's either increasing the asset base by potentially working longer or reducing expenses to decrease the liability that you're funding.
Right. And so when I think about the funded ratio too, I also think about it as a point in time estimate, and that it could change depending on factors. So for instance, if you reduce the time horizon from say 35 to 30 years, or you increase the time horizon from 30 to 40 years, that funded ratio changes. So I often think about using that ratio in a best case, worst case, probable case, as opposed to maybe one number. What's your thought about that?
Right. So the other part of risk, so that you're trying to manage retirement risk within your funded ratio. Longevity risk, what planning age do you use? The longer you assume you're going to live, the less funded you'll be because you'll have more expenses to fund over a longer retirement. So you could play around with that number. Market volatility, which you manage by assuming a conservative rate of return. And then the spending risk, the spending shocks, the different big expenses outside of your budget. You manage that by including those contingency liabilities in the plan. And so at the end of the day, it's really developing assumptions that you feel comfortable. If I can have a funded plan, assuming I'm going to live to 95, or assuming I'm only going to earn a bond-like rate of return on my investments, or assuming I can fund a couple of years in a nursing home, then I'm going to go ahead and proceed with my retirement because things could get worse, but I hope they'll be in a good place. And it's also true that your funded ratio would fluctuate on a daily basis as the value of your investment accounts fluctuate. That's where with the funded ratio, you're assuming a simple fixed rate of return that hopefully you'll outperform over the long term. But on a daily basis, that can fluctuate. And that's something to certainly keep in mind and monitor. And if things are going well and your funded ratio keeps improving, it might even point to spending a bit more. But if your funded ratio is decreasing over time due to market losses, then you might want to revisit whether you need to reduce expenditures to help get that funded ratio back into alignment.
Right. So the funded ratio may be something new to most people who are planning for living in retirement. Many times people are told a common rule of thumb when they're planning for retirement is to plan for replacing 70 to 80% of their pre-retirement income in retirement to fund their desired standard of living. Any thoughts about that rule of thumb and whether people should use that as they're sort of determining whether they have enough money or not?
As a really simple starting point, that could be a way to define what your longevity and lifestyle goals. That your retirement budget would be 70 to 80% of your pre-retirement spending. But as you really start digging in any depth, that rule of thumb starts falling apart because if 70 or 80% of what is a big question, it's really implicitly assuming you always have the same salary. So if you say, I'm going to replace 70 to 80% of my pre-retirement salary, kind of have a sense of what that is. But the reality is people's salaries fluctuate quite a bit. And so then it's really, what am I replacing? Is it just a salary right before I retired? But if my salary had been declining as I start to cut back on work pre-retirement, I might need a higher replacement rate. Or do I do it based on the peak earnings over my lifetime, which might have happened in my 50s or my average lifetime earnings? The basic idea makes sense in terms of if you tend to spend most of your income other than maybe saving 10 to 15%, paying taxes and so forth, that guideline of 70 to 80% could make some sense. It's just in practical terms, you're probably better off spending the time figuring out what your budget is and then using that as a baseline for figuring out whether you're potentially able to fund that in retirement.
Wade, we're going to take a short break, and when we come back, we're going to talk about how you can manage and mitigate the risks that you'll face in retirement. We'll talk a little bit about inflation and interest rates, and we'll also talk about the newest version of your book, Retirement Planning Guidebook. So don't go away. Stay tuned.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome back to Decoding Retirement. I'm Bob Powell, and I'm speaking with Wade Pfau. He's the author of the Retirement Planning Guidebook, among other things. Wade, before we took a break, I promised that we would talk about the ways in which people can manage and mitigate the many risks that they'll face in retirement. The Society of Actuaries lists 15 risks that people will face in retirement: longevity, inflation, spending, health shocks, divorce, death of a spouse, change in living conditions, et cetera, et cetera, et cetera. Where to begin? Longevity and inflation seem to me like the big two, the twin pillars of risks that people face, and the tools that you need to use to manage and mitigate longevity are different from the tools you might need to manage and mitigate inflation. So eager to hear what your thoughts are.
Right. It's really about building an overall plan that has aspects that will manage the different risks. But yeah, longevity is just, it's great to live a long time. It's just financially more expensive. And so longevity risk is the risk you live longer than expected and outlive your financial plan. If you're retiring in your 60s and your life expectancy is your 80s, there's a 50% chance you live beyond your life expectancy. So then you may start, well, what if I outlive my assets? What if I have to plan to age 95 or plan to 100 or whatever the case may be? And then with an investment strategy, that means spending less to make sure you can stretch those assets out over a long-term horizon. So with managing longevity risk, the key things you have available, delaying Social Security helps to provide a lot of longevity protection, especially for the high earner in a couple whose benefit will become a survivor benefit potentially as well. And also using risk pooling type products such as annuities as part of the planning process can help manage that longevity risk as well. On the inflation side, annuities may not be the best approach for managing inflation specifically. That's where Social Security also shines for managing inflation, because Social Security does have a benefit that's linked to one of the major consumer price indexes used in the United States. You also have TIPS, Treasury Inflation Protected Securities, which are Treasury bonds that actually give you a real rate of return plus whatever inflation ends up being. And then also, if you have your reliable income that we talked about earlier for your core expenses in retirement, that can provide the capacity to invest other assets, your investment assets, for long-term growth, with the idea that there's no guarantee behind it, but typically over long time horizons, a diversified investment portfolio can also grow beyond the inflation rate and give you a real rate of return beyond inflation as well.
Yeah. I'm curious, Wade, many people often say that people have to be worried about sequence of returns risks, especially if they're using their diversified portfolio to generate income in retirement using the 4% withdrawal rule or whatever the case may be. And I'm curious if one is using reliable income to fund essential expenses, you may not be exposed to sequence of return risk because you're not depending on your diversified portfolio to generate the income that you need to live on. Is that fair to say?
Right. So sequence of returns risk is in retirement being forced to sell assets at a loss to meet expenses. And so if you have reliable income that's not exposed to losses, those assets are not exposed to the sequence of returns risk. And so if you have your basics covered and you're not having to take, at least you can cut distributions for discretionary spending. Being able to reduce your expenditures after a market downturn is another way to manage sequence risk. So with reliable income for the basics, and then with some flexibility about how much you spend for discretionary, that can be a really powerful 1-2 punch for helping to manage the risk of having to sell assets at a loss and then seeing those assets disappear from the portfolio, so that even if the market subsequently recovers, whatever you sold from the portfolio to meet expenses doesn't enjoy that subsequent market recovery.
So one thing that people need to plan for and fear the most are healthcare shocks, the possibility of having to spend hundreds of thousands of dollars on medical expenses, on nursing homes, on home health aides, et cetera, et cetera. How do you plan for this possibility where half of the people may have a healthcare shock and half may not?
Right. So when we talk about, there's the idea of long-term care insurance, but insurance works best for low probability, high cost events. Long-term care is not a low probability event, so you can't leverage your dollars as much through insurance. At the end of the day, it's either self-funding, that you have enough reserve assets to manage a significant long-term care event, or for many people, it may ultimately mean if you're part of the population that experiences a long-term care spending need, eventually as you spend down assets, Medicaid may become an option at some point, Or there is still different long-term care insurance policies, whether it's traditional insurance or insurance linked to life insurance or an annuity, to help support spending when a long-term care event takes place. You really have to think through which of those three approaches do you feel most comfortable with for your own retirement.
Yeah. Another risk that people don't talk often enough about, especially if they're in a couple, is the death of a spouse and the sort of the ramifications that happen, tax bombs, et cetera, et cetera, et cetera. I mean, it's going to happen for most couples, right? That there'll be a death of a spouse.
Yeah, unfortunately, it's inevitable, but it can still be a significant retirement risk in that it's unexpected. But with the death of the spouse, the Social Security benefits to the household would probably decline. If that spouse had any other pensions or things that were based just on their own lifetime, those will be gone. Now, household expenditures may decrease, but not necessarily by as much as the lost income sources that we're talking about. And then also there's a tax hit because single filers are not treated as well as married filing jointly. And so in the year after the death, when you have to switch to single filer status, you might find that your tax bills are going up quite a bit as well. And so between having some reduction in expenses, but higher taxes and losses of other income sources, the death of a spouse, in addition to the emotional and non-financial considerations, can also have a significant financial impact as well.
Yeah. So Wade, I want to turn my attention to the newest edition of your book. There's some highlights in here. Things have changed. The Social Security Fairness Act has eliminated the windfall elimination provision and the government pension offset. Talk about a little bit about how that will affect people for whom this was a problem.
Mm-hmm. Yeah, so most Americans spent most of their careers in work covered by Social Security, but with some state and local employees and in some other cases, federal employees and things, they spent part of their careers in work not covered by Social Security because Social Security had progressive benefit formula. It made them look poorer from a lifetime basis, and they would have then got a higher amount from Social Security. So the windfall elimination provision and government pension offset reduced benefits to individuals that spent part of their careers outside of the Social Security system and had pensions coming from that work outside of the Social Security system. Those provisions are gone. So if you previously had your Social Security benefits cut, either your own primary insurance amount reduced to the windfall elimination provision, or any spousal or survivor benefits you were entitled to from someone else's record through the government pension offset, that's now gone, and you'll see a big boost in your Social Security benefits.
So Congress also did something else recently where they clarified the rules on inherited IRAs and RMDs. Tell us what we need to know about that.
Right, with Secure Act 2.0, or was this 1.0? One of them, we got this new 10-year rule where individuals who did have a lifetime stretch when they had the inherited IRA, they could stretch distributions out over their lifetime. If they were not otherwise an eligible individual or a spouse, they now had 10 years to distribute that account. And the initial thought was, well, they could just wait to year 10 to take it all out if they want to. Now, that might not be wise from a tax perspective, but that was the assumption that would be the option. We now have received clarification. And it's not for everyone, but it's, well, first, if the owner of the account was past their required beginning date, which is April 1st in the year after their RMDs began. So if they're already past that date and they died after 2020, well, in 2020 or later, so after the very end of 2019, then you do have to follow those lifetime stretch rules and take a distribution in years 1 through 9. And then take the remainder of the account out in year 10. And there's been exception for that, so that in 2021 through 2024, you're not penalized if you didn't take those RMDs, but you do have to start doing that if you're required to. Starting in 2025, there is still annual RMD requirements only in that case.
So, Wade, last question quickly. In your new book, you increased the interest rate that you're using to 2.25%. And I'm wondering if you could just touch briefly on the notion of where we stand with respect to inflation and why you're using a higher interest rate now.
Mm-hmm. Absolutely. And that's the real interest rate. So that's like based on Treasury inflation protected securities. Then you add inflation on top of that. Real interest rates had been close to zero for a long time, had even been negative at some points, but they keep going up now, and that makes it much easier to fund a retirement. So if you're running a funded ratio analysis with a 2.25% real interest rate compared to, in the previous year, I used 1.75%, and in the year before that, I think I was still at 0% real. That really makes it easier to fund the retirement because the cost of funding your liabilities will, generally speaking, decrease by more than the impact on any cash flow based assets that you may have. And so it's great news for retirees. It's easier to fund retirement now. We used to talk about things like, is the 4% rule safe? And it wasn't with a very low interest rate if you were trying to just build a 30-year ladder of TIPS bonds. But today, if I wanted 30 years of safe inflation-adjusted spending with where TIPS are right now, we're talking more about like a 4.6% initial withdrawal rate is sustainable because of that higher interest rate environment.
All right. Wade, I'm afraid we've run out of time. I want to thank you for sharing your knowledge and wisdom with us. It's so greatly appreciated, and I can't wait to have you come back on a future episode of Decoding Retirement. If you've got a question about money or retirement, we're here to help. Email me at askbob@yahooinc.com, and we'll answer your question in a future episode. So that's it for this edition of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. And don't forget, for the latest retirement news and expert analysis, check out yahoofinance.com.
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is Yahoo Finance's Madison Mills. The People's Voice is on assignment. And before we get started, kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming back Michael Renking, CFA. He is a senior market strategist at none other than the New York Stock Exchange. Hello again. Our phrase of the day here is terming out. It's one of those wonky bond market terms, but fortunately it's easy to understand, and it's part of the $37 trillion question in the US right now. And this episode is brought to you by the number 77. That is the relative strength index score for consumer staples, the stuff you need, divided by consumer discretionary, the stuff you want. Exactly why is the market favoring the stuff we can't just live without? So, Michael, before we really dig in, what are you seeing in the markets right now? Interesting year so far. And I got to say for the audience, we're taping this right ahead of NVIDIA earnings, so we don't have the benefit of that knowledge, but there's a lot else going on.
Yes. Yeah. Well, first and foremost, thanks for having me back on. Yeah, look, I mean, it's been an interesting, kind of start to the year where we got off to a pretty solid start. And then like we do see in, kind of in February's in many years, and especially after elections, right, we've seen a choppy kind of February, up to date, and we've seen, kind of over the last week, we've seen a pretty, significant momentum unwind. Where there's been some of the really kind of crowded positionings and popular, kind of risk-on assets have really started to unwind, and markets are, kind of dealing with multiple different narratives, around, potential growth scare, kind of Washington policy fog, all right, and it's just kind of weighing on, kind of overall sentiment.
Yeah, I remember last time you were here, you were talking about the potential for some headwinds in Q1, and that's exactly what we saw in February, right on cue for followers of seasonality. But right now, we want to get to our phrase of the day. It comes from the bond market. It's called terming out. And that is when the government or a company, could be a corporation, replaces short-term debt with longer-term debt. And that is so they can lock in lower interest rates and reduce the risk of refinancing. That's having to go to the debt market every few months or 6 months. And so that's kind of a strategy that we've been talking about that the Treasury might need to implement because we have a lot of debt and there's a lot more short-term debt than there used to be. How are you thinking about this, terming out?
Yeah, so I mean, in terms of terming out, right, that's actually been a really important dynamic, not only from a Treasury perspective, but from if you think about households, right, and companies over the last couple of years, and really been one of the things that that we had looked at in terms of less interest rate sensitivity, kind of within the market, and why we didn't necessarily see as high a risk of recession as some other people did, kind of over the last couple of years. So if you think about kind of people in their mortgages, right? You've termed out kind of mortgages for 30 years over this last decade in a very low interest rate environment. Companies also did a very good job of terming out their debt over the kind of during that pandemic time period and coming out of that pandemic time period, right? So while rates are moving higher, they haven't felt the effects. Now, the kind of big question right now has been kind of around kind of the government debt load, right? And we had some commentary kind of from Treasury Secretary Bessent last week, suggesting that we weren't going to start to kind of term out that debt, for at least a few quarters, and that was one of the concerns that kind of was making its way through markets kind of earlier this year when we'd seen kind of 10-year yields moving up to kind of 4.8%.
Yeah, and let's suss that out for a second because 10-year yields were moving higher after the election, and they were doing it at a pretty fast clip. And it's a lot of the guests that we talk to, most of them will say it's not the level necessarily, although there are some big levels like 5%, but it's the speed, and it was just screaming higher. So what I would note now is the last few days we've had a little bit of a growth scare. Stocks have not been performing well. We've seen them come down off their highs with force, but those rates, the 10-year rate has been coming down as well. So, you could say that's maybe a sigh of relief, or if there's an actual growth scare though, and that builds, that's another dynamic. So, it's funny that the markets are just kind of on this fence. Is the Fed really, what is its next move? I think the market is kind of trying to figure that out. What do you think there?
Yeah, and I think markets do tend to move kind of very, very quickly, right? And we've seen kind of that narrative shifting kind of very fast, kind of over the last couple of years. If you think back to the start of last year when markets were pricing in 7 or 8 rate cuts, right, and then we kind of backed that off and we ended up having 4. Kind of currently kind of that back off from 4.8% to 4.3% is pretty significant, right? And that goes to like one of the themes that I've kind of been thinking about is like markets have started to move in a way where they look at things in kind of a binary outcome, where it's like all or none, right? So it's like we're either having an inflation scare, right, or you know, we're going to lose control, right? We're going to lose control of, you know, kind of our balance sheet as a country, and then all of a sudden, like, you know, now we're right back to this kind of growth scare, right? And you know, the conversation around potential recessions is starting to make its way back into markets.
What is a growth scare? High level.
It's so scary. The markets don't like
because we like growth, right? But we don't like inflation. What is a growth scare?
Yes. So, I mean, what we're seeing right now and how it's kind of playing out within the market, right, is that we've seen soft data, which is what we'd call kind of survey data, right? And that survey data historically has been a good leading indicator to suggest that the harder economic data, you know, kind of things like retail sales, jobs numbers, and things of that nature, start to move. Will start to kind of move lower when you see that, kind of that survey data move lower. Now, that being said, over the last couple of years, that survey data has been very, very negative, despite the fact that the economy has continued to hold up. Right. So now, once again, you know, kind of with the uncertainty that we have, you know, kind of around policy, we're seeing that survey data, you know, move lower. We had a very sharp move lower in the consumer confidence numbers. Right. There's a lot of concern. You know, kind of consumers are expressing a lot of concern around tariffs. Right. So there is this concern that we're going to start to see kind of the growth side of the equation and that hard data start to turn lower. You know, I think it's a little bit early to kind of jump to that conclusion.
And Michael, last time you were here, we talked about systematic flows. And when we think about institutional investors, it's not just this monolithic structure. I mean, you got hedge funds, you got market makers, you have commodity trading advisors, the CTAs, and they all have, and there's a lot of divisions within them. But when we have certain events in the market, like you see stocks down 2-3% at the index level, a lot of times that can trigger various flows. And I'm wondering if you're seeing any of those kind of dynamics in the market right now.
Yes, yeah, I mean, and we have definitely been, we have been seeing, kind of some of those moves over the last couple of weeks, or particularly over the last kind of week or so. But like there were some early warning signs, right? So while we had the S&P 500 hitting these new marginal all-time highs, you continued to see kind of small and mid-cap indices, kind of were underperforming, right? They couldn't even break above their 50-day moving averages, right? And then beneath the surface, you talked a little bit earlier about kind of staples and consumer discretionary. You really started to see the consumer staples sector start to outperform that consumer discretionary sector, which can be another one of those like kind of leading indicators that there's some concern kind of happening beneath the surface. Now, over the last kind of really starting a week ago today, we started to see that momentum unwind. Kind of really begin. Kind of late on the day on kind of last Wednesday. Sure. Kind of there were some insider sales announcements coming from Palantir, which has been a retail favorite. Kind of, along with kind of the Department of Defense. Kind of cost cutting, and that kind of took the wind out of the sails of that stock. But you started to see, that kind of cascade through different, very kind of momentum-based assets, cryptocurrencies, and things of that nature. So we've started to see the VIX moving higher, right? And you see, kind of some of that risk reduction, kind of happening within the market more broadly. One of the things you can watch is at the end of the day, when you see markets moving in that final kind of half hour of trade, that kind of gives you the signal that you're seeing more institutional flows, right? So like the closing auction here on the New York Stock Exchange is the biggest trade of the day. It makes up, something, call it, around 15% of, normal daily volume. And when you see markets moving lower into the close or moving higher into the close, that's giving you a sense of where that institutional money flow is going.
But I do hear you talking about a rotation that the market had wanted. There was this interest in a broadening, and now the market's getting it, and they're unhappy about it.
Well, the market's never happy. Investors are never happy. So, how do you think about the rotation, though? Is it enough to sustain the bull market?
Well, so there's a couple different things going on with the rotation, right? The expectation that we would see the rotation within U.S. equities was for that to happen kind of down the market capitalization scale. As we're seeing kind of concern, the rotation we're getting is up the quality scale, right? And because there is some concern and there's more defensive posturing that's happening within the market. So we're seeing the large caps outperform, and that area where investors have been hoping to see kind of that rotation in the small and mid cap, that's been underperforming. In addition, what we're also seeing is international markets have started to kind of outperform U.S. markets, right? So you're seeing kind of strength in Europe. You're seeing, kind of China, which was, kind of, just not too long ago was considered, kind of uninvestable, right? Is all of a sudden, kind of coming back with, kind of, as we've seen stimulus coming into that country, and then, kind of the DeepSeek headlines, over the last few weeks, right? So you're seeing that rotational activity happen in ways that, I don't think most people were necessarily expecting.
No,
and
Trump's
it's happening,
president, there's Europe for you.
Yeah.
No, people didn't expect that. How long does it last? Is this sustainable for, is this a longer term trend that we have in the making?
Right. Well, so I'm not quite sure how, kind of how long the trend can continue, right? I mean, it's not, when you look at Europe, you can understand, right? We're seeing some fiscal austerity here, right? And you're seeing kind of more headlines about, kind of an increased, kind of fiscal spending, kind of happening at the European level. But it's not as if, kind of those economies are kind of gangbuster. The other, kind of the other piece of that equation is that you're looking at other areas of the market that are just trading at, nice relative values or cheaper than U.S. equity markets have, are currently trading, right? So that's, kind of giving you a little bit more of a buffer, and that's kind of helping, kind of helping money rotate into those areas of the market. I don't think it necessarily, like, that can happen, and U.S. markets can also continue to, kind of perform well. I don't think it necessarily, just like kind of that binary outcome that we just talked about.
There's no
it doesn't need to be one or the other. I think both can perform well.
Let's talk about some nuance with respect to the U.S. dollar index, or just the U.S. dollar broadly. I look at the DXY, and it's kind of an old archaic index, but it does the job. It's well off of its highs, and when it was screaming higher with rates, that was a problem. Now it's not necessarily a problem, but given the international surges that we've seen in these stock markets across the world, whether Europe, China, or in between, is the dollar under threat? Does it weaken too much, and is that some kind of a signal that you would look at?
I mean, I think from a U.S. market perspective, right? I think some dollar weakness would probably be applauded at this juncture, right? That would been kind of in the Q1 earnings season, right? That dollar strength has been one of the headwinds that we've heard kind of U.S. global kind of multinationals have kind of called out in terms of a headwind from an earnings perspective. So I think if we continue to see the U.S. dollar moving a bit lower here, in the near term, that might actually be applauded from a U.S. market perspective. From a more global macro perspective, right?
Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time, right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail. Oh yeah, you're not gonna forget to cancel those free trials this time. Right? Uh-oh. Free trial alerts to the rescue, so you cancel on time from Yahoo Mail.
Take an ETF for consumer staples like XLP and you divide it by consumer sentiment, XLY, you get a ratio of staples to discretionary. And that's the stuff we want versus the stuff we need. And it has been screaming higher recently, favoring staples. And so if we do technical analysis on this ratio, what we see is the relative strength index, or RSI, of the ratio is 77. We haven't seen a level that high since December of 2022. So Michael, we already talked about staples versus discretionary a little bit. Is this one of your signals? What do you look into this? What is the read through on this?
Yeah, I mean, I think the read through was kind of that early signal that kind of there's more concern kind of within the market. Now there's like just like the S&P 500, when you look at the those sectors within the index, right? They're very top heavy as well, right? So within consumer discretionary, Amazon and Tesla make up a very big portion of that. So it does skew, but I've also looked at it from an equal weight perspective, right? And you did see that signal was also triggering from an equal weight perspective, right? So I think like at those turning points, that's like something that can be an early indicator where you're seeing institutional flows, kind of looking for that safety, kind of for that safe haven, kind of within equity markets.
All right, we're going to get to today's Who Wore It Better right now. We have a runway showdown with interest rates. And this is featuring the short end of the curve, the Fed funds rate. That's the overnight rate that the Fed uses, and that's versus the U.S. 10-year yield. So it's short-term versus long-term. But don't let maturity get in the way, because the 10-year Treasury is free-spirited. It's strutting down the runway in real time, reacting to these market whispers, global money flows, and investor sentiment. It moves fast, it moves early, and it doesn't wait for permission. On the other side, the Fed's benchmark Fed funds rate is the structured power dresser. Every move is deliberate, calculated, and telegraphed well in advance. No unexpected jumps, no impulsive pivots. Usually, the Federal Reserve dictates the season's official outlook, whether its markets don't like it, whether markets like it or not. So right now, the 10-year is shouting growth scare, while the Fed is holding its ground, ready to pounce on inflation or economic weakness. So Michael, who is wearing the interest rate crown better? Is it the market's instincts, the 10-year, or the Fed's control?
Well, it's a great question. And look, I think like ultimately, right, the markets are kind of have been like leading the Fed, right? And we've seen that, kind of during 2022, we saw markets lead the Fed, kind of on the way up, suggesting that we're going to see many more rate hikes than the Federal Reserve, kind of had expected at that time, right? And now, right, you're getting kind of a cautious view from the market. I think you made a great point earlier, kind of in our discussion, right? It's something that I talk about all the time. It's not necessarily kind of the ultimate rate, kind of where 10-year yields are trading. It's how you're getting there. It's that rate of change, the second derivative, right? And that's been the concerning part of A, the move higher, and then B, kind of, the move on, in the other direction. The one positive, kind of outcome in what that move and where we are from an absolute rate perspective is that it is actually providing investors, some negative correlation. So when we are seeing equity markets, right, moving lower, right, the bond portfolio is actually
working now.
Right, it's working, right, and so we have kind of a positive interest rate environment, and there are other places for kind of equity investors or investors, broadly, to put money to work.
What should investors and just constituents know about the 10-year as a check on the Trump administration? Because you mentioned Scott Bessent's commentary. Sure. He talked about the 10-year as a check and something that they were going to look at all the time. We previously thought that the stock market would be that check on the administration, and Bessent said essentially, no, we want it to be the 10-year.
30 seconds.
Well, I mean, Scott Bessent, himself said he's the kind of the most important bond salesman, right out there. Yeah. So I mean, it is kind of very important. Kind of if you start to see that term premium, which is something we talked about in the last episode here, if you start to see that term premium and the demand that investors are kind of requiring to hold that longer term debt, start to move higher.
Mm-hmm. All right, that wraps up this segment of Stocks in Translation. Welcome back to Stocks in Translation. Overtime. Thought we'd do something a little bit different today. In my never-ending quest to bring Sydney into the fold, you know her as the people's voice, by the way, into the fold in technical analysis, I thought we'd do some of that right here in our Yahoo Finance studios today.
I'm with you, Jared, because I'm more of a fundamentals girly. I am really curious. All the time on the show, you talk about candlestick charts.
Yes.
So can you help me understand a bit, kind of chart that out here for us?
You bet. This is Berkshire Hathaway. This is a 1-month chart. So each one of these candles represents 1 day in the market, and there are usually 21 of these or thereabouts in 1 month. And you're going to notice some of these are green and some of these are red. And the coloring depends on where the close is in relation to the open. So in a green chart, that means that it's gaining throughout the day. So it opens down here and it closes here. And it also happened to close at the very high. You're going to notice here, if you zoom in and squint, here's a red candle, but we have some sticks above it. It's actually called a wick or a shadow, and it's colored red because the close was lower than the open. So you can say it opened here, it probed a little bit higher, it decreased or declined, and then it kind of came off the lows and found a close that was in the bottom, say 25% of it. Now, we can expand this, and let's take a look at a year-to-date here of Berkshire. I think it's interesting to use candlesticks to kind of mark trends, and you don't even need candlesticks for this. We can also use a line chart, but I just happen to be partial to candlesticks, so let's go. I'm going to take this low down here. Then we're going to go to this high. Then we have a higher low, a higher high, higher low, higher high, and we're using the closes here. And it goes all the way up until we finally have this area where we are right now. So Sid, I don't know if you have any questions.
Well, I'm just trying to keep track of it all. So green body means stock closed higher. Red body means stock closed lower.
Yes.
The fact that there's no little wick over here means that the stock closed at this highest level.
Yeah, exactly.
All right,
Perfect. And the shadows are important sometimes because if you see a long one like this, and let me just draw this in, this has a long shadow to the downside, and you can see it's a red candle, so the close was a little bit under the open, and let me take the annotations off, but you can see this is actually a hammer formation. That's called a hammer candle, and sometimes that marks an interim bottom, and you can see it actually took out this low from 2 days prior, so it ran some stops there perhaps, and then it just accelerated to the upside, and a lot of times when that happens, the short sellers intraday, they get caught and they have to participate in the buying action in order to cover. So let's go back to our year-to-date here. We are looking at this uptrend in Berkshire Hathaway, but we can see a good example of a downtrend if we look at Tesla.
Looks painful.
Well, I mean, this stock has gotten cut in half off of its highs here, so pretty serious situation for the stock. It's been very volatile over the last few years, which I'll show in a second, but I just want to show here how we have a series of lower highs and lower lows, and really not a whole lot of wiggle room in between. It's just been when it decides to go down, it tends to go down dramatically. So this is year to date. I'm going to show you the 5-year chart, and let me put some lines on there so it's easier to see. You can see that's a whole lot of sideways, and markets are known for being tricky. One of the tricky things that Tesla did here was recently, late last year, it broke to a new high, and a lot of people thought that was a signal to go long, to add to their position or just to buy the stock. Well, that was precisely the point to sell, and so that was a little bit of a non-starter. Some people call this a little whoops to the upside. That's J.C. Peret's terminology, or you could just call it a failed breakout to the upside. Nevertheless, what I want to highlight here is that Tesla is just in the middle of this big trading range. Probably doesn't mean a lot until it goes below 150 or above 450. All right. We got a minute left, so I wanted to show you two different stocks, Palantir and Peloton. Palantir peaked in early 2021. They both IPO'd about the same time, and then it declined about 85%, and then it took off to the races. Peloton, guess what? It peaked around 2021, earlier in the year, got cut 90%, but it didn't take off. So these are actually two very similar stocks until the year 2023, and just kind of gives you some context into how different things have evolved, how two different stocks have evolved over the pandemic.
Yeah, it's interesting to see two similar things when they look so different, technically.
As they do now. So that's the importance of also going back in time and getting some historical context. Start out with the longer time frames, work your way down all the way to the daily, sometimes even intraday if you want to go there. We're going to sign off here. That's all the time we have for Yahoo Finance's Stocks in Translation. Catch us next week for another scintillating episode where I try to bring Sydney back into the technical analysis foray.
I don't know if it's going to work.
Until next time.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor.
Podcast that will make you a smarter investor.
Welcome to Stocks in Translation.
Justice John Roberts says the impeachment of federal judges is not an appropriate response. News when you want it with Bloomberg News Now. I'm Amy Morris. U.S. Chief Justice John Roberts says the impeachment of federal judges is not an appropriate response to disagreement with their rulings. This extraordinary statement from the leader of the Supreme Court comes just hours after President Trump called for the impeachment of a judge who tried to pause the deportation of hundreds of alleged Venezuelan gang members. Roberts says that for more than 2 centuries it's been established impeachment is not an appropriate response to disagreement concerning a judicial decision, and that is why they have appellate reviews. Now, in that case, the judge ordered a pause on those deportations, which was ignored. White House Deputy Chief of Staff Stephen Miller told ABC News a judge has no authority to question the president's proclamation because he says a president's order will supersede a judge's order.
No district court judge who presides over just some small, little geography of the whole country could possibly presume to have the authority to direct the expulsion of terrorists from our soil, who, by the way, are also here illegally.
Now, the judge ordered the Trump administration attorneys to file a sworn declaration with answers to his questions about those deportations by noon today. That's this hour, after they refused to disclose details about the flights. And that is when President Trump called for that judge to be impeached. All eyes are on Washington today for President Trump's phone call with Russia's Vladimir Putin on ending the war in Ukraine. The White House says it's been underway since 10 o'clock this morning, Wall Street time. Sources tell Bloomberg News Putin is demanding an end to weapons shipments as part of a ceasefire. Bloomberg opinion columnist Mark Champion says it might not end there.
He's not talking just about American arms and intelligence sharing and so on. He's talking about all arms from Europe as well. So that will be a huge one for the Ukrainians. When the U.S. cut off arms before, it resulted in a breakthrough, a disastrous breakthrough for the Ukrainians in the Kursk region of Russia.
Mark Champion with Bloomberg Opinion. President Trump has said he'll also discuss land and dividing assets with Russia during the call. Ukraine's foreign minister says Kyiv will not accept any concessions on its territory nor sovereignty. German lawmakers passed a landmark spending package to unlock hundreds of billions of euros in debt financing for defense and infrastructure. Bloomberg's Oliver Crook reports this would be a sea change under Chancellor-in-waiting Friedrich Merz.
We are talking about basically blowing to pieces 2 orthodoxies of Germany from the last few decades. One, a massive effort to remilitarize the entire economy, the entire nation, something that is obviously very fraught in the context of German political history, but also on the other hand, doing it basically purely by debt financing.
Bloomberg's Oliver Crook. The passage of the legislation is seen as a major step toward reviving Europe's largest economy and bolstering growth across the region, with German stocks rising and investor sentiment improving. Treasury Secretary Scott Bessent believes the underlying U.S. economy is healthy and there's no reason for the U.S. to see a recession. But he also tells Fox News he can't guarantee that.
Can you guarantee there's not going to be a recession? I can't guarantee anything. But what I can guarantee you is that there is no reason we need to have a recession. I think the economy in the first quarter is doing better than the media is reporting.
Bessent expects a pause in the economy as it transitions from relying on government spending. Stocks are lower with traders gearing up for tomorrow's Fed decision that will likely bring an assessment of how President Trump's trade policies are impacting the economy. And we do check markets for you all day long here at Bloomberg. The S&P 500 down 1.1%, NASDAQ down 1.7%, the Dow is down 0.7%. The 10-year Treasury yield at 4.29% and the 2-year yield at 4.04%. Google owner Alphabet has agreed to buy cybersecurity startup Wiz for $32 billion. Bloomberg Intelligence senior tech analyst Mandeep Singh says Google could use this in the cloud.
Cloud is what's worked for them. If you look at, the whole AI wave, it's added almost, 10 percentage points of growth to their cloud business, which is a $50 billion run rate business. And security could be additional.
Mandeep Singh with Bloomberg Intelligence, and Alphabet shares are now down 3%. Tesla shares are down nearly 4% after Chinese automaker BYD unveiled a lineup of electric vehicles it says can charge almost as fast as it would take to refuel a regular car. That has Tesla leading losses among the Magnificent Seven stocks. The Mag 7 stock index has fallen 16% so far this year after it jumped 67% last year. That's news when you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg.
Today, Palestinian authorities say hundreds are killed as Israel strikes Gaza. Trump and Putin are set to discuss the war in Ukraine and control over Europe's largest nuclear power plant.
And 2 astronauts stranded on the International Space Station begin their journey back to Earth. It's Tuesday, March 18th. This is Reuters World News, bringing you everything you need to know from the front lines in 10 minutes every weekday. I'm Christopher Waljasper in Chicago.
And I'm Tara Oakes in Liverpool. An ambulance races to the site of an airstrike in Gaza. Israel has pounded the enclave, collapsing a 2-month ceasefire with Hamas. Palestinian health authorities say over 300 people have been killed, many of whom were children. Panic at hospitals as injured Gazans are brought in. Piles of dead bodies covered in white, blood-smeared plastic stacked up on the ground. The strikes were reported across multiple locations in the Strip. Hamas has issued a statement accusing Israel of violating the truce.
The Israeli military says it targeted mid-level Hamas commanders and leadership, as well as Hamas infrastructure. They say the offensive will continue for as long as necessary and extend beyond airstrikes. There are still 59 hostages being held in Gaza, whose fate remains uncertain. A White House spokesperson says Israel consulted with the Trump administration before it carried out the strikes.
US President Donald Trump is set to speak to Russia's Vladimir Putin this morning about ending the Ukraine war. Territorial concessions by Kyiv are likely to feature prominently in the talks, as is control of Zaporizhia, Europe's largest nuclear power plant. Christian Lowe has been following the story in Kyiv. So, Christian, what's happening at Zaporizhia on the ground right now?
The situation on the ground is that for some time now, Zaporizhia nuclear power plant has been controlled by Russia. So after Russian forces pushed through westward into that part of Ukraine, they took control of the power plant. It's basically been partially shut down. It's not actively producing power. And there are lots of concerns about the safety of this nuclear power plant because, in essence, there's a war going on around it. And there have been instances where munitions have landed on or near to the nuclear power station, and that's caused real concern by the UN agencies that are responsible for nuclear safety, because their point is you cannot wage a war around a nuclear power plant. That could be catastrophic. And this is, let's remember, in a country that had the Chernobyl nuclear disaster. So there's real concern about this, and I think a desire to resolve this situation.
So what does Russian control mean at the plant?
It doesn't help Russia enormously because it's not actually functioning. And part of the problem is that a nuclear power station needs vast quantities of water for cooling. The water is no longer available because a dam that created the reservoir that supplied the water blew up earlier in the war. So it's hard to see of any immediate effective future for the power station. One of the scenarios could be that Russia actually decides to hand it back to Ukraine, letting the Ukrainians take it back. There's no longer a conflict going on around it. That would ease lots of concerns about nuclear safety, and Ukraine, at some point in the future, could start using it to supply its electricity grid.
What's the Kremlin said about it?
The Kremlin hasn't really commented on Zaporizhzhia at all. So their position is, we control it, we're trying to keep it safe. They accuse Ukraine, actually, of creating risks to it. They say that Ukraine fires on it. Ukraine says it's actually the opposite, and Russia is creating the risks for the Zaporizhzhia power station. In terms of what they want to do and get out of the talks with Trump about the power station, we just don't know at this stage. They're keeping their cards pretty close to their chest.
A federal judge has given the Trump administration a deadline of today. He wants details about plane loads of Venezuelans who were deported to El Salvador despite orders not to. Trump claims they are members of the prison gang Tren de Aragua, which he has designated as a foreign terrorist organization.
Mr. Carney, would you like the Prime Minister to show more support to Canada?
Canada's Prime Minister Mark Carney arriving at Downing Street, where he says he is strengthening ties with reliable allies. And the new leader is sending a clear message to the US as tensions rise between the two countries.
We've called out those comments. They're disrespectful.
Carney met with British and French leaders on his first overseas visit. If you want to know more about what Carney's up against as Canada's new Prime Minister, we released an episode over the weekend that goes into all of it. There's a link in the podcast description.
Hong Kong shares hit a 3-year peak on Tuesday, with Chinese electric automaker BYD leading the charge. Pun intended there. Carmel Crimmins has more.
Nice, Tara. I see what you did there. So BYD shares jumped 6% after it unveiled a new charging system that it says can charge an EV as fast as it takes to refuel a regular car. This could be a game changer, convincing drivers who aren't willing to make lengthy stops to go electric and kick off a new supercharging race. It also underlines how investors are turning positive on China. Chinese government promises to support consumption and the rise of AI group DeepSeek have triggered a big rally in Chinese stocks, with the Hang Seng up 23% so far this year, easily the largest of any major market.
Butch Wilmore and Sonny Williams are returning home after an 8-day-long test flight of the Boeing Starliner spacecraft turned into being stranded in space for 9 months due to technical problems with the Boeing craft. The NASA astronauts have undocked from the International Space Station and are expected to splash down off the Florida coast later today. Joey Roulette has been following the mission.
Butch and Sonny have been on the ISS since June, and a lot of people think that they're either floating out there in space or something, or it's like Sandra Bullock in Gravity where everything's really dire. But the reality is they had their test mission turned into just like a normal astronaut stay on the ISS. And so they've had company with Russian astronauts, Japanese astronauts, and their fellow United States astronauts as well. And they've been doing research, all different types of experiments and maintenance on the ISS. And in fact, Sonny Williams did, I think, 2 spacewalks while she was up there on the ISS. But that doesn't really negate the fact that it is probably hard being up there for on a mission that you thought would only last 8 days. I think the psychological toll that would take on anybody would be great. But these are veteran U.S. Navy test pilots and veteran NASA astronauts too. And so when you ask them how they feel, or how does it feel to be stuck in space for that long, unexpectedly, they say, we trained for this. Although our mission was supposed to last 8 days, we prepared for the unexpected. That's what we do. We're astronauts. So they sound good. They sound like they're doing healthy and they're doing well.
So what happens once they make it back to Earth?
So they splash down. They'll be helicoptered over to NASA's Johnson Space Center, and they'll spend several days there for medical checks. NASA scientists and health officials from the astronaut office are going to do the most intense physical they've probably ever gotten to see how their body has changed while they're up there on the International Space Station.
And for today's recommended read, an exclusive on Intel's new CEO and his plans. Lip-Bu-Tan is considering an overhaul to the ailing tech giant's chip manufacturing methods and its AI strategies. There's a link to the story to find out more in the pod description.
For more on any of the stories from today, check out Reuters.com or the Reuters app. Don't forget to follow us on your favorite podcast player. We'll be back tomorrow with our daily headline show.
Is the Jensen Huang playbook regarding this administration has been different than that of some of the other mega cap CEOs, right? He has not been, he wasn't at the inauguration. We haven't seen him going to sort of court President Trump either before inauguration at Mar-a-Lago or at the White House. At least if he has, we have not known about it, right? So it's been interesting. He's not taken the sort of Mark Zuckerberg, Jeff Bezos, obviously Elon Musk tack in approaching this administration, maybe just trying to stay a little more out of the crosshairs, perhaps.
Well, it would be interesting how, Jensen, listen, is a very gifted executive, and like most executives, you don't get there unless you're also also a very gifted diplomat. So my guess is Jensen is making some type of moves because he knows, like, if necessary, he wouldn't mind tariff carve-outs either, right? So depending on what he's saying in the background would be
and not an increase in export controls.
But also too, NVIDIA really hasn't been he hasn't been under attack from President Trump. Zuckerberg has. All Jensen has had to worry about is sell chips that get used by everyone around the world. So maybe he's just like, you know what, I'm not gonna really get involved. I'm not getting threatened to be tossed in jail like Mark Zuckerberg. I'm just gonna keep doing what I do.
Another thing that we'll be looking for today is there has been this sort of training the inference discussion. It looks like Jensen is walking onto the stage, so we'll hear more about it from him right now.
Welcome to GTC! What an amazing year. We wanted to do this at NVIDIA. So through the magic of artificial intelligence, we're going to bring you to NVIDIA's headquarters. I think I'm bringing you to NVIDIA's headquarters. What do you think? This is where we work. This is where we work. What an amazing year it was, and we have a lot of incredible things to talk about. And I just want you to know that I'm up here without a net. There are no scripts, there's no teleprompter, and I've got a lot of things to cover, so let's get started. First of all, I want to thank all of the sponsors, all the amazing people who are part of this conference. Just about every single industry is represented. Healthcare is here, transportation, retail, gosh, the computer industry. Everybody in the computer industry is here. And so it's really, really terrific to see all of you, and thank you for sponsoring it. GTC started with GeForce. It all started with GeForce. And today, I have here a GeForce 5090. And 5090, unbelievably, 25 years later, 25 years after we started working on GeForce, GeForce is sold out all over the world. This is the 5090, the Blackwell generation. And comparing it to the 4090, look how it's 30% smaller in volume. It's 30% better at dissipating energy and incredible performance. Hard to even compare. And the reason for that is because of artificial intelligence. GeForce brought CUDA to the world. CUDA enabled AI. And AI has now come back to revolutionize computer graphics. What you're looking at is real-time computer graphics, 100% path traced. For every pixel that's rendered, artificial intelligence predicts the other 15. Think about this for a second. for every pixel that we mathematically rendered, artificial intelligence inferred the other 15. And it has to do so with so much precision that the image looks right, and it's temporally accurate, meaning that from frame to frame to frame, going forward or backwards because it's computer graphics, it has to stay temporally stable. Incredible. Artificial intelligence has made extraordinary progress. It has only been 10 years. Now, we've been talking about AI for a little longer than that. But AI really came into the world's consciousness about a decade ago. Started with perception AI, computer vision, speech recognition, then generative AI. The last 5 years, we've largely focused on generative AI, teaching an AI how to translate from one modality to another modality, text to image, image to text to video, amino acids to proteins, properties to chemicals, all kinds of different ways that we can use AI to generate content. Generative AI fundamentally changed how computing is done. From a retrieval computing model, we now have a generative computing model. Whereas almost everything that we did in the past was about creating content in advance, storing multiple versions of it, and fetching whatever version we think is appropriate at the moment of use. Now, AI understands the context, understands what we're asking, understands the meaning of our request, and generates what it knows. If it needs, it'll retrieve information, augments its understanding, and generate answer for us. Rather than retrieving data, it now generates answers. Fundamentally changed how computing is done. Every single layer of computing has been transformed. The last several years, the last couple, 2-3 years, major breakthrough happened. Fundamental advance in artificial intelligence. We call it agentic AI. Agentic AI basically means that you have an AI that has agency. It can perceive and understand the context of the circumstance. It can reason, very importantly, it can reason about how to answer or how to solve a problem. And it can plan an action. It can plan and take action. It can use tools because it now understands multimodality information. It can go to a website and look at the format of the website, words and videos, maybe even play a video. Learns from what it learns from that website, understands it, and come back and use that information, use that newfound knowledge to do its job. Agentic AI. At the foundation of agentic AI, of course, something that's very new, reasoning. And then, of course, the next wave is already happening. We're going to talk a lot about that today. Robotics, which has been enabled by physical AI. AI that understands the physical world. It understands things like friction and inertia, cause and effect, object permanence. When some corner doesn't mean it's disappeared from this universe. It's still there, just not seeable. And so that ability to understand the physical world, the three-dimensional world, is what's going to enable a new era of AI we call physical AI, and it's going to enable robotics. Each one of these phases, each one of these waves opens up new market opportunities for all of us. It brings more and new partners to GTC. As a result, GTC is now jam-packed. The only way to hold more people at GTC is we're going to have to grow San Jose. And we're working on it. We got a lot of land to work with. We got to grow San Jose. So that we can make GTC. I have to just, as I'm standing here, I wish all of you could see what I see. And we're in the middle of a stadium. And last year was the first year back that we did this live, and it was like a rock concert, and it was described, GTC was described as the Woodstock of AI, and this year it's described as the Super Bowl of AI. The only difference is everybody wins at this Super Bowl. Everybody's a winner. And so every single year, more people come because AI is able to solve more interesting problems for more industries and more companies. And this year, we're going to talk a lot about agentic AI and physical AI. At its core, what enables each wave and each phase of AI, three fundamental matters are involved. The first is how do you solve the data problem? And the reason why that's important is because AI is a data-driven computer science approach. It needs data to learn from. It needs digital experience to learn from, to learn knowledge and to gain digital experience. How do you solve the data problem? The second is how do you solve the training problem without human in the loop? The reason why human in the loop is fundamentally challenging is because we only have so much time, and we would like an AI to be able to learn at superhuman rates, at super real-time rates, and to be able to learn at a scale that no humans can keep up with. And so the second question is, how do you train the model? And the third is, how do you scale? How do you find an algorithm whereby the more resource you provide, whatever the resource is, the smarter the AI becomes? The scaling law. Well, this last year, this is where almost the entire world got it wrong. The computation requirement, the scaling law of AI is more resilient and, in fact, hyper-accelerated. The amount of computation we need at this point as a result of agentic AI, as a result of reasoning, is easily 100 times more than we thought we needed this time last year. And let's reason about why that's true. The first part is, let's just go from what the AI can do. Let me work backwards. Agentic AI, as I mentioned, at its foundation is reasoning. We now have AIs that can reason, which is fundamentally about breaking a problem down step by step. Maybe it approaches a problem in a few different ways and selects the best answer. Maybe it solves the same problem in a variety of ways and ensure it has the same answer, consistency checking. Or maybe after it's done deriving the answer, it plugs it back into the equation, maybe a quadratic equation, to confirm that, in fact, it's the right answer, instead of just one shot blurbing it out. Remember, 2 years ago, when we started working with ChatGPT, a miracle as it was, many complicated questions and many simple questions, it simply can't get right, and it's understandably so. It took a one shot, whatever it learned by studying pre-trained data, whatever it saw from other experiences, pre-trained data, it does a one-shot, blurbs it out, like a savant. Now, we have AIs that can reason step by step by step, using a technology called chain of thought, best of n, consistency checking, a variety of different path planning, a variety of different techniques. We now have AIs that can reason, break a problem down, reason, step by step by step. Well, you could imagine, as a result, the number of tokens we generate, and the fundamental technology of AI is still the same. Generate the next token, predict the next token. It's just that the next token now makes up step one. Then the next token after that, after it generates step one, that step one has gone into the input of the AI again as it generates step two, and step three, and step four. So instead of just generating one token or one word after next, it generates a sequence of words that represents a step of reasoning. The amount of tokens that's generated as a result is substantially higher, and I'll show you in a second. Easily 100 times more. Now, 100 times more, what does that mean? Well, it could generate 100 times more tokens, and you can see that happening, as I explained previously. Or the model is more complex. It generates 10 times more tokens. And in order for us to keep the model responsive, interactive, so that we don't lose our patience waiting for it to think, we now have to compute 10 times faster. And so 10 times tokens, 10 times faster, the amount of computation we have to do is 100 times more easily. And so you're going to see this in the rest of the presentation. The amount of computation we have to do for inference is dramatically higher than it used to be. Well, the question then becomes, how do we teach an AI how to do what I just described? How to execute this chain of thought? Well, one method is you have to teach the AI how to reason. And as I mentioned earlier, in training, there are two fundamental problems we have to solve. Where does the data come from? Where does the data come from? And how do we not have it be limited by human in the loop? There's only so much data and so much human demonstration we can perform. And so this is the big breakthrough in the last couple of years. Reinforcement learning, verifiable results. Basically, reinforcement learning of an AI as it attacks or tries to engage solving a problem step by step. Well, we have many problems that have been solved in the history of humanity where we know the answer. We know the equation of a quadratic equation. How to solve that. We know how to solve a Pythagorean theorem. The rules of a right triangle. We know many, many rules of math and geometry and logic and science. We have puzzle games that we could give it. Constraint type of problems like Sudoku. Those kind of problems, on and on and on. We have hundreds of these problem spaces where we can generate millions of different examples and give the AI hundreds of chances to solve it step by step by step as we use reinforcement learning to reward it as it does a better and better job. So as a result, you take hundreds of different topics, millions of different examples, hundreds of different tries, each one of the tries generating tens of thousands of tokens. You put that all together, we're talking about trillions and trillions of tokens in order to train that model. And now with reinforcement learning, we have the ability to generate an enormous amount of tokens. Synthetic data generation, basically using a robotic approach to teach an AI. The combination of these two things has put an enormous challenge of computing in front of the industry. And you can see that the industry is responding. This is, what I'm about to show you is Hopper shipments of the top 4 CSPs. The top 4 CSPs. They're the ones with the public clouds. Amazon, Azure, GCP, and OCI. The top 4 CSPs, not the AI companies, that's not included. Not all the startups, not included. Not enterprise, not included. A whole bunch of things not included. Just those 4. Just to give you a sense of comparing the peak year of Hopper and the first year of Blackwell. Okay? The peak year of Hopper and the first year of Blackwell. So you can kind of see that, in fact, AI is going through an inflection point. It has become more useful because it's smarter, it can reason. It is more used. You can tell it's more used because whenever you go to ChatGPT these days, it seems like you have to wait longer and longer and longer, which is a good thing. It says a lot of people are using it with great effect. And the amount of computation necessary to train those models and to inference those models has grown tremendously. So in just 1 year, and Blackwell has just started shipping, in just 1 year, you could see the incredible growth in AI infrastructure. Well, that's being reflected in computing across the board. We're now seeing, and this is, the purple is the forecast of analysts about the increase of capital expense of the world's data centers, including CSPs and enterprise and so on. The world's data centers